acquiring them. So, at the current levels, it probably makes sense for you to take a call on moving to something else, or wait for at least the consolidation and then kind of re-enter is what I would feel maybe an ideal recommendation.
Okay, all right. Hi, Prakash. Good morning. Good to see you in. I want to ask you about the big boy Reliance Industries. Over the weekend, there were various unconfirmed reports that suggested that Reliance and Rosneft could be doing a deal out there, which could be a multi-billion-dollar deal. It'll be interesting because it could probably make Reliance the largest refiner in the country. And also, it'll increase their OTC EBITDA by a large extent. The stock in the last 1 year actually is unmoved, but it's found its momentum in the last 3 months. At 1,500 rupees, what's your take?
Good morning, Nigel. So I've been a big believer in the Reliance story over the long period of time. They've kind of overcome setbacks, environmental, regulatory, seasonal, whatever you call it. And all new businesses that they have nurtured have kind of started reaching a stage of maturity. You look at the Jio numbers. I think they added 10 times more than what Bharti's done with all the aggression that Bharti seems to be getting back. So Jio has done things more quietly. And I'm sure closer to the AGM, you'll probably start seeing an expectation build that there could be some announcements towards some sort of a roadmap on the listing, whether it's Jio, retail, whatever. But my sense is, and retail, by the way, retail is also doing exceedingly well. If you look at the ground reality of, what numbers add up, the kind of aggression they have started demonstrating in terms of faster delivery turnarounds and all of that. So I don't think there's any reason, and if this O2C thing is likely to come through, I think it will spur the stock to come back to its to its highs. And look at where the momentum of the market is. I mean, it's Reliance carries almost 10% plus kind of weight in the Nifty. So if the Nifty were to do well, Reliance were to do well, Nifty has to do well. So it's like a cyclical thing. It's a self-fulfilling arrangement. You will see Reliance do well because the kind of buying that's happening is fairly large and it's institutional. And I wouldn't be surprised if the FIs have started to add to their portfolio. Till now, it's been under-owned in that aspect, and that's kind of probably changing now. I mean, I'm just looking at the numbers and the kind of volumes and delivery numbers that have been reflected on the screen. But fundamentally, I think Reliance definitely has much more space to go because for the first time, all its verticals have started kind of maturing and performing and revving up to the optimal levels.
All right. And finally, before we let you go, Prakash, do you have a view on the oil marketing companies? It's time to tank up. Oil prices are lower and we don't have any near-term events like state elections, etc. So there could be a case for, prices to stay where they are. That means that's margin positive for them. Would you view this?
Absolutely. I think Manglam, this is one basket that will surprise everybody in the next couple of years. And I'm saying couple of years, not necessarily just the next couple of quarters. Notwithstanding the fact that this quarter number, June end numbers, they'll report a record profit just because of the kind of crude levels price levels that they have enjoyed. And you're right. Last year around the election in June, there was anticipation that the moment the elections are done with, you'll probably see some sort of a price, this thing change. That didn't happen. So all that margin is still sitting on the books, and this will continue. And the big bugbear out there was the LPG subsidies, which will start coming back to them in trickles if it's not like a torrent, but which means that it'll keep adding to the P&L incrementally without much of outflows looking forward. So I think you need to just take a basket approach, buy all three of them because all of them have their own salience and at times things work differently. But for the next 2 years...
Stay on, need to slip into a very short break. But on the other side, we'll also get chatting about the market technicals. After a 4-day run, what are the charts suggesting? Will the momentum continue or will we see a pause? Sudarshan Sukhani and Mitesh Thakkar will join in with a few trading ideas. Stay tuned.
Welcome back. Hope you're having a good morning. Well, the Nifty, the buy on dips continued even on Friday's trading session. But where are we headed from here? To help us out with that, we have Sudarshan and Mitesh to join us this morning. Good morning, gentlemen. Good to see you all in as always. Mitesh, you go first. What's the call on the Nifty? A mild uptick is what the GIFT Nifty is suggesting. But where are we headed from there?
Good morning, Nigel. So I think ever since we broke beyond 25,100 zone, I think I've been looking at 25,500 as the first target and then 25,740, 750, which is where we had a gap when the markets were falling. I think that would be an area where I would be inclined to take profits. You've seen a good 500-600 point kind of a rally in the last few days, and there's a gap level, and we're also getting slightly overbought on the hourly and 2-hourly chart. So my idea is that while we may eventually go higher, in the near term, 25,750 will be a significant hurdle, and levels close to that should be used to take some profits on the long positions.
All right. And Sudarshan, you've been positionally bullish on the frontline index, and you said that, use every opportunity to go ahead and buy. Now that we are at levels where we are, do you think chasing this would make sense, or maybe again, wait for a dip and then add up?
Yeah, good morning. I would say that we've had the first leg of this up move wherever it goes, and the chances are that we will now consolidate and chop around for many days, at least for today, certainly. So there is no rush. If you have long positions, you can as well take profits because markets are uncertain in the best of times. Take profits on your long positions, wait patiently for either a sharp correction of 300 to 400 points or a protracted consolidation that goes for 2-3, maybe the whole week. So till then, there is no rush to buy. So the way you put it was correct. There's no rush to buy. Take your profits and wait. But the only trade is to buy, not now, but whenever.
Okay. All right. Let's get to individual stocks then. Sudarshan, you go first. What's on your radar?
Well, the first is Torrent Pharma, which you've been talking about, and we had a big up move. Now that's a breakout. Now this is a positional trade. You don't have to rush to buy at the morning, but whenever you get an opportunity, go long, because that breakout tells us that significantly higher levels are coming. So with a stop under 3,300, consider going long in Torrent Pharma. Power Grid is a buy with a stop under 293. Pidilite Industries is a buy with a stop under 3,000. And Berger Paints is a buy with a stop under 570. It's an all-buy list as usual.
All right, an all-buy list. Interesting one on Berger and Pidilite. Paint stocks did well post the deal on Friday, and thereafter Pidilite, of course, for all of them looking to move away from the paint space but still stay in the home improvement space. Adhesives, Pidilite, as of now, Fevicol has no competition, so the street is looking at that. Raw material prices also fairly contained fundamentally. Mitesh, your individual stock picks?
Good morning. I have actually 1 sell and 3 buys. So on the buying side is Apollo Hospital with a stop at 72.50 for targets of 74.30. Lotus Labs, which made a fresh swing in a fresh 52-week and all-time high, is a buy with a stop below 689 for targets of 725. A sell call on Dr. Reddy's with a stop at 1316 for targets of 1265, and Deepak Nitrate is the final buy call. Keep a stop below 1960, look for targets of 2010.
All right, gentlemen, thank you so much for joining in. We will come back to you for trades at 10 as well. With that, we'll take a short break. On the other side, we have the management of Texmaco Rail and Engineering. They won a near 530 crore order. What does that mean for their book and growth going ahead? We'll discuss with Sudipta Mukherjee, who joins in. Less than 20 minutes to go for trade. In fact, just a couple of minutes to go for pre-open as well. The GIFT Nifty is indicating a positive start for our markets after what has been a stellar week for the Indian markets and a good time for global markets in general, easing trade tensions, etc. GIFT Nifty, when we started the show, was up just around 15 odd points and now up 41 points, indicating that optimism is building on as we move towards the open for our markets itself. We do have Prakash Diwan still with us. Prakash, I wanted your view particularly on the auto space. Is there anything that you like here? You know, you have the auto sales data, which is likely in the next couple of days, and the Vahan data does not indicate a big jump that we've seen in the month of June. Do you think things can improve? If yes, then what are the stocks that one should benefit most from it?
So quite difficult to hazard a guess, but you know the data that we've seen possibly could throw up some surprises on the two-wheeler side with some of the players like TVS who haven't been doing very well because of some, you know, they launched a certain scheme for the dealerships. You know, they've revamped the discounting structure, the kind of, you know, working capital needs that they have from dealers and all of that. So that could have probably helped, but generally, by and large, June is not a month where auto sales pick up. It's only post the monsoon that things will probably look up, Manga. But in the, you know, in the shadow of improving OEM sales, what we could look at is some of the ancillaries which will do well. And what you need to look at is slightly long range. But you know the notification that's come for the ABS in two-wheelers. Right now it's only for 150cc, but now it's going to be next year onwards. It's going to be for all two-wheelers. And that means a company like Bosch could be probably a very key beneficiary because they sit right on the top of the value chain out there. So, you know, you will have certain moves like this which will benefit ancillaries selectively depending on the strengths. But I'm not too bullish on the OEMs at this point. And you will have the likes of Mahindra and Mahindra battling it out with the Tatas on the EV side because their aggression is kind of getting into shape. But barring that, I don't think any fireworks that are expected out of the numbers tomorrow.
Prakash, on this issue of ABS being mandatory, possibly for two-wheelers, if that were to happen, will it not push up pricing and therefore hurt demand for two-wheelers? And keeping that in mind, how would you approach two-wheeler names?
Yeah, so there is always that fear. You know, it's very similar to when truck cabins were likely to get air conditioned compulsorily. There was a lot of protests. There were a lot of, you know, doubts whether, you know, the OEMs will be able to pass this off. But look at what has happened to a company like Subros in the last 1.5 years, right? I mean, it's kind of almost done about 200-250%. So this is something which takes time to get established. But if you see in the long run, people get used to a benefit, an advantage that they're getting from a feature that's compulsorily added because it does increase safety levels. So what it does is it helps you set off potential damage costs that you would have if something goes wrong. And then it's, of course, safety, human safety, that's what you're paying for. But the scale that two-wheelers have, Rima, will probably not mean that the ABS is going to be very expensive. It won't be a incremental load up on cost very significantly. But I would wait to see how things pan out. It's, as I said, it's still a long you know, duration. 1 year is still quite some time away, but it's very positive for the overall upgradation of quality of vehicles, and this will also help in the export side to a lot of the players that have already been doing it, but they'll probably be able to optimize the costs once this happens domestically as well.
Okay, all right. Prakash, request you to stay with us. For the time being, let's connect with the management of Texmaco Rail as the company has secured a big export order of around 535 crore rupees. To discuss this and more and what about the outlook from here on, we're joined by Sudipta Mukherjee, the MD at Texmaco Rail as well as engineering. Hi, Sudipta. Thanks a lot for joining in. Give us some color about this. What are the margins you will enjoy on this? Since it's an export order, are the margins better? And also there's a potential for another big order coming in there. What could that value be approximately? Just doing a rough calculation could suggest it could be 1,000 crore order.
Good morning. So far margin is concerned, it should be in the range of higher teens. And
it should be in the range of, so we missed that number.
I said that so far margin is concerned, it should be in the higher teens.
Okay.
That's what we expect. And if you see that it's a long-term contract, it's not only design and supply, but it also involves element of maintenance for 20 years. So we feel that this is a kind of, I think, one of the largest for an Indian company to have a rolling stock order from overseas market.
Okay.
And this market is predominantly led by Chinese companies and also some European entities. So winning such a large order definitely creates a opportunity for us to multiply this.
Sudipta,
Yeah.
Sudipta, if I got that correct, you said high teens are the margins, which are much better than what you're doing currently. Is that correct?
Yes.
And this is around a 535 crore order for supplying around 560 open-top wagons. That's right as well, right?
Yeah, it is right. And along with this, there is also a maintenance component into it because
Okay.
this has to be maintained over there.
How much would that be in terms of money for you?
So
Maintenance contract?
230 crore. I mean, it's the 90% of the 95% of the total order book. And also, it has a provision of further 1,040.
Yes. So that's exactly what we wanted to understand, Mr. Mukherjee. You know, one of this 535 crores, maintenance is 235 crores is what you're saying, right? And how long is the execution timeline on this? And on what basis are you likely to see that upsize for the deal coming in?
Okay, these 560 wagons has to be delivered within 24 months.
Okay.
And, the balance part is has to be supplied, of course, depending upon an outer limit of 5 years, which is comprising of 1,600 wagons. And of course, it's a turnkey project design and supply and maintenance. And the higher margin comes from the unique solution which we are providing, considering the track conditions and the reliability factor and the performance, which we are going to establish over there.
So by when will you know whether this deal has been upsided or not?
It should be done within these 2 financial years.
Okay, so these 2 financial years, you will, deliver goods worth nearly 230, 240 crores. The remainder is spread over 20 years as operations and maintenance. And by the end of this second year, you will know whether this deal has been upsized or not. If the deal is upsized, how much bigger will the book be? How much bigger will your revenue be?
So it should be in the range of 1,500 crore, no less than that in Indian rupee. And we have full conviction of upsiding it because you know that particular continent. So there is a focus by the government and I mean the whole world is looking forward to because of various platinum category mineral availability. And this particular project is targeted for some bauxite mining. And other than that, there are so many other opportunities which is coming up and is a part of the larger scheme taken by the CAMRail, which is the national railway in Cameroon. So we have a conviction that it has to come because it is outer line of 5 years have been put because considering the progress of the new tracks which are coming up, there is another 512 kilometer tracks which are coming up in the country, connecting various cities and ports. So definitely seeing at the progress of that, these rolling stocks will be required, if not more.
With this international order, what would your order book now stand at? And what is the percentage of international orders?
So we have around 7,800 crore on a standalone basis order book today. And if you see, it is around 10% of the total order book, which is of export order we are having today.
Okay. And are we seeing an increasing contribution from exports? Because the margins are clearly higher. You spoke about, I think, mid-teen, kind of high-teen margins for this particular order. Are all international orders with a similar margin of high teens?
Generally, yes.
Okay. And what about the contribution of exports? Do you see it going up from the current 10%?
Yeah, I would like to answer you in little bit elaborate in this, that because there was a question also that why it is higher. So these are not the commodity product portfolio where we are getting these orders from the export market, and whenever we work for the private markets also, which is unlike to the requirement or the supply which we do for Indian Railways. So these are niche products, and you need to design for a specific requirement of the customer. So there is a room for you to have a better competitive, higher margin pricing in a competition when you use technology and newer generation products, or a specific boutique product to satisfy the customer. So, and in terms of the growth of the export market, we in Texmaco has a target that in next 3 to 4 years time, our portfolio should have a 30% export component.
Okay, all right, 30%. All right, great. So that would mean margins as well trend up based on what you're saying, because they are commanding better margins. Let's talk about the near term, FY26. Let's just revisit those numbers. What kind of revenue growth can you do? What kind of margins? Last year, I think you did ballpark close to 5,000 crores on that sort of a base. Going by the traction in orders, what kind of revenue growth, what kind of margins you're looking at, and order inflow for the year? Please go ahead.
So in terms of the top line, we feel that we should have a decent 15 to 20% growth. But in the bottom line, we are targeting a EBITDA percentage near the between lower teen to mid-teen. So that's the immediate target for the company. And we have taken certain restructuring of the organization. That includes the demerging of the rail infra business to a wholly owned subsidiary. And with this focus, we feel that the core business of the company, other than the rolling stock, has a significant room of growth where you can see around 25 to 30% growth.
All right. So
you're saying margins in FY26 will be low to mid-teens, 13, 15%? But that's a substantial jump from the 9% margins that you had in FY25.
Yeah.
So what would, in 1 year, in 12 months, what can explain such a big jump in margins?
So it's basically the product portfolio, efficiency improvement, and focus on specific markets. Because if you see that historically, due to large order book of Texmaco from Indian Railways, it was in a range of 90%, and 10% market was for private and export. So our target is to change this mix without compromising in numbers to at least 65-35.
right. You know, one issue that the industry was facing was that of lack of wheel sets, and that was impacting execution. Are you facing that as well, or are you fairly well, equipped with wheel sets for your growth going ahead?
For railway order execution, we are facing problem of wheel sets. So it is not fully resolved. And hopeful thing is that by mid of July, Indian Railway has been pragmatic to solve this problem forever. And we expect that from mid of July or end of July, things should normalize for the Indian Railway supplies. For private and export wagons, we are not dependent on this crisis. So we are well off to manage our wheel sets up, whatever we require.
How much of your growth guidance this year depends on the wheel set availability? Because if that does not come by July, say September, October is when it comes, then do you think your growth can be lower by a couple of percentage points?
We don't envisage that as of now, because you see that Texmaco has geared up very well last couple of years. And we focused on improving our capacity and capability quite significantly. And we have, I think, one of the most efficient production system in the country. Last year, we have delivered highest rolling stocks to Indian Railways and private sectors, with the largest manufacturer of the country, in spite of this wheel problem was persisting. And of course, it is little bit acute in the this first quarter of the financial year. But we believe that with our flexibility of production and large capacity, we'll be able to maintain and make up in next 3 quarters. And we do not want to give a different guidance than whatever I have said now.
Right. Just a final question from my end on your business diversification itself. We've seen you diversify into different geographies, whereas some of your peers have diversified into different product categories. Some of them have gone into rail infra, some of them are, making wheel sets themselves, some of them have gone into the metros, and some of them have gone into the defense space as well. Are you looking at these as diversification strategies, or do you believe that increasing exports is the way to go for Texmaco?
For Texmaco, the strategy is very clear and lucid. We are following a strategy of going deep as well as working wide. So whatever we have here, we have certain in the core business have certain key advantage which other peers doesn't enjoy in the country, being our presence and the certifications to supply to all the continents, our design and innovation capability, and our state-of-the-art foundry and components and the customer base. So there our focus is to increase our reach to newer markets and newer products related to the core business. And for the breakout business, yes, we are focusing. If you have seen that we have also got into the passenger mobility interiors, because we feel that the key ecosystem of the passenger mobility in the country, which is going to grow manifold, are one of the enablers to get into the whole product maturity cycle. And these are areas, are niche areas where Indian capability should come in. And along with this, we are looking for various wide opportunities, including various other component areas, digital spheres, predictive maintenance, and also certain things.
All right, we take that point. Thank you so much for joining in and giving us all your growth prospects for this year, but more importantly from a long-term strategy standpoint as well. We'll have another conversation soon. Wish you good luck with the execution of this order and the potential upsizing as well. With that, we're close to the 9:10 mark. Sudarshan joins in with his 9:10 call, as does Mitesh. Sudarshan, you go first.
Well, Power Grid, look to buy Power Grid with a stop under 293.
Mitesh?
I go with a buy on launch slabs for targets of 725.
Got that. Thank you very much for that. Let's get Ritu on the show now. She's going to get us the latest on IndusInd Bank and JP Associates resolution. Ritu.
Well, on IndusInd Bank, watch out for today because 30th of June is the deadline by which the Reserve Bank of India had asked the board to submit the candidates for the potential CEO position. We'd reported last week 3 contenders are in the running. Rajiv Anand, currently the DMD of Axis Bank, who's set to retire in August, would make him an ideal candidate and we're given to understand is very much a strong contender. Then there is Anup Saha from Bajaj Finance, again with more than 25 years in financial services, recently elevated to the position of MD in Bajaj Finance, and Rahul Shukla of HDFC Bank, who's currently looking after commercial and rural banking, but is on sabbatical, very much in the mix still. We're given to understand between these 3, Rajiv Anand and Anup Saha are the 2 names that the board is looking at more keenly. Informal discussions have already happened with RBI, but the formal names are yet to be submitted. We're also given to understand RBI may fast-track the approval given the urgency of the matter. As far as Jayaprakash Associates is concerned, we've reported there are 5 suitors.
Ritu, the bell is gone. The first tick is in the green, but it's a quiet opening. So after 4 days of a run-up, there is a pause in momentum. The Nifty is just up close to about 8 points. Sensex is moving between the red and the green line. Very, very quiet. But the mid-cap action continues. I think the mid-cap index is higher now for the 7th consecutive day with a gain of close to about 0.5%. The advanced decline ratio, the heat map, will also come up for you on your screen. So banks continue with their run-up. So a little bit of an outperformance, 100 points up on the Nifty Bank. It's IndusInd Bank right on top, the stock that Ritu was talking about. Today is the last day for the board to submit names of the CEO to RBI. IndusInd Bank is up. Jio Financials is having a good run. Axis Bank is gaining nearly about 0.5%. And in the PSU lot, it's State Bank of India in the green. Trend, Coal India, L&T, BEL, Eternal, ONGC, These are a few of the large cap stocks where you have a bit of green going for themselves. On the way down, Reliance Industries, HDFC Bank, the big contributors to last week's up move, are retracing some of the gains. Not down a whole lot, just down about 1/3 of a percentage point, but those two heavyweights are seeing a little bit of a profit booking. Two-wheeler names like Hero MotoCorp are under pressure. SBI Life, Bharti Airtel, Tata Consumer are some of the names which where at least the first tick is in the red right now.
All right, from the broader markets, well, a few stocks are calling for attention. Transrail, that one, in fact, is buzzing away. Big up move is what we're seeing on solid volumes out there. So that one should come up for you on the screen. SBFC as well, that's another name that's doing very, very well. Solid uptake on that name as well. Volumes quite high on these two. Last few days, we have seen that Lloyd Engineering has been buzzing around and volumes are large. So that is up another 2% on large volumes yet again out there. So keep an eye out on that one. Jyoti CNC, as the bottom of your screen is telling you, there was a large trade that was executed and that was on expected lines. We had reported that as well. 1.37 crore shares, which is 6% equity. Changing hands, total deal worth around 1,500 crore rupees. Massive volumes. Let's see. Sometimes, once this deal gets out of the way, you see some of these stocks bounce back. So I'll be interested to see whether or not that's going to happen in this case. Hind Rectifiers, couple of big order wins. The street likes it. That one is zooming away. It's up close to around 10% as we speak. Last quarter's numbers were good. Couple of deal announcements coming in there as well, and volumes picking up on this particular name. Keep in mind, it had corrected, I think, from around 1,700 rupees all the way to around 1,000 rupees, and that's bouncing back in trade. The Nifty, for the time being, well, that's a little bit lower, but plenty of stocks from the broader markets are doing well, and the broader market outperformance is something that's notable. Indra Prastha Medical, that's the other one that's up close to around 5%, massive volumes. Manglam.
The pair of the morning has to be JB Chemical and Pharma as well as Torrent Pharma. So Torrent Pharma mildly in the green, opened much higher, opened about 3.5% higher. Thereafter is now sitting with a gain of just about 1.2%. Whereas on the other hand, we have JB Chemical and Pharma. The deal has been done at a discount to its prevailing price. Even the open offer is at a lower level versus its prevailing market price. And that stock, look at it, down 6.5% straight off the bat, lower in today's trading session so far. Bharti Hexacom did extremely well towards the close of trade on Friday, but thereafter the stock has opened slightly lower. Some bit of profit taking is what the street is seeing out there. ITD Cementation, one orders, the stock has been doing well lately and now opens fairly in the green once again. The other stock which is doing well is VRL Logistics. So the stock has been on an uptrend ever since it reported its fourth quarter numbers, and since then, volumes are piling up. The stock opens up with a gain of almost 4% with decent volumes. And another stock which is coming up on the volume gainers list is Dreamfolks. All of last 2 weeks it was under a wee bit of pressure, concerns around whether key clients are sticking around with them or not. Dreamfolks is making a bit of a comeback. But Torrent Pharma is the one that I'm watching out for once again, because now it's lost about 3.5% from its highs. Let's see whether the street, is okay with the balance sheet upsizing of this deal and the debt that it brings. Or in the near term, there would be some EPS related issues. But other pharmaceutical companies are doing a lot better. So we have Aurobindo Pharma, which has moved higher, up around 3%. We have Alembic Pharma, which has moved higher. And Pfizer too has opened about 2% higher. So pharmaceutical stocks, barring Torrent Pharma, which is mildly in the green, are largely doing well. And JB Chemical, of course, because of the deal price being lower, is down about 6%.
And Karnataka Bank, a couple of big resignations at the top. The stock is selling off. It's down close to around 4.5% as we speak. So that's the other one you should keep on your radar. 4.5% or lower as well.
Schloss Bangalore, the owner of Hotel Leela, and Aegis Vopak, their 30-day lock-in comes to an end. So Hormus was saying for Schloss Bangalore, the owner of Hotel Leela and Resorts, about 5% equity is now available for trading. The stock is down about 2.5%. And I think some other names also he was referring to. There was Synoris Pharma, Sai Life, Stanley. Some of these, in some of these counters, there is stock now available for sale after the lock-in has come to an end today.
I wonder what's taking place with Godfrey Phillips. That stock has been smoking hot. In fact, over the last couple of months, it's seen a big rally right now as well. It's up around 3.5%. In this month, it's up around 10%. But we've seen in this year itself, the stock is up 80%. The first half of this year, it's up 80%. And it's not that it didn't do well in the previous year as well. So if you look at it, the second half of last year, It was up 50%, at another 80% in the first half of this year. So Godfrey Phillips is one of the stocks which is spiking as we speak.
All right, well, let's welcome Mahesh Patil, Chief Investment Officer, Aditya Birla Sun Life AMC, who joins in. Hi, Mahesh. Good morning. Good to see you in. Markets appear to have got its mojo back and in style. Now the street is talking about, higher highs and, in fact, moving on in the upward trajectory. What do you think? Euphoria, or do you think that it's very realistic? I think earnings is going to be the key determinant, and we'll get a sense of that in the next couple of weeks. But how are you feeling with regard to the Indian markets as of now?
Yeah, good morning. I think some of the headwinds or the clouds which are lingering around, right, on the geopolitical side, as well as on the tariff front, I think those are kind of now moving away, and that is giving a comfort that I think the risks which were there are kind of coming up, and you've seen that not only Indian markets but even the global markets. I mean, U.S. market is now almost close to its all-time peak now, right? Where in fact, there's a bigger concern, right, in terms of slowdown in growth because of the tariff impacts. So I think that is, I think, now kind of behind. And overall, I think the liquidity flow into the markets is also improving. We've seen FIs slowly starting to come back. Domestic flows have been steady. And I think valuations were reasonable. I mean, markets, after the correction, what we saw around 6-9 months back, a lot of stocks had come down to decent level. We've seen now interest coming back, not only into the frontline names. I mean, the large caps were always looking good on a valuation perspective, but even the broader market, right, the mid cap and small cap have seen a good recovery. Although I would say that it is more stock specific in the mid and small cap. Not everything is Muda, but clearly, I think the confidence is coming back. And as we step into this fiscal year, we would see that the overall trajectory of growth, at least on the earnings front, should be better than what it was in the last fiscal year. More so in the, I think, second half, while the first quarter could still be a bit tepid because there has been some uncertainty on the global front. Companies have been doing a wait and watch. But I think clearly, with good monsoons also now coming in, we're expecting the sowing season has been good. So rural economy should do well this year, no? And that should support some amount of consumption also, which has been kind of lagging behind.
There's consumption which is likely to do well, sowing season, which implies that a lot of the domestic-facing names are likely to do a lot better. But, Mahesh, I wanted your views on the IT space, because that is one index which is still a fair distance away from its 52-week high at a time when all the other indices are fairly close to their highs. Do you think the weakness is priced in and global situation is looking a lot less cloudy now than what it was, say, same time last year?
I would guess so, yes. I think the IT sector was the first one to underperform, right, earlier because of global concerns. And I think on that front, I think US, where you were expecting a recession, the probability was much higher around, say, 3-4 months back. Now that has receded. And looks like at least the commentary also from the IT companies is that the worst seems to be behind. That doesn't mean that you will see a sharp recovery over there in terms of volume growth. It will be still slow and tepid. But I think this is a sector where I think overall stability, I think, would be there. I think the downgrade cycle seems to be behind over there. Also, the cross-currency impact also could be slightly positive, at least in this quarter. And that should support. So I would say that this sector is now looking, while the stocks are not cheap, especially in the mid-cap and the small-cap space in the IT is still expensive relative to the historical numbers. But I think clearly the headwinds there are behind. So I think if there is any positive surprise or slight change in the commentary, I think the stocks are probably ready to bounce from these levels.
So if you had to construct a portfolio, Mahesh, could you give us a broad sense of how you would do it with the preference and then the allocation to each of the sectors or themes?
So I think the allocation would be, preference would be more towards domestic plays because global uncertainty, I think on the tariff front, while we've seen that, I think that might still prevail for some time. So domestic plays, especially, as I said, the focused on the rural consumption. So we've seen that even some of these agrochemical companies are likely to report very good numbers in this quarter because volume growth has been strong. But as we move forward, right, we should see some of the discretionary consumption, especially as we move into the festive season, should do well. Rate cuts have happened, and we've seen the transmission of that happening pretty fast, and that should help some of the interest rate plays, especially say if you're looking at banking and financial, then the financial services, the NBFCs in particular, I think should see a better growth not only but also improvement in the margins over there. So by and large, I would say a domestic focus, and on the external front, I would say sectors like say IT, for example, which have already underperformed and factoring a kind of slowdown, I think they could be a kind of a contra play to look at.
All right, the big story really, Mahesh, which has given confidence, particularly on the macro front, has been the sharp fall in crude oil prices. And it's, continued. There's no big view that's come in that crude oil prices are going to dance away to 100 anytime soon, even though we have geopolitical issues that cropped up. In that sort of a backdrop, what's your take on these OMCs? They appeared that at least as of now, valuations are in favor, crude oil prices are lower. How would you play this fall in crude oil prices? Will it be the OMCs? Will it be the paint companies because they stand to benefit, or would it be the FMCG names?
Yeah, so you're right. I think even with the worst of the, tensions which were there, we saw the crude price didn't go above $80 or so, right? And now with those things behind, I think the pressure on crude oil is fairly evident. And it looks like it will remain at these levels, right, around $60 or so. So given that, I would agree that the oil PSUs, oil marketing companies, are likely to see a better kind of marketing margins. Although the refining margins have also actually improved a bit. So I think all in all, I think the outlook there should look better. But I think you should also look at, while crude oil prices have come down for the other sectors, it's also important to look at the demand side, okay, how that is shaping up, because unless the demand picks up, you will not see the benefit of crude price really coming in. Otherwise, they have to pass it on to the end consumers. So, but I think across the board, I think the inflation and this thing basket, I think should be lower. So I think that's good. And anyway, the macro, I think it is more important, right? Because we've seen that this last month, after many years, we've seen that the current account deficit, right, was in surplus. And that shows that it's a combination of not only crude oil prices, but also on the export side, remittances and this thing were also good. But I think that places India in a much more comfortable macro situation for stability. And that means good for flows, foreign flows into the economy.
All right, just look at Reliance. The stock has recovered a fair bit from the lows and actually taken the Nifty back into the green as well. It was mildly below the flat line at open for Reliance as well as the Nifty. And if you pull up both the intraday charts of the Nifty and Reliance, you would know that they're fairly strongly correlated right now. Reliance has been leading the gains on the frontline index. Right now, it's recovered from the lows, and that's taken the Nifty back into the green as well, slightly above the flat line. I wanted your thoughts in particular on the consumer discretionary space, Mahesh, because a lot of people believe that urban weakness is also now bottoming out, and from here on, discretionary would do a lot better than staples because, that's where a lot of the incremental income would be deployed. So in light of that, say, hotels, Eternal, and a lot of these other new age companies, would you back them at these valuations?
I think the discretionary consumption, again, was weak last year. It is recovering. Still, the trends are not really very strong, but I think the two things. One is the rate cut, which should start, the transmission should start through, and that will mean that your disposable income could be higher. Secondly is the kind of a tax breaks which were given in the budget, right, for 1 lakh, total amount which has been passed on to the taxpayers. I think that will start to now flow in, and that will help the rural urban consumption, I would guess. So I think, as I said, mostly I think you should see the impact of that coming in into the second half, where it should gather momentum. And rural consumption is, as I said, with good sowing season, rural wages are in positive territory. Real wages are doing well, slightly than what it was in the last 2 years. So that should also support. So I would say that consumption, especially discretionary consumption, retail companies, consumer durables, and the likes, I think could pick up. But it'll take time. It will not happen in the first half. I think you'll see that impact more in the second half.
What do you expect from banks in this earnings season? Because the latest reported system loan growth has been subdued. I think as of 13th of June, the loan growth was sub 10%, 9.6%, which is lower than the FY25 level. And plus, there will be the NIM compression that we will see on account of the rate cuts. So what's your expectation from banks? And if there is some weakness, would you go out there and add to any financial stocks? And where would your preference lie in financials?
Yeah, so banks this year, the outlook for overall growth is a bit muted in high single digits because, as I rightly said, because of the rate cut, you'll see an NIM compression. But I think there is some benefit coming in because of the overall CRR cut also. So the impact is not as high as one would have expected, considering that we have seen a 100 basis point rate cut, in the last 6 months, 9 months. Having said that, overall loan growth is, I think, the bigger challenge, as I rightly said, is in terms of the loan growth. In fact, last year, the concern was on the deposit side. Deposit growth was weak. I think that is now improving with overall system liquidity looking better. And banks have also been able to now cut rates, deposit rate much faster. So that should also help on the liability side, though the impact will take time to percolate through. So overall, I would say that the loan growth is the bigger this thing. I think and for that, I think we'll have to wait and see how the recovery happens, both on the retail side and on even the corporate side, because of the uncertainty. I think we've seen the corporates have been slightly hesitant in terms of pursuing with some of the capex plans. But as we get more clarity on the global front, I think you will see that also pick up. I would say that banks look good. Short term this quarter, there could be slight, the profit growth would be slightly weaker, but I think one should really buy into this. We don't see any major structural challenge in the banking space. Continue to prefer the private banks. I think though PSU banks are also looking good now because we've seen them underperform recently and the valuations there are fairly comfortable. But again, they would be more cyclical plays rather than structurally. We'll still prefer the private banks.
All right, we take that point. Thanks a lot, Mahesh, for joining in and chiming in with your view on the market, the economy, individual sectors, and how they're likely to perform from here on. Seems like maybe the second half of this year a lot better given the favorable macros. The one consensus view that is building on right now, however, is that oil marketing companies are likely to do better as their margins will improve. So let's take it straight to the management of Indian Oil Corporation. We do have A.S. Sani, who's the chairman of IOC, joining us now. Thanks a lot, Mr. Sani, for joining in. A lot that's been happening, right, in terms of tensions, and the first thing that gets impacted is crude and crude supplies. That seems to have eased so far, but despite that, could you tell us how much has India been importing from Iran? How has the volatility impacted the spread so far? How's your business likely to play out from here on?
First of all, there was practically no impact of crude supplies during this last 10-15 days that the war was there, war-like situation was there. We have not been affected. As India, I can say that we have not been affected, not only Indian Oil. That is one point. The second point, you asked that how much we import from Iran. No, we don't import anything from Iran. As far as my information goes, most of the Iran supplies go to China only. That is the second question. The third question is the price volatility. Yes, it went up in a single day by around $10 to $11 to a barrel also. But the good news is that as soon as the situation seemed to normalize, it has again come back to sub-70 levels. It is 67, 68, 65 levels, which are a comfort zone for us as Indian Oil and as Indian refiners, Indian OMCs.
So what's the crude breakup looking like right now, sir? Say for the industry and for your company. What's the sourcing mix?
Actually, it is a dynamic thing. You all understand it. But the question that you are asking with reference to Middle East, around 40% of my crude are coming from Middle East sources. and balance 60% is coming from all other sources, including Russia, including Western African countries, including the Latin American countries, and other sources, maybe some of it from US and Canada also, and other sources. So it is a mixed batch. Today, India per se and Indian Oil is importing crude from at least 38 to 40 countries. So it is a very well spread layout wherein we are not depending, or we are not putting all our eggs in a single basket. So we have a pretty spread out.
All right, Mr. Saini, if you could tell us what are the current petrol and diesel cracks? And if you compare it, say, with 3 months ago or 6 months ago, has there been a big swing out there?
Volatility, yes, of course. When these disturbing situations were there, it affected the gas oil, that is the diesel cracks more, because a lot of gas oil comes out of Middle East and it goes into other geographies. So there was a concern on gas oil availability for other parts of the world, not for India, but for other parts of the world. So it affected in a slight jump in the gas oil cracks. Gasoline cracks, the MS cracks, were more or less went unaffected, and they are the same as they were, like more or less in the same range as they were maybe 3 months back, or maybe say before war. So we can talk of before war and after war. Gas oil, yes, it jumped. Now it is getting somewhat subsided, but not totally where they were before the war. But gas oil, but the gasoline MS is more or less intact.
Right. I understand that qualitatively, sir, but if you could give us some numbers on that. What would the number of those cracks be? What levels are they at?
Around $7 to $8 for gasoline, and around $12, $13 for gas oil.
Okay. Sir, everyone's been talking about the new green energy push. What kind of capex from Indian Oil will go into green energy?
Capex, it is a long-term strategy that we have. We have a very laid out strategic plan going forward up to 2046, wherein we have an ambition of becoming net zero in our scope 1 and scope 2 emissions. And this plan of next 20 years, it has a layout of at least 3 lakh crores total investments. This 3 lakh crores investment is spread out over the next 15-20 years, which will go into the green energy initiatives. But at the same time, I would like to mention that all these investments that we are going to place in action in next 15-20 years will be based on the returns, because we see green energy, or we see the drive towards net zero as an initiative for increasing the profitability. It is not that we are just going to spend money. We are not going to spend money without the returns, because when we go for renewables, it gives me good returns. We expect to give good returns. Then we are going for green hydrogen. We expect that ecosystem will be developed, and then we will earn money out of it. Similarly, when we go into biogas or bioethanol or those things, we invest money into it with solid returns expectation.
Well, sir, you have a lot of expansions coming up, all across the country. Panipat, you have in Gujarat as well. Where do you expect, the one to come through as well, the Baruni? If you could give us some details with regard to your expansions.
My expansions are going to come on stream mostly towards the end of this financial year. Maybe December 25 or by March 26. Most of them will be in very advanced stages of commissioning during this time period. That is one point taken care, and that will increase my refining capacities by around 20%, where I stand at around 80 million tons, along with my subsidiary, that is CPCL. That will go to almost 100 million tons per annum capacity. So that is one thing. The other thing that you about the battery, in battery, we are, first of all, we are in the value chain wherein it comes for EV charging stations. So we have, at least Indian Oil has around 14,000 EV charging stations spread all across the length and breadth of the country. That is one part of it. The second part is we are into battery swapping business. The battery swapping business, it comes in a JV with Sun Mobility. It is by the name of Indofast, and this in 3 or 4 geographies in India, around 1,000 battery swapping stations are already operational, and they are doing good business. They are. This is the play where we want to focus more at this point of time. Battery manufacturing, we are in talks with people. We are in talks for technology transfer with people. If that happens, we might go into the battery manufacturing area also.
Sani, you know, the one standing issue that's been the LPG compensation with the government. Have you been in talks with the government for any sort of under recoveries that we saw in FY25 for LPG?
Yes, we are in very positive talks. We have been given to understand that a big portion of it might come to us, and we are pretty confident of amply and adequately compensated for whatever is due for us.
Could you give us a sense of what timeline could this be and what the quantum of this could be?
No, timelines I can't assure, and I can't assure about the quantum also, but I've been given that they are considering our demands, and they are very much aware that it is all linked with what capex I have to do, how I am growing in my businesses, how I have to invest more and more into greener solutions and sustainable energy sources. So the capex is needed to be done. So that criteria is there in everybody's decision-making matrix.
All right, so one final question before we let you go. Give us an update on the refinery with CPCL, the Nagapattinam refinery. Will that also come up and give you that 100 million metric ton target that you have spoken about in the past?
The Nagapattinam refinery is, we have gone back on the drawing board because the viability of that refinery was not becoming very good. So now we have gone back on the drawing board and we are putting into more and more petrochemicals into it. So it might change the financial outlay, but it will be more of a petrochemical plant now going forward instead of a pure refinery play. So we are reconsidering our configuration, and again we will go back to our board for taking approval for that and then move forward.
All right, in that case, that will be an important one to track going forward when it comes to Nagapattinam. But more importantly, we'll watch out for, your cracks as well as margins going forward, along with volumes. And if at all there is any sort of recoveries coming in from the LPG under recoveries from the government, at what time, what quantum. Thank you so much, sir, for joining in and giving us your view on the company and the industry going forward. With that, we'll take a short break. But just before we do that, pull up the intraday chart of Alembic Pharma. It's been a big move out there, up around 10%. In fact, it's currently the top gainer in the broader markets with decent volumes as well. So we'll keep an eye out on why that one's moving. And the other one is Kalyan Jewellers. Remember on Friday, we did have Gautam Dugar join in from, Motilal Oswal did say that if gold prices stay stable, then it would benefit some of these jewellers in terms of demand over the next few years if gold stays stable for the next couple of years as well. And Kalyan Jewellers along with Titan stands to benefit. With that, we'll take a short break. On the other side, markets, the investment scenario with William Sells of HSBC joining in to talk about that and the global trade uncertainty.
Welcome back. Well, markets a little bit lower, par for the course after the kind of rally that we have seen, but a few stocks are doing a thing of their own. Jio Financial, that's moved to the high point of the day, and that's really been the big mover in the last couple of months. Reliance has done well, and Jio Financial, the share price derives much of its value from the holding that they have in Reliance Industries. Just take a look at that stock. Jio Financial last few months has outperformed what Reliance as well has done. But let's get in William Sales, Global Chief Investment Officer at HSBC Private Bank, and Premier Wealth, who joins us. Hi, William. Good morning. Thanks a lot for joining in. Well, what a first half of the calendar year it's been, right? We're drawing it, we'll be closing it down today. But you've had tariffs, you've had Trump, as well as you've had geopolitical issues. First, let's focus on Trump. Do you think we have experienced peak Trump in the first 6 months of the year? And in that sense, would it be good for US equity markets for the remainder of this year? Because there was some kind of uncertainty, but do you think US markets are now favorably placed for the second half?
Yes, we think so. We are overweight on US equities because of a number of factors. Firstly, when I talk to clients, and I'm just at the end of a 1-month roadshow here across Asia, and talking to you from Bengaluru, most clients are no longer for a recession nor stagflation, and that's obviously very good news. We ourselves are looking for 1.8% GDP growth in the US and 11% earnings growth in the US, so that's certainly a positive. I think with regard to the unpredictability of policy, what people have also realized is that we actually have two-way risks rather than only just one-way negative kind of risks. We've seen policy sometimes being adjusted when there was too much pressure from the markets or from business leaders, and clearly that's positively interpreted. So that basically explains why the market has rebounded, and we think it can continue to rally.
All right, so we have experienced peak Trump then in the first in the first half of the year, and the very fact that when the markets get a little bit jittery, he steps in. So that should be good times, right?
So yes, I do think that we have that positive momentum here going now, and it also illustrates basically that it is very dangerous to try to time the market. Staying in the market, so what we call time in the market, is important because obviously, as we all know, as Einstein said, compounding is the 8th wonder of the world. To try to be in diversified portfolios, but of course building resilience, because we are going to continue to have policy uncertainty, lots of things hitting us, and that certainly will continue over the next 4 years, in my view. So therefore, staying in the market, but building resilient portfolios.
All right. I was curious to know about your traffic experience in Bengaluru, because the weather is great. They say that once you enter Bengaluru, first the weather hits you and then the traffic. I hope you did not experience that. Having said that, what about emerging markets? I see you being positive on China, Singapore, as well as India. In that, what would your pecking order be? And how much of an outperformance do you think some of these indices could do versus, say, the global markets, the developed markets, that is?
It's not to try to be diplomatic, but indeed we are overweight both on China and India, and then also on Singapore. But they are very different types of markets. Obviously, valuations between India and China are very different, but the ROE is very different as well. Indian companies tend to have very high ROE. The Chinese are working on this and also working on distributing more, dividends, being more shareholder friendly, and so on. In China, it is not the entire market that one can buy, I think. It is really, when we talk to our clients and to institutional investors, it's really the technology side that gets the attention, that people are positive about, and you can see, great progress there as well. But still, the domestic demand is still, a factor that needs to be improved on. We are expecting that the Chinese government will deliver more stimulus, but they don't want to do a big bang approach. They don't want to react to every single headline out of the US. They do it in a much more structural fashion. You started to see some improvement in that domestic demand, but clearly the deflationary spiral is still, is still a negative. So you don't see that in India. So when you buy China, I think it needs to be the technology sector, and it needs to be those dividend payers, whereas in India we like the industrial side, we like the healthcare side, we like the financials as well.
Interesting point out there. But what about the Indian economy? Things seem to be moving in our favor. We have the Reserve Bank of India that's given us that growth booster shot. We have this currency that's fairly stable. And in fact, earnings are likely to pick up in this year as well. With that sort of a backdrop, do you think Indian equities can continue to do well from here on?
I do agree, yeah. So we expect 6.7% GDP growth this year, 6.2% next year. Basically, mostly driven by the consumer, who sees that falling inflation, indeed, that you're pointing out, in part because of the oil prices, the food prices, and so on. Obviously, it's helped by the rate cuts as well. We expect one further, interest rate cut. I've mentioned the sectors that we like. In terms of style, we would very much stick to the large cap companies because you see that the relative valuations are in favor of the large cap. The small cap have rallied potentially a little bit too much from a relative perspective, and the foreigners are going to stick with the large caps.
So you prefer large caps versus mid caps, and in terms of the sectors you liked, you said healthcare. I just missed the industrials, and what else?
And the financials as well.
All right.
In part to get that income as well.
What about the European markets and UK? You've made some changes to your portfolio there as well. So if one had to say make a global portfolio of $100, how would you spread that across US, Europe and emerging markets, and how much of that would come to India?
Yeah, so I know about the constraints, obviously, that Indian investors sometimes have, having a really globalized portfolio. But if you were to, be able to diversify, obviously, we always recommend that people do that. A lot of our clients have businesses, have lots of stakes here in India or in their home country. And we always try to have them diversify as much as possible because you don't want to double up on the country risk. So, try to diversify globally where that is possible. For the moment, in addition to the countries that I mentioned, India, China and Singapore, that we're overweight in Asia, we're also overweight in the US, which is, I think, an out of consensus call. More people try to go into Europe, but Europe has rallied already. The proof will be in the pudding as to how much of that fiscal spending and how much of the structural reforms, even more importantly, they will be able to do in Europe. I think in the US, people have relatively low growth expectations, relatively low earnings expectations. The positioning and the sentiment is relatively weak. So I think the earnings season in the US can be a trigger for companies to do better than expectations and therefore, to support a rally there. So an overweight for us in the US as well.
All right, an overweight on US as well as India, China, as well as Singapore. So that's the view coming in. Thank you so much, William, for joining in and giving us your call on the global equities and doubling down on your preference towards India in the emerging market space as well. As we slip into that short break, just keep an eye out on Siemens. That stock's moved to the high point of trade. A couple of these banks doing well as well. Bank of Baroda for one, and we have Federal Bank, which has spiked as well. And then we do have, Hindustan Copper, which too has moved to the high point of trade. We take a short break, come back on the other side. All right, before we take that short break, we do have PTC Industries, the stock on our radar after its wholly owned subsidiary, Aeroloy, has signed a memorandum of understanding with Safran Aircraft to co-develop aircraft engine components. To talk about this and more, we do have Sachin Agarwal, who's the chairman and managing director of the company, who joins in. Sachin, first up, if you could give us a scope of revenue generation via this MOU. What does this mean? Because you had told post your fourth quarter results that you already have an order coming in from Safran for a few, few aircraft. What does this deal mean in terms of, in addition to what was your deal with Safran earlier? What is the revenue scope here?
Good morning, Mangalam. No, this is a bit different. The previous MOU and long-term agreement that we had signed with Safran Aircraft Engines was related to civil aviation, commercial aviation for LEAP engines. This is specifically related to military engines. So here the scope is quite wide. It's related to all titanium and superalloy and all critical material component manufacturing, as well as material supplies in various forms, right from billets, bars, sheets, plates. So it has a very, very wide scope and has huge implications for India in terms of Make in India, as well as the indigenous content requirements for the new policy that's coming in place.
What's the value of this? What's the potential value of this deal?
Well, that's a bit difficult to put in right now in terms of value of the deal, because it's right now in the form of an MOU, which will not translate like in the previous MOU that we signed with Safran. The MOU was then later translated into a long-term agreement and contracts. So that stage will come probably in a year or so from now. So then it will be a better point to give some value on this. But it has a huge potential, and it gels in with all the investments that we are currently doing in all these fields.
All right, Sachin, hi, good morning. Good to see you in. Thanks a lot for joining in. This is Nigel on this side. So you've given us few details with regard to this is military focused. The MOU is both for materials as well as for casting. And also you mentioned, I think it's going to be a mix of titanium as well as super alloy. Do we have any broad sense about which way it will be tilting towards? And what is the realization difference between the two, super alloy as well as titanium?
So normally in an engine, the weights is about split 50-50 between titanium and superalloys. In components, the valuation for superalloy is about in the region of almost, it ranges from almost like $400-500 a kilo to almost $2,000 a kilo, or even going up to even $10,000 a kilo. So it has a huge range depending on the component. And similarly in titanium, it again in components it goes from almost $500 to about $2,000. In material supplies, it's also similar that in titanium we're talking about somewhere between $40 to $40 per kilo, all the way up to almost $200 per kilo, and on a similar range on the superalloys materials as well. So they're very similar.
Right. You know, this is one of the businesses that you've signed an MOU for. What about your other order book right now? I mean, where does that stand at? What is the visibility that you have? On this one, you said you'll probably get visibility, say, a year from now when it comes to value. As of now, with the orders that you have on hand, what kind of visibility do you have in terms of revenue for the next, this year and the next year?
So we currently have a reasonable amount of orders. We almost booked for, I think we in the region of close to almost having orders in the region of approximately 700 to 800 crores already in. We also expect that this financial year will be almost close to doubling our revenue from the previous financial year. So there is a very good visibility available in that sense. And then again, quite a significant increase the following year as well. So in terms of order book, we are very well placed. We have a substantial amount of capacities that are getting created, which will be unleashed in the financial year of 27. So again, then there will be quite a bit of increase after that as well.
All right. So for this year, we're looking at nearly, I think the last time around we'd spoken about this. This year you should end with in the vicinity of around 750 crores. That's correct, right? In terms of revenues?
Well, close to 700. I said almost double. So from the current financial.
750 crores should be a fair estimate. And margins in mid-20s?
Mid to high 20s.
Mid to high 20s. All right. But the bigger year, as you mentioned last time around, is with capacities coming on stream and with the order book, picking up pace. FY27 appears like the bigger year. So this year you double your revenues, and on that base you more than double your revenues, right? FY27 you should be looking in the vicinity of around 1,700 crores or thereabouts.
No, I think the primary unleashing will happen in the financial year 27-28. Rather than 26-27, the reason being that a lot of qualification work that needs to be done on the new plant. So the plant will be up and running in about a year and a half from now, but the qualification work will start after that. So that will consume the next financial year to a certain extent. But but still from the domestic sources there will be still quite a bit of an increase.
Sachin, the rate at which your order book is growing, your revenue projections are, and at the same time you have been increasing capacities in titanium. We see that some plasma arc furnace, etc., going under trial production, etc., too. That has put a stretch on your working capital and your balance sheet, because I'm looking at cash flow from operations, and that has been negative for the last many years for a company like yours. So we're just trying to figure out, at what point do you turn CFO positive, and what is your working capital outlook, working capital days?
So I think the working capital, I don't know which data you're looking at, but I think we have remained quite reasonably sustained on our operations. So there are two parts of our fund flow. One is related to the funding of the new plant, which is primarily going into investment in the new plant, which is in the tune of almost 800 to 900 crores currently ongoing. But on the operations side, we have remained reasonably well cash surplus, and which is also further getting funded or contributing to the investments that we are making. So the margins in this business, once the new capacities are released, are quite significant, especially in castings and the component business, where the margins, EBITDA margins, exceed 40-50%, especially also on a material side, where it's in excess of 30%. So with those levels of margins, I believe that there is no reason that we will be at any point cash starved in coming years.
All right, Sachin, just want to understand your working capital days. I think the goal is to get to hold it around 100 days. Is that correct?
That's correct.
That's the number you like to maintain. All right. Yeah. And since you have bulk of your expansion that will be coming in FY 26-27 onwards, for FY 29, what kind of a revenue number could you give? What is the aspiration? And since margins will improve from year on, how do you see the number, pan out from there as well? So let's focus on FY 29, since you'll have the capacities fully on stream and you have visibility. Please go ahead.
So 29-30, we are looking at reasonably in excess of 2,500 crores of top line.
Okay.
Probably touching somewhere around 3,000 even in 29-30. So in terms of margin, I think we'd be easily sitting above 30% positively. So quite a reasonably high margin, as well as very massive growth coming.
So roughly 750 to 900 crore EBITDA is what you could potentially do by FY 29 is what you're saying, right?
Yeah, almost close to 1,000, yeah.
Yeah, it'll be interesting because
29-30, I said, so not.
Okay, as of now, your market cap is 22,500 crores. So clearly the street is looking ahead and saying that you're going to deliver blockbuster numbers. We'll hold you at this aspiration. Thanks a lot for joining in and giving us some color. Maybe the next time around, you'll be able to quantify this potential that you have from this MOU. Appreciate you speaking to us here on CNBC.
Just before we let you go, would you have a target on return on equity and return on capital employed? Because you are investing so much, these two ratios would be, pressured in the very near term.
But I think the numbers, as I said, 29-30, the numbers already kind of tell you what the kind of returns can be made. We are currently making investments in the region of 800 to 900 crores with potential EBITDA margins of in excess of 800, 900 crores incoming in the next few years. So that would give a very, very high ROE and ROC as well. Besides the agreement that we have just recently signed with Safran.
On ROE and ROCE?
Sorry?
Do you have a target on ROCE and ROE?
No, I don't have a target, but I do see a very high return.
Got that. Take your point.
And besides this agreement that we signed, in the next few months, we are signing many more agreements to come in the next 6 months. So which will keep you informed on that.
All right, take that point. Thank you so much for joining in and giving us your outlook on the business. With that, we'll take a short break, come back on the other side. Manisha Gupta joins in with focus on all things commodities. Welcome back. Let's get trades at 10. We have LIC, which is doing well, RBL Bank higher as well, and we are seeing some traction in all the PSU banks this morning so far, even as the frontline indices are slightly contained. Mitesh Thakkar joins in. Mitesh, what would your trade at 10 be?
In fact, Mangalam, I have LIC as a recommendation with a stop at 964 and a target of 1010. And the other one is State Bank of India. It's looking good as well. Buy here with a stop at about 805 and a target of around 840.
All right, LIC and PSU Bank. You have SBI as well as LIC as your pick. Thanks a lot for joining in. With that, let's shift focus to the commodity space. Manisha, what's the one commodity that you're tracking today?
Well, I actually want to take a look at all the commodities for the month of June because it has been quite an interesting month. But yes, I'll put in focus crude oil prices first because this clearly has been the most volatile of all. And it is trading nearly a percentage point lower in the Asian markets right now after nearly 13% of a decline in the previous week for the crude oil prices. Well, a 13% decline has been the sharpest weekly decline that you've seen in 2 years coming for the crude oil prices. One, it is about the Iran-Israel war, as fragile that ceasefire is, but it seems to be holding, and that's taken the premium off the markets. The second thing is that you have to really look at the volume, or rather the volatility that we've seen in crude oil prices. The 12-day Israel-Iran war had the crude oil prices surging all the way up to $80 a barrel, and then we saw correction come down to $67 a barrel, and that's exactly where we seem to be trading at this point in time. The other thing that the street will watch out for is the OPEC Plus meeting. Well, that's on 6th of July, where they decide on what is going to be the production for the month of August now. The expectation is that they will increase it by 411,000 barrels per day, and they have been actually doing this for the month of May and June and July, and could be happening for August as well. This actually would be a fifth monthly increase in production that OPEC could be doing, and that's yet another reason that you have seen prices talk about a supply surplus of almost 1 million barrels per day in this year, and that's weighing onto the markets too. A couple of things which actually could be supportive is one, the China-Iran crude imports, which hit a record high for the month of June, could see more gains coming in the future months as well. The second point is about the US oil and rig count, which also has seen a decline by a fifth straight month this time around. And with that, the actual count of US oil and rig now stands at the lowest since October 2021. So barring these two factors, everything else seems slightly bearish for the crude oil prices from where we stand. But I do want to take you through on what we've done in month of June for many of these commodities. And I'll start with energy, where we are looking at a second monthly gain for the crude oil prices, up by 5%. Natural gas has been the only one that has seen a decline. Otherwise, heating oil, gasoline prices actually have seen gains for the month of June there. Take a look at the precious metal prices there, and here you see a sea of green. Barring gold, where we haven't seen any safe haven buying, the money actually came out of gold and went to various other metals. So silver is gained up by 4% for the month of June, but the actual outperformance comes in from platinum and palladium, 14% up for palladium, 28% of gains coming in for platinum as well. And my final plate will show you the base metal prices, where we have seen the outperformance come in from copper, 4.5% of gains in the month of June. We've seen stronger gains from aluminum at 5%. Actually, metals have seen a good month for the month of June. Barring steel, which also seems to be easing its losses there, we've seen a stronger month there. And the markets do believe that base metals perhaps is the way to get into for the month of July as well, with slightly longish positions there.
All right, base metals is the way to go. Thank you, Manisha, for that. All things commodities. With that, we'll take a short break. On the other side, our special segment, Economy Unpacked. Lata will be in conversation with a battery of people. There will be Samiran Chakrabarti of Citi India, Neeraj Gambhir of Axis Bank, Srinivasan Varadarajan, who's a banking veteran, and a market expert on how the bond markets must read the RBI's puzzling moves.
Economy Unpacked is a new series from us to understand difficult questions about the economy. In this first edition, we are trying to answer some key confusions on interest rates emanating from Reserve Bank's actions. Confusion number one, Reserve Bank cut interest rates by 50 basis points on June 6th, but said it was moving stance to neutral from accommodative. Bond yields, which should have fallen after the massive rate cut, actually ended up rising because market concluded no more rate cuts. However, the 2.8% May inflation has rekindled hopes of another rate cut. Now, confusion number two. Will Reserve Bank keep liquidity just enough so that the overnight call rate comes towards the repo rate of 5.5%? Or will call rate remain at 5.25%? Now, immediately after the policy, yields rose and then they fell below 5.25%. In fact, they went to 5% mark because governor said that rate cut transmission is still in early stages. So market concluded liquidity will remain surplus. But last week on June 24th, Reserve Bank announced a massive 7-day VRRR, variable rate reverse repo of 1 trillion rupees, which means Reserve Bank is absorbing 1 trillion of liquidity. So yields rose. Market is still confused if Reserve Bank will continue to do VRRs and hence absorb liquidity, push up the call rate to 5.5%, or will it do VRRR only when liquidity gets too plentiful? Now, for all these questions, I'm joined by an elite panel of experts: Samiran Chakrabarti, Chief Economist, Citi India; Neeraj Gambhir, Group Executive and Head Treasury Markets and Wholesale Banking at Axis Bank; Srinivasan Varadarajan, Banking Veteran and Market Expert. Before I shoot my first question, for those of you who are equity expert viewers, just 2 or 3 terms. One, when we say VRRR, variable rate reverse repo, the RBI is pulling money out of the system for a temporary period. Overnight call rate is the market where banks borrow from one another for 1 day, and the TREPS market is where mutual funds, insurance companies, banks, all of them borrow from one another for 1 day. We will use these jargon, but let me get to the expert. First, Neeraj, what did you make of this VRRR? Are you getting a feeling that Reserve Bank is now going to bring the call rate to 5.5%?
I think that looks like to be the case. To me, it feels like that after announcing the change in stance to neutral from accommodative, Reserve Bank is not very comfortable with call money rates trading significantly below the repo rate. And I think this introduction of the 7-day VRRR, and market is sensing that there could potentially be an extension to overnight VRRRs, which means basically RBI taking out money from the system at repo rate will basically fix the floor of rates at repo rate. It was about 25 basis points lower. Now it's going to be closer to the repo rate. What this basically means is that if the overnight gets fixed at repo rate, which is 5.5%, all the other rates in the money market, whether it's T-bill yields or whether it is CP/CD rates, will get indexed to this rate. And therefore, in some senses, there is going to be a little bit of upward bias towards these money market rates as a result of this action. We will.
Yeah, go ahead.
No, I'm just saying that this is something which is a bit of a change in their operating procedure of monetary policy post the recent MPC meeting. And I think it is more of an alignment of their operating procedures and operations in line with the change in the stance from accommodative to neutral.
Now, I'll tell you, the governor was very clear, not this policy, but in previous policies, that when they change the stance, they are not referring to liquidity. They are referring to their view of repo rate. I remember them, I'm not quoting verbatim, but I remember them saying that. But Samiran, what are your thoughts? Is it not possible that the RBI and the governor were alarmed that call rate went even below 5.25%? And I think at one point there was one trade even below 5%. And TREPS market, there the rates went really towards 5% and below 5%. So they're only correcting this distortion, but they don't want the call rate to come from 5.25% to 5.5%. Is that one way of looking at it?
So, I will agree with Neeraj on this, that it appears that this is in sync with the RBI's change of monetary policy stance from accommodative to neutral. Till the monetary policy stance was accommodative, RBI was allowing the overnight rates to be closer to the reverse repo rate rather than the repo rate. Now, since the stance has changed, the sanctity of the monetary policy framework needs to be preserved, because as of now, in the inflation targeting framework, the operating procedure of monetary policy is to keep the weighted average call rate close to the repo rate under usual circumstances. So because the market is right now, in my view, in a pretty much normal situation, for RBI to have this sort of a abnormal thing of having the overnight rate much lower than the repo rate probably wouldn't have made sense. But at the same time, I don't think it has any signal for future rate action. They can still go in for rate cuts in the future, and through that bring down the overnight rate. That's probably a cleaner way of doing this rather than having this sort of stealth method of a rate cut.
Okay, Srini, I just want to present to you, and you would have heard this, of course, what the governor said in the Business Standard interview. He said, keeping liquidity surplus helps rate cut transmission. RBI will continue to weigh the trade-off between keeping call rate at SDF rate for better transmission or at repo as the framework requires. Broadly, those were his words. You would know much better about transmission. Has transmission really taken off? If the governor and the RBI want transmission, will they push up the yield from 5/4 to 5.5?
Transmission. Is transmission something to do with lending rates, or transmission something to do with the deposit rates? And clearly, I think, and the way I look at how the policy and the rate cuts have sort of happened over the last few months, it looks like, I think, the RBI would like immediate transmission or transmission to happen as quickly as possible. And that they are trying to do it through rate cuts, because the EBLR immediately sort of resets. And I think that is forcing the transmission on the lending side to make sure that if there is a facilitative environment which can be created for credit growth and therefore trigger some amount of activity in the economy, let us facilitate that. So that to some extent is one aspect of transmission, because the fact that transmission through cost of deposits coming down is a process which is taking longer. And in my view, the way the market structure is today, that is unlikely to happen, because there are always going to be banks which are going to be borrowing at high rates. And what CDs and bulk deposits coming down is not reflective of the liability profile of banks, because these are the two products which the regulator doesn't want banks to rely on. They want banks to rely on our retail term deposits and CASA. That to some extent is not changing much with any of the rate cuts, and it's only liquidity to some extent which is sort of impacting that. So I think there is a basic issue is what is the policy rate seeking to achieve? Is it seeking to achieve lower lending rates, which is what I think RBI has now come down to, saying that, okay, if I cut rates, I will push the EBLR lower, and then the banks will have to then manage their own liquidity and profitability. And then that's why we've seen banks sort of look at savings rate to immediately reduce their cost of funds. So to me, it looks like we have to relook at what the policy rate is supposed to do. Because if the repo rate right now impacts only T-bills and to some extent GSEC, and long-term GSEC also, it is getting slow. The cost of funds of banks and the policy rate, I think are right now, the sensitivity is becoming lower and lower. I think low in repo.
1 minute, Srini, 1 minute. In the past, RBI has told me and bankers have told me that, when there is plentiful liquidity, you're actually putting money in SDF, we are bolder to reduce deposit rates. When we are kind of depending on the call rate to borrow, at that time, we are not in a mood to reduce deposit rates. So the Reserve Bank does make a connect that lending rates, of course, are linked to EBLR. Once repo rate is cut, many lending rates are cut. But deposit rates fall. As you say, many banks are hamstrung. And the Reserve Bank's psyche, at least in the past, I didn't speak to this governor, in the past is bankers are in a better mood to cut deposit rates when there is plentiful liquidity. Do you buy that? And if you buy that, that means they will be keeping liquidity plentiful?
you would have to look at the average cost of retail term deposits for this quarter and the coming quarters. I would suspect that it is going to be not more than 50% of the extent of rate cuts. And I think that is primarily because there are high rate borrowing banks which will continue to do at those rates. They are not getting rates lower. Only the banks which have, to some extent, a large depositor base and which have clearly sticky customers are in a position to do it. So therefore, if you look at the system level retail term deposits, I don't think so the transmission is going to be so easy because the power equations of different banks are different. And I think the consolidation of market shares among different banks is happening at such a pace that I think the people who are left out are never going to be able to lower their deposit rates.
So your short point is he will bring the VRR to the call rate to repo rate?
Now, basically what I'm saying is RBI is forcing banks to lower their lending rates through the repo rate cut by the EBLR mechanism.
Okay.
And then it's up to the banks to manage a liquidity profile in terms of what they want to lower, how they want to lower, and try and manage their NIMs, margins, and profitability.
All right. Okay. Neeraj, what is your sense about, therefore, another rate cut if the RBI is already bringing the call rate to the repo rate? Then does that reduce are they giving an indication that there isn't scope for rate cut?
So before I come to another rate cut, let me just respond to this question of transmission. In my opinion, and it's a little different from what Srini said, this quarter and this cycle of rate cuts, we've seen one of the fastest transmissions on the liability side that I've ever seen in the banking system. We've already seen large banks cut their savings bank rate by approximately more than 50 basis points. We've seen a significant reduction in term deposit rates for retail. I'm not talking about the bulk or the CD rates. I think bulk and CD rates have actually come down by almost 130 basis points since their high in the March. So I would, I'm basically, my conclusion is that given the change in the structure of banks' balance sheets since 2019, where more than 50% of assets are now linked to EBLR, banks are being forced to relook at their liability pricing far more proactively and far more quickly than I have seen in the past. And obviously, Reserve Bank's massive liquidity injection that they have done over the last 4 months or 5 months has actually helped in the process. I think the fact that Reserve Bank kept the call money rate close to STF rate or lower end of the corridor has actually helped banks do significant repricing. Now, it's the structure of the balance sheet that the liabilities reprice at a slower pace as compared to the asset. The asset repricing is almost instantaneous. It happens within a quarter. The liabilities take time to reprice from a stock perspective. But from an incremental perspective, I think banks have taken a lot of action in terms of bringing down their retail deposit rates. Obviously, I'm talking about large banks, not the entire banking system.
Okay.
As far as the future rate cuts are concerned, I don't think that this action of normalizing the call rate to repo rate is any indication of what Reserve Bank may end up in the future. I think the door is still open for further rate cuts, provided we see inflation continuing to come down and there is some weakness in the growth. But I think the bar is a little bit higher in my opinion.
Samiran, I have to take a break, but I want a quick reply. Do you think if you're in the Reserve Bank's shoes, you will be satisfied with this level of transmission? I mean, credit growth is really abysmal.
So there is a bank lending channel of transmission and there is a bond market channel of transmission. The governor in his interview has clearly mentioned that both are equally important. I think definitely the bank lending channel is working fine. Whether the bond market channel is working fine or not, how much patience RBI can show on that, that's something that we have to see.
Okay, fair enough. I have to take a quick break, but I'm going to ask now even for the CRR views and how the Reserve Bank will approach it in the future, as well on rate cut transmission. The entire conversation is going into CNBC Access. So viewers, you can catch the full conversation of Economy Unpacked post-market hours on CNBC Access. After a break, Chartbusters for you.
Well, the markets start the trading week on a cautious note with a tinge of volatility. The financials lead the gains while realty and auto drag. Broader markets outperform in trade today.
JB Chemicals down over 6% after Torrent Pharma acquires controlling stake in the company. The transaction will be executed in 2 phases with a total purchase of up to 19,480 crore for the 46.4% stake.
Shares of Karnataka Bank fall as much as 7% after the lender's managing director and CEO, Mr. Sarma, along with executive director, Mr. Rao, both quit, citing personal reasons.
Shares of Hero MotoCorp trade lower after reports of the government issuing a draft notification for anti-lock braking systems become mandatory for two-wheelers in the L2 category.
Well, hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Manglam. And the markets, well, cooling off a little bit. That's just the headline index. The good news is the mid-cap index continues to trade in the green. And there are a lot of stocks doing a jig of their own. Hey, Manglam.
Hi, Nigel. A lot of stocks doing a jig of their own. And the key in that are all these PSU banks. So, you know, at a time when the Nifty bank is just about 100 points lower, pull up the intraday chart of the PSU banks and you'll see a big up move out there. Leading it from the front is State Bank of India, up around, 1.5%, a little more than that. And you do have all the others as well. Union Bank, Indian Bank, we have Punjab National Bank, all of them higher in today's trading session so far. So that's one sector which is really standing out in terms of gains. The other one is the pharmaceutical pack, where we are seeing some traction build up in names like Laurus Labs, which is up and above in today's trading session, Alembic Pharma. The only couple of pharma stocks which are lower belong to the ones that were participating in the Torrent and JB Chemical deal. So Torrent actually on hopes of or on worries of near-term EPS dilution mildly lower, and we have JB Chemicals as well as pharma lower on account of the deal being done at a discount. No worries for the market by and large. Shivangi Sada joins in for a quick technical check on the market. Shivangi, we've put on decent gains all of last week. Do you think this dip is an opportunity to buy, or maybe you'll wait for a further dip?
Hey, good morning, Manglam and Nigel. Thank you for having me. So we've seen that, of course, there has been quite a comeback of the bulls last week. And the way we closed at the higher zones indicates that, somewhere support-based buying is quite strong. Today, of course, we've again had a little bit of a soft opening, but overall lower levels are being respected, which is quite crucial at the moment to watch out for. India VIX is at lower zones and it is still showing signs of comfort, along with Nifty put call ratio, which is above 1 comfortably. So overall, we are recommending buy on decline to continue with some sort of consolidation. Of course, we've moved 850 points almost in the last 1 week. So overall, some sort of pause is healthy over here. We're looking at 25,750 marks next for the index, and with a support of 25,350 zones. So this will be the take on Nifty. Talking about Bank Nifty, of course, there's a clear outperformance here in this index today. We've seen that smaller banking names are driving this momentum today. At the higher levels, we are still holding above 57,000, which is a plus. So till the time it holds above 57K, we are expecting 58,000 levels here with a crucial, support of 57,000 to watch out for.
Okay, got it. All right. Hi, Shivangi. Good morning. Good to see you in. Give us your take on individual stocks.
The individual stocks on my radar, first up is Canara Bank. We've seen that good rollovers in the banking and the NBFCs for that matter. Stocks, and Canara Bank is of course one of them which has witnessed slow and steady up move in the last 2 weeks. We've seen that even on a month-on-month basis, this stock has been moving in a higher top, higher bottom formation from the last 4 months. So overall strength continuing here with a good short covering move following good open interest activity here as well. So we're recommending a buy here. The next targets for Canara Bank is around about 118 with a support of 111 zones. And the second pick on my radar is Indigo. We've seen that, of course, sentiments are back in action here. And from the last 2 sessions, we're seeing price and volume action quite significantly here.
There was a good amount of long build-up in the June series and a good positive start in the July one as well. And even on the monthly basis, the stock has been upward, trading in an upward sloping channel. So, of course, any small declines have been utilized for buying. And we are looking at next targets of around about 6,200 over here for Indigo with the support of 5830 levels.
All right, we take that point as we speak. The broader markets have seemed to move further higher, in the last 15 minutes or so. SRF is one of the stocks which too has recovered from the lows, currently at the high point of trade. And we are seeing similar traction build in names like HDFC, AMC as well, who was largely flattish for most part of today's trading session and now has seen a spike similar to what we've seen in SRF. So watch out for all these stocks as well. But as we are seeing the broader markets move, let's get you some ideas of profit coming in from our colleagues at Money Control Pro. And today we have Lekha Badlani joining in with a stock that she's been tracking. Rekha.
Yes, so we like FIAM Industries, which is a leading auto ancillary specializing in comprehensive lighting solutions. Now, the company surpassed the two-wheeler industry's growth in FY25 by nearly 2x as it registered a 20% increase in sales. Now, this outperformance was driven by the growing adoption of the value-added LED lighting systems, which offer significant value addition and carry higher realizations. We believe that the consumer sentiment remains robust in the two-wheeler segment, supported by new model launches, rising disposable income, moderating inflation, decreasing interest rates, and expectation for good monsoon. Both urban and rural demand look well poised for a strong growth going ahead. Fueled by these catalysts, the management is confident of achieving around 15 to 20% top-line growth over the next 2 to 3 years. FIAM is also expanding into the passenger vehicle segment, securing orders from major players like Mercedes and Mahindra. Also, the low EV penetration in India presents a significant long-term opportunity. While a partnership with the EV company Gogoro is on hold, FIAM has secured contracts from top Indian EV manufacturers like Ola and Okinawa, positioning itself in the high-potential market. Additionally, FIAM's domestic focus protects it from the global risk and geopolitical tensions. Given a strong business outlook, the company's valuation of around 20 times FY27 estimated earnings makes it an attractive long-term investment.
Thanks a lot for that, Lekha. Well, time to slip into a short break. But as we do that, remember to tune in to the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders, economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, where the focus is on cryptos, currencies and commodities, and the Global Lens at 8:30 p.m.
पड़े।
Welcome back. You're watching us here on Chartbusters. A bunch of stocks, they're all buzzing around, and we have the entire team joining in to tell us about each of those stocks. We have Hormaz with us. We do have on the screen, as you can see, Vinny as well as Vamakshi, all of them telling you about stocks. And joining us on the phone line is Ritu Singh, no less. So we have the entire team here. Let's go across to Hormaz first. Hormaz, Uno Minda, that's the stock on our radar, right? A target of 1,304 rupees coming in from CLSA.
Long awaited, much bullish initiation from CLSA coming in on Uno Minda. Outperform recommendation, as you mentioned, a 1,304 rupee price target. And they're mentioning the fact that as a fast growing company, they have shown limited cyclicality in the auto ancillary space because they have a diversified product and customer base. They are also expecting their margins to improve courtesy of the fact that there is a revival in the industry overall. They're expecting the company to scale up going forward. Premiumization as a play comes into focus as well, and a better product mix that will contribute to this improving margins, and as a result of which they're expecting the company's earnings to almost double between FY25 to 28. And they are also seeing Uno Minda as a high growth compounding play with a lean balance sheet, and they are not modeling in any potential reinvestments of their cash flows as potential M&A activity, which they believe is an upside risk for the stock. So as a positive initiation coming in for Uno Minda. The stock not doing much though, although the stock has moved almost 10 to 12% in the last 1 month.
All right, Hormaz, thanks a lot for that. Well, let's move to the next stock then. Titagarh Rail Systems, that's buzzing in trade on the back of a big order win. Vinny, she's the one who's going to deal with this one. Vinny, take it away.
Hi, good morning. So yes, Titagarh Rail, a big order win coming in. 430 crores is the order win coming in. This is mainly for the Maharashtra Metro Rail Corporation. Now, obviously, the contract is going to be for supplies of 12 additional train sets. Execution period is almost 1.5 years. 30 months is what we could say highlight coming in as well. Now, obviously, do not forget, recently also there were a lot of clearances coming in for the railway front. So this is especially coming in after those clearances have come in Maharashtra for the railway side and railway project front. And obviously, this is mainly a Pune Metro Rail project that is coming in for Titagarh Rail, a big one over there, 430 crores. So keeping an eye on that.
430 crore order coming in for Titagarh Rail Systems. And let's talk about divergent moves in the banking space. We have Karnataka Bank, which is sharply lower in today's trading session. RBL Bank is higher. What is it that is causing these moves on these stocks? Well, we do have Vamakshi joining in. Vamakshi, Karnataka Bank, top leadership leaving.
Well, absolutely, Mangalam. You know, it bodes not so well for the company. When we look at Karnataka Bank, MD and CEO Sri Krishnan Harihari Sarma, as well as the Executive Director Sekhar Rao, both have tendered their resignation. Now, as far as Mr. Sarma is concerned, he has cited personal reasons, which also includes the decision to relocate back to Mumbai, while Mr. Rao too has submitted his resignation, citing inability to relocate to Bengaluru, as well as some other personal reasons. So, resignation coming in from the top leadership at Karnataka Bank, not boding well for the stock. The stock resultantly down and out in trade today. But on the flip side, when we look at RBL Bank, that is doing quite well. That is on the back of a note on that has come in from Citi. They've opened the 90-day positive catalyst watch. They have a buy rating on this counter, target price of 285. They say that they're expecting the return on assets trajectory to improve by 45 to 50 basis points. And this largely would be driven by normalization in terms of credit costs. They're expecting it to normalize to 2.2%. And the normalization would actually be led by subsidization of stress in joint liability group as well as credit cards in the first quarter. They're also expecting slippages to moderate to 4.5% as compared to 4.7% in the previous quarter. They believe that repricing of floating rate portfolio mix changes could lead to 28 to 30 basis points NIM pressure. The NIMs could bottom out in much sooner as compared to peers, and they're expecting industry average loan growth of 9%, deposit growth of almost 10% on a year-on-year basis.
Okay, all right. Thanks a lot for that, Vamakshi. Well, let's move on to the latest in JP Associates resolution. Sources say that 6 suitors submit bids, but only 5 have qualified. Ritu joins in to fill us in with all of those details. Well, Ritu, you ended last week with a big breaking news and starting off this one as well with a new one. Tell us more.
Well, Nigel, we have top corporates that have lined up, to throw their hat in the ring for JP Associates. And our sources indicate there are 6 suitors, as we have been reporting, that submitted binding bids for the company. But one of them, that is the Suraksha Group-led JP Infratech, did not qualify because they did not submit the EMD or the deposit money with the resolution professional. But the 5 that do remain in the fray are corporates like the Adani Group, very much on expected lines, the Vedanta Group, Dalmia Bharat, which Nigel, you remember, was also trying to earlier acquire the cement assets of the company, and the Naveen Jindal Group as well, which is Jindal Power. Apart from this, the 5th player is a listed infrastructure company, PNC Infratech, that is also in the fray. Now, while the exact quantum of bids is not known, keep in mind the National Asset Reconstruction Company had acquired these stress loans from the banks for about 12,000 crore rupees, and banks believe that could set a benchmark for the bidders. But some of the suitors that we've spoken to indicate the offers could be even lower than 12,000 crores. Keep in mind the total debt amount is more than 57,000 crores. So a steep haircut for the lenders here, but all eyes now, of course, on how the bidding war plays out, especially with these kind of high-profile names in the mix.
Take that point entirely, Ritu. Thank you so much for joining in, and we trust you to keep us up to speed with all the developments that take place out there as well. In fact, on that note, we'll thank everyone for joining in. There was Hormaz, Vamakshi, Vinny, and Ritu for telling us about all the stocks which were in the news. And in case you missed it, let's tell you there's some good news for all of you. It's India's business news leader, which is CNBC-TV18. Just a click away on the CNBC-TV18 app, which gives you access to in-depth articles, breaking news in the financial world, and all the updates coming in on the stock markets at your fingertips. Things that we just spoke about, similar to that, on the app. All you got to do is download it from either the Apple Store or the Google Play Store. If you can't find that, then that's the QR code for you. There, download it and you get the app.
Back, you're tuned into Chartbusters. As we've been mentioning earlier, the Nifty is a little bit lower, but broader markets are doing a thing of their own. And KPI Green is a stock that's suddenly come on the radar. It's moved up, a bit of a volume spike out there, and that one has moved to the high point of the day. So I think we should get that one up for you on the screen, up close to around 4% as we speak. But let's focus on the big deal. JB Chemicals and Pharma, that's a little bit lower after Torrent Pharma's acquisition news that came late last evening. Ekta joins us to run us through the news and give us a quick analysis as well. Ekta.
Well, yes, Torrent Pharma will be acquiring JB Chemicals from KKR in what would be a two-phase deal. So phase one would be acquiring 46.39% stake from KKR for around 11,917 crores. They may acquire up to 2.8% from employees at around 1,600 rupees per share, and the open offer for 26% at 1,639.18 rupees per share. So that would come up to around 6,842.8 crores in terms of a total open offer size. The total deal value could go up to around 19,480 odd crores. Now, the equity valuation of this deal is around 25,689 crores, which is a discount to the market cap. Closing market cap on Friday for JB Chemicals. The deal as a whole is 19 to 20 times FY27 EV to EBITDA. This compares to Torrent at around 23 times FY27 EV to EBITDA. Now, the phase two is JB Chemicals shareholders will receive around 51 Torrent shares for every 100 shares of JB Chemicals. The valuation and funding, the deal, remember, was at around an 11% discount to JB Chemicals' Friday closing price. The open offer also 8.9% discount to JB Chemicals' Friday closing price. The deal is likely to be funded via internal accruals, debt, as well as QIP. There's no clarity in terms of the combination of what they would be using in terms of funding of the deal. But Torrent, according to analysts, could take up debt as much as 10 to 12,500 crores. The total debt on a combined basis could go up as much as around 14,500 crores. Overall, the impact is positive for Torrent because it strengthens their domestic portfolio. They will become the fourth largest pharma company in India. Domestic sales will rise by around 35% based on FY25 numbers. They've gained key chronic brands such as Cilacar as well as Metrogyl, and they've entered the CDMO lozenges business as well. Torrent's past M&A record is all based on domestic pharmaceutical acquisitions. So Elder Pharma, Unichem and Curatio, and they have managed to integrate it successfully. So that is why the street is confident about this. IIFL says that minority shareholders should wait for Torrent shares post the merger. Synergies could lift the JB margins to around 34 to 35% in 3 to 4 years. Nomura says that the reported EPS may fall 30% due to interest and amortization, but the adjusted EPS could rise mid-single to low double digits. They have a neutral rating. DAM remains positive on Torrent. EPS likely to be dilutive in the near term, and 2 times EV to EBITDA leverage is not a stretch. The debt can be repaid according to them in the next 3 to 4 years.
Take that point, Ekta. Thanks a lot for that. So that's about Torrent Pharma and Torrent Group, fairly acquisitive over the last few years, as we've seen. But, the sector this morning has to be the auto space. We've seen a big jump in Force Motors. Endurance, the auto ancillary stock, is doing well as well. Hyundai Motors is the other one, which opened lower and from the lows has seen a rally of almost 4% and has moved to the high point of trade. But has the first half of this year belonged to the auto sector or not? Which sector has outperformed this year? We wrap up on the first 6 months of 2025, how the benchmarks have been, how the broader markets fared, what stocks have been big movers on either the up or the downside. We have Hormaz joining in with that. Hormaz, take it away.
We're fair to say that we have seen it all this year. Tariffs, wars, ceasefires and everything possible. And it's been that kind of moves in the markets as well. The first quarter was making a bottom and then recovering, and the second half has been building on that recovery. And take a look at the Nifty here, 8.5% higher so far this year, and that is after an 18% recovery that you have seen from the lows. The recovery from the broader markets is a lot more pronounced, and it is a result of this recovery that they have finally turned positive on a year-to-date basis as well. Now, which are the stocks that have done well on the Nifty this time around in the first 6 months of the year? No prices for guessing. BEL is one of them, 41% higher. The first half of the year has belonged to the life insurance companies here. SBI Life, HDFC Life, both of them seeing returns of around 30% each. Among the underperformers, you'll find a lot of IT names, TCS, Infosys, Wipro, all of them making their list here. And Trent, after the recovery, is also down 16% so far, and IndusInd Bank too makes a mention. The broader markets, as we've seen, there has been a recovery, but the stock-specific action has been been a lot more pronounced. Look at solar industries, the talk of the town in the first half of the year. Look at BSC, Bharat Dynamics, L&T Finance is up 50% in the first 6 months of the year. On the underperformers in the mid-cap list, you'll find Ola Electric, of course, continuing to make new lows from their IPO price, already halved this year. Oracle Financial, Kalyan, Voltas, Aditya Birla Fashion, of course, down another 30% this year so far. In the small caps, you'd find a lot of other names like Garden Reach. Of course, defense has been an underlying theme, whether it be the benchmark or the broader markets. Narayana Health making new highs every day. Naveen Fluorine too, after a slew of positive brokerage commentary too, is up 50% this year. And lastly, some small cap underperformers with Brainbees, a new listing is down 40%. But look like Natco Pharma, Anantraj and Tejas Networks too, seeing losses of anywhere between 35 to 40%. The second half of the year is something that has been seasonally positive for the index and for the broader markets as well. And the markets would hope that we do end the year on a high.
All right, the markets will hope that we do end the year on a high. Hormaz, thanks a lot for that. Meanwhile, for right now, there is consolidation at the frontline end of things, even as there are 1,600 stocks which are in the green for about 1,000 which are in the red. We are out of time on this edition of Chartbusters. On that, we will take your leave, but you stay tuned because Trading Hour comes up next. Thank you for watching.
Hello and welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra and with me is Hormaz Patakia. Hormaz, good morning. Well, last 2 weeks were great for the markets, 2 consecutive weeks of gains that we saw. But today on the back foot, but that's something that's par for the course, right? Because we've seen stellar rally that's come by. Today, PSU banks definitely doing really well. Mid caps and small caps are outperforming, but Nifty in the red right now, down around 85 points.
Morning, Sonal. Great to have you back. And of course, yes, par for the course, as you just mentioned, right? Almost 700 points that we surged in the last 4 trading sessions on the index. So only some bit of consolidation is only apt, as we can say, for the index. And as an 80-point downtick, it's still holding on to levels of 25,550. The Nifty bank made a new high earlier in the day, but has come off since then. And at roundabout levels of 57,600 is the new high that the Nifty bank has made. That too, seeing some bit of consolidation in today's trading session. But as Sonal just highlighted, it is the PSU banks that are outperforming in today's trade, continuing from where they left off last week. And the PSU bank index itself is up 2.5%. And all of them, be it SBI, be it Canara Bank, Union Bank, all of them doing well for themselves. But the topic of discussion at the start of the show is the oil and gas space. We spoke about it on a Friday as well, just a bit of a curtain raiser. And today, Citi has written on this sector, Sonal.
Oh yes, so there's a lot that's happening. The first thing is there is a lot of regulation that's going to come about for this space. Citi has written an interesting note. They talk about 2 regulatory catalysts that could be around the corner in the sector. The first one is PNGRB set to approve the new transmission tariff guidelines that it had proposed in March 2025, something that we spoke about on Friday as well. The second one is GAIL's final tariff order, which is likely very soon. The suggestion is that maybe in the July 2nd week, there could be a board meet by PNGRB. So IGL and GSPL, according to Citi, could be the 2 big beneficiaries of new transmission tariff guidelines. And GAIL is, of course, the beneficiary of final tariff order if it comes according to what the street is estimating. Gujarat Gas and MGL could be negatively impacted by PNGRB's new transmission tariff guidelines because it is possible that gas prices for them in that particular area could increase, leading to higher raw material costs. This is no implication on Petronet LNG as of now, but they have also opened a 90-day positive catalyst on IGL. So these are some stocks which will be in focus on the back of these guidelines that would come about. So we're watching out for that one. But we do have a lot happening in the sector. We spoke to IOC as well. So let's take that conversation forward with Probal.
Indeed, and Probal Sen is joining in, the energy analyst at ICICI Securities, to take this conversation forward. Probal, good morning. Thank you for joining in. What is the expectation from the PNGRB this time around when it comes to this unified tariff? Was it not already announced earlier? And what is the difference that is expected this time around from the PNGRB?
Honestly, one will have to sort of, firstly, yes, it was something that has been discussed and they had put out the PCDs or the public consultation document on this earlier as well. I guess the visibility on when those norms could finally be pushed out is probably getting clearer. That is what is getting, the street excited. The difference basically is once you have a unified tariff and you have preferential tariffs specifically for companies supplying to the priority sectors, that obviously will be a benefit to the CGDs. And obviously what is being spoken about in terms of the distance, the way that the zonal tariffs will basically be now determined, that can make some of the players like MGL, which are on the further end of the, or rather which were getting slightly better tariffs earlier, those may have to pay slightly higher to basically smoothen out the tariff. I think that is broadly what, could happen with the unified tariffs. We'll obviously have to wait and see what the final tariff order could actually look like. But, the visibility and the speed at which the reforms are now starting to move, I think that is what is making the street optimistic.
Okay, so how soon can we expect a final decision, Probal? Any indication by when can we see a decision coming in from PNGRB?
I wouldn't want to speculate on the exact timelines. I think when GAIL in its Q4 briefing, post-analyst had said that its final tariff order could come sometime by June or July. And they had, they've recently also, been stating that once these unified tariff norms and all are released, after that, their final tariff order would come. So one would expect that in the next couple of months, you would expect these regulations to actually finally come through. But, I wouldn't want to speculate on the exact time frame.
Of course, you would never know when and how it would pan out. But Probal, GAIL has asked for a 33% increase. Jefferies had put out a note where they expect around 10 to 15% increase. What's your idea? How higher could the tariffs be from what GAIL has asked? Will the street be negatively, will take it negatively? It's less than 10% or something?
Yes, I think there's a reasonable expectation that around 15% kind of a tariff increase might come through. That is what we are anyways building into our base case estimates. So obviously anything less than that is something that could negatively impact the street. It's very, very difficult at this point to say what would be the final tariff that is allowed. If you look at the representation made by them with respect to the gas cost assumptions that were made, purely changing only that assumption to a more realistic gas cost, from about 3.2, which was used in the earlier tariff order, to basically current prices of even subsidized gas, even though they don't really have any access to subsidized APM gas now, but even taking it up to about $7, that itself can actually give them 12 to 15%. So on the basis of that assumption, one would expect that 15% plus tariff increase should come. But then, this is a comprehensive tariff order. There could be other assumptions on costs, capex, everything else. And it's very difficult to sort of then pin it on exactly what assumptions the regulator can have a relook. But on the basis of the gas cost assumption, which is what one of the primary things that GAIL had asked for a review on, I would say 15% is a very, very likely number, and anything less than that would disappoint the street.
Probal, you were speaking to Indian Oil Corporation earlier in the day, and they have also mentioned the fact that their proposed project with CPCL might not go through, and that could be a petchem project as well. But being the largest refiner that it is, how does that impact its refining volume guidance going forward in case this project does not go through as they are anticipating?
I think even if you take out CPCL's proposed refinery throughput addition, the standalone additions that they're doing at multiple refineries, those itself will actually increase overall throughput to well over 85 million tons from the 70 million tons that they have. So, that places them, fairly comfortably as far as meeting their growth requirements. More importantly, I think what they have been doing, or what they have stated as their goal over the medium to long term, is to gradually move to a much higher petrochemical intensity from the current levels of 3 to 4%. What they've been speaking about is they want to get to 15% petchem intensity by FY30. So the decision to basically change the parameters of the CPCL expansion to maybe a petrochem heavy one, I think is in line with those goals to basically move to more and more towards petrochemicals and new energy, and move away from, or at least reduce the dependence on traditional refined products for their earnings. So I think that's something that we wouldn't necessarily look at it as a negative at this point of time.
Okay, so it's not a negative at this point in time. Finally, before we let you go, Probal, what are the top picks? Which segments? There are so many in the oil and gas space, be it the upstream oil companies, OMCs, from the gas space or gas utilities. Which are your top picks right now, and why?
We continue to, I think, be positive on MGL. We continue to be positive on GAIL. We believe, I think, OMCs as a pack, I think, seems very good to us at this point of time. In the upstream space, I think Oil India probably is a more preferred pick than ONGC, purely because operationally we believe Oil India can probably deliver slightly stronger numbers at this point of time. MGL, even if the tariff is a bit of a negative, I don't think it impacts their overall numbers or margins or the growth story, frankly. To a huge extent. Yes, the stock has run up, so there is a correction that's ongoing, but we would use a major correction as an opportunity to get in, even at these prices.
Using a correction as an opportunity to get in. Probal, thank you so much for sparing time and joining us today with your views on what to anticipate from the PNGRB, and of course your top picks within the segment as well. Well, earlier we did speak to Arvinder Singh Sahni, who is the chairman of Indian Oil Corporation, and asked him about their update on the Nagapattinam project, and listening to what he had to say.
The Nagapattinam refinery is, we have gone back on the drawing board because the viability of that refinery was not becoming very good. So now we have gone back on the drawing board, and we are putting into more and more petrochemicals into it. So it might change the financial outlay, but it will be more of a petrochemical plant now going forward, instead of a pure refinery play. So we are reconsidering our configuration, and again we will go back to our board for taking approval for that, and then move forward.
Okay, all right, that's the word coming in from Indian Oil Corporation. All eyes on that project with Chennai Petro. We'll do one thing. We'll slip into a short break now. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta. Stay tuned for that.
Welcome back, and on to some exclusives then. The government is likely to soon invite financial bids for IDBI Bank. Sapna Das, who's been tracking this story, is joining in with the latest. Sapna, tell us more.
So basically, this is obviously something that has been in the works for a long time. The first stage of the preliminary bids, the EOIs, had been invited way back October 2022. And as the finance minister has indicated that, the government expects to conclude the deal in the current financial year. So given to understand that, two aspects, that basically the stage may be set for calling for the financial bids for IDBI Bank divestment. And immediately before that, of course, the share purchase agreement has to be reached with the potential bidders. And that's what the stage is currently at a very advanced stage, and they are very close to concluding this. It's nearing a closure, basically. So once the SPA is in place, nothing stops the government from inviting the bids. My sense is that by end of H1, I think there would be some kind of clarity as to where the transaction is. If at least not finalizing the bidder, definitely calling for the financial bid. So, these are all approvals also which are required, which are very, very critical for the whole process to go ahead. But, the entire deal, I would just like to say this is at a fairly advanced stage. So we have to now wait and watch as to the processes which will now start unfolding.
Okay, all right. Thank you so much, Sapna, for joining us with those important details. It's a story we'll keep coming back to you for again as well, and as and when there are more updates. But it's time to focus on the commodity space. Manisha is joining us as always. Today we are focusing on copper. Manisha, what's happening here?
Well, thank you for that, Sonal. I'm looking at copper because we've seen stronger gains continuing into this one. It has been a roller coaster of an year for copper until now. We've seen all-time highs, and then the prices fell almost 15% from those kind of levels. But when you look at the month of May and June, these are positive months. For the month of June, we are up by 5% for the copper prices. And as we end the quarter and the first half today, we've seen copper prices gain up by almost 27% during this time as well. This is going to be a third monthly gain as well coming in for copper. Couple of positive points. One, the US demand has been much on the higher side. And since there are still conversations on how copper could also be tariffed, like how aluminum and steel is being done, we've seen almost 400,000 tons of copper being shipped to US ahead of these potential tariffs there. The other thing also is about that the tariffs could come in as early as the next couple of months itself, and that seems to be adding some premium to prices there. Interestingly, what you also should be looking at is the TC charges when it comes to copper, and that is where you see a huge disparity. There is concentrate not available into the markets, and is the reason when you look at the copper TC charges, they are the lowest perhaps ever at 0. There are reports on how smelting charges dropped to -43, and there have been times when the smelters are actually offering money to the miners to give them copper so that they can mine and give, refine and give it back to them. So it's becoming that kind of a market. Of course, the profitability has taken a hit right now, and that's yet another trend to follow in copper going forward. Treatment charges in 2024, by the time we ended that year, was around $21 a ton. And as I said, it's at 0, even in the negative at this point in time. So unless you see the concentrate availability improve, you perhaps are going to see that premium also continue in case of the copper prices.
Keep an eye out on copper. It's been a roller coaster year so far, as Manisha has highlighted. Thank you so much for that update. Take a short break. On the other side, we put the spotlight on Zee Entertainment's preferential warrant issue. We'll be in conversation with some experts on this. Stay tuned. Back on the other side.
Welcome back. You're still tuned into Trading Hour. As promised, let's put spotlight on Zee Entertainment, the warrants issue that's ongoing. We understand from news reports that 3 proxy firms had advised shareholders to vote against the company's fundraise plans, which will eventually lead to an increase in promoter stake. The proxy advisory firms have also advised against ratifying 2 board appointments. To discuss more on this, Hetal Dalal, President and COO at Institutional Investor Advisory Services, and Sriram Subramanian, the founder and MD at InGovern Research Services, Services are joining us now. Good morning. Thank you so much for joining in. Hetal, let me start with you first up. Can you give us a sense of what is the core concern driving this shareholder plea or asking them to vote against Zee Entertainment's warrant preference?
Sure. Thank you for having me on the show, and good morning, everyone. There are three broad reasons why IS has recommended voting against the resolution for warrants. One is the fact that the company currently has about 2,400 crores sitting on its balance sheet and cash and treasury investments, and therefore raising another 2,200 crores in warrants and diluting shareholders by an incremental 15% is something that we find that rationale to be unconvincing. The second is we just don't generally like warrants to promoters. Even in a warrant structure, what happens is while 25% of the money is being brought in, there is the remaining 75% has to be brought in over an 18-month period. And because promoters essentially are the ultimate insiders, they have access to inside information. So it allows them to ride the stock price. So therefore, as an instrument itself, we're very cautious in terms of recommending the use of warrants which are issued to promoters. I think third is the whole issue around the fact that investors themselves have voted against Puneet Goenka's leadership last year. And while there's been clearly his resolution to be reappointed has been defeated by shareholders, the board has been protecting him by letting him step off the board but continue to be in control of the company. And therefore, we're asking that fundamental question, saying if investors don't want the current leadership to continue, having them becoming more entrenched in the business by increasing their equity from the 4% to 18.5 odd percent is something that we don't think is in the long-term interest of shareholders.
Hetal, Sriram, good morning. Thank you for joining in. Sriram, same question to you, but you can look at this both ways, right? At one point, does this feel as if the promoters are trying to prioritize control instead of creating shareholder value? And if you look at the flip side of the coin, in general, when the promoter stake goes up in the company, it is generally perceived as a positive, saying that, okay, now the company can have more strategic direction, more clarity. But considering the fact that Zee Entertainment has had so much controversy in the past with regards to its promoters, does that become a null and void point?
Good morning. Thank you for having me on the show. I agree with you. Most often, promoters increasing their shareholding is viewed positively because, given the fact that Zee has faced a lot of issues in the past couple of years, starting with the failed merger with Sony, to the promoters themselves have faced a lot of backlash on promoter funding, their other ventures, defaults to banks, etc. So from that perspective, what Hetal said regarding the warrant issue, especially when the money is not coming upfront, when the source of promoters' funds is now unknown, when they have defaulted in bank loans and others. So that's where the issue is. And the fact is that they had pledged shares in the past. That is what led to the loss of their control. Two is now, obviously, they are not committing here that they are going to pledge these shares. It is probably free shares, but yet the source of promoter funding is not very clear. Two is only 25% will come upfront, 99 rupees per share will come within 18 months. So all these uncertainties create a lot of backlash against the promoters. And investors are not very happy with the promoters also.
Okay. Sriram, just to follow up, you had suggested Zee should consider alternatives like QIP or rights issues instead of warrants. Why do you believe these options are better suited? Because they already have cash. Do they really need to use these methods for fundraise as well?
No, but if we give the benefit of doubt to the management on the board, saying that, look, we really have use for those funds for the next 12 months or so, then these are other alternative means to consider, is all we are saying. Given the fact that upfront, if they don't need the money, then why use it? Why issue warrants at all, where only 25% money will come upfront?
You know, Hetal, as you just mentioned as one of your concerns that you particularly do not agree to the concept of a warrant issue in itself. And does that raise a concern in the minds of the shareholders as well? And the second bit is the fact that they have mentioned that they are going to raise that many that sum of money, and they have also mentioned, they have highlighted that they have plans for the next few years, but they have not disclosed specifics as to what they plan on using these funds for. Now, is that also a cause of concern, because it does not give you a clear idea of what this money is eventually going to be used for, especially because there is already money in the balance sheet?
That's right. I think when you look at warrants as a structure, and especially when they're issued to promoters, I think the fact that there is this whole 25-75 split and you can write the stock price is an element of concern. There have been instances in the past where warrants have been forfeited. And therefore, from just the company's ability to manage its own sort of plans and ensure that cash flow is happening, this becomes a structure which has a lot of uncertainty. I think in instances where you're seeing a 15% dilution, which is quite high, and there isn't a very strong convincing argument for raising that kind of capital, I think that adds to the entire concern as far as these resolution to issue warrants to promoters is concerned.
Okay. All right, Hetal, the other concern has been ratifying 2 board appointments. Is it pure governance issue, or is it related to those particular directors?
No, it's not really related to those particular directors. It is actually a governance issue. You have a board which has essentially ignored the voice of shareholders. When shareholders have voted against Puneet Goenka's continuation on the board, they've allowed him to still run the company by being a CEO, not on the board. And that's essentially cognitive dissonance to say that, well, he's not on the board, it's all right. You're protecting, the leadership from shareholder votes. And I think, therefore, we raise questions around the objectivity of the decision-making process of the board. And it is in that context that we voted against the board appointments. It really isn't, it's not directly concerned with the 2 individuals per se.
Sriram, what does this do to minority shareholders? Every time something like this happens or a controversy breaks out, it is the minority shareholders that are always at a disadvantage. What does this now do to minority shareholders, especially because the stock has moved very significantly from the lows that it made? At levels of around 89, the stock is already at 150. That's a 65% up move in relatively no time. What does that do to minority shareholders now with these new issues that are cropping up at the company?
Yeah, in fact, the very use of the term minority shareholder is a misnomer, right? In fact, the public shareholders are majority shareholders, and as the promoter has only 4% shareholding. And the fact is that the company needs to reconstitute its boards by taking the investors into confidence. The fact is that they have tried to ram in new board members without taking investors into confidence or getting investor representatives on the board. This is where I think the bigger issue of Z is. I mean, they need to reconstitute the board in a manner which is totally transparent, which takes investors into confidence, where investors really like the profile of people in the directorships, and then the company can see a future which is, I would think, aligned with the interests of the promoter as well as the larger public investors.
Okay, we take that point, and thank you for joining in with your thoughts. That's the view coming on Z Entertainment, their warrant issue and appointment of 2 directors as well. The stock, though, is at the day's high. It's up around 2% as we speak. At the day's high, it has recovered from the day's low. But you do remember to tune into the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C and the Global Lens at 8:30 p.m.
Welcome back. Still 300 points down on the Sensex, around 80 points lower on the Nifty. There's some flashes on your screen there from ANI which say that a reactor blast has taken place at Sigachi's Telangana premises and nearly 15 to 20% people have been injured in that blast. We get more details as they emerge. We'll also be hoping to hear from the company on the exchanges as well with regards to this incident. But for now, a reactor blast at Sigachi's Telangana premises. This is a story from ANI. The stock though at the lowest point of the day, 8% lower on that stock. But of course, we are talking about the index. 25,560 is where it currently lies. Soni Patnaik is joining in for a quick chart check on the markets and some trading ideas as well. Soni, good morning. Thank you for joining in. We've had a very strong up move over the last 4 trading sessions. We're seeing a bit of consolidation right now. But where do you see the index headed now? Do we have that strength to reclaim those record highs in the July series? What are the charts indicating? And of course, your stock ideas for the morning.
Hey, good morning, Hormas. Thank you for having me on the show. So I think definitely, because if you look at the overall data that has been formed for July series, Nifty is indicating that it can reclaim those new highs in July series and head somewhere towards 26,200 to 26,500 odd levels. May not happen immediately. There could be some consolidation seen, for the next 2 to 3 days, as we can see some aggressive call writing taking place towards 25,700. However, the overall positional view still remains quite strong, and a buy on declines anywhere towards 25,400 to 25,300. This range is the buy on declines range, and one can adopt that buy on dip strategy around these levels. It holds very strong support towards 25,000. So I think it's quite, it may consolidate, but a buy on dips looks quite feasible right now. Similarly, if you look at Bank Nifty, which is clearly in an uncharted territory, but even Bank Nifty is indicating that it can head towards the 59,000 levels in July series. It also has a very strong support towards 56,000. So anywhere towards a 57,000 to 56,500 is a range where one can accumulate a long strategy in Bank Nifty for a positional play with 56,000 as a support stop loss, and look for a positional target towards 59,000 in July series. And apart from these, I think what we're recommending in stocks would be an official recommendation. One is a buy call on Masdog. The stock is crossing above its 20-day EMA today, and there can be a sharp short covering move seen if it crosses above 3,300, 3,220. So one can buy in Masdog futures with a stop loss of 3,180 and a target of 3,400 to 3,430 levels can be seen. The second buy pick that we're recommending is in CDSL. Similar views, it's given a good breakout on daily charts, and any move above 1820 will see a very sharp short covering. So one can buy CDSL futures with a stop loss of 1775 and a target towards 1830 to 1850 can be seen.
All right, Soni, thank you so much for joining us with that check and individual stock names as well. Let's get stock specific now. UBS has issued a note on two-wheeler companies. Rima is joining us to tell us what the brokerage firm has highlighted and which stocks are impacted. Rima?
Thanks so much for that. So the government on the 27th of June issued a draft notification which makes it mandatory for anti-lock braking systems for most two-wheelers. Now this, remember, is a draft notification. But if it is implemented, if the ABS or anti-brake system is implemented for two-wheelers, we're talking about a cost increase. So UBS estimates about a 4,000 to 5,000 increase for 80% of the industry two-wheelers. And already the industry is reeling with a lot of price increases in the recent past. So they're saying the industry has seen a 6 to 7% price increase every year for the last 7 years, which is higher than historically when the price increase would be to the tune of 1 to 2%. Now, amongst the two-wheeler players listed in India, it's Hero MotoCorp, which will be the most impacted. Royal Enfield, and that's Eicher Motors, will not be impacted because their two-wheelers are already fitted with ABS, being the premium vehicles. So they're saying that the most impact will actually be on the entry level two-wheelers, because in percentage terms, when you put that 4,000, 5,000 in terms of a price increase, it will hurt them the most. UBS has also given the exposure, in terms of revenues for each of the two-wheelers. So Ather is about 100%, Hero MotoCorp is the most at 77%, TVS is at 52%, for Bajaj it's about 21%, so in that sense a bit limited, while for Royal Enfield it's 0, because all their two-wheelers are fitted with the ABS system. So according to UBS, this regulation will further dampen the investor sentiment, and you are seeing the negative cut coming through on Hero MotoCorp on the back of this draft notification making anti-brake system mandatory for two-wheelers from 1st of January 2026.
Okay, those are important details. Thank you, Rima, for joining in. The other stock on our radar is JB Chemicals and Pharma. It's trading lower after Torrent Pharma's acquisition news. Ekta is joining us with more details and the analysis as well. Ekta.
Well, yes, big news in the M&A space and in the pharmaceutical M&A space particularly. Torrent Pharma will be acquiring JB Chemicals from KKR in a two-phase deal. So they will in phase 1 acquire 46.4% from KKR for around 11,917 crores. They may acquire an additional 2.8% from employees at around 1,600 rupees per share and an open offer for 26% at 1,639.18 rupees per share. The total deal value can then go up to around 19,480 odd crores. The equity valuation stands at around 25,689 odd crores. And in terms of the deal, it is at around 19 to 20 times FY27 EV to EBITDA, which compares to around 23 times FY27 EV to EBITDA, which Torrent is trading at. So a slight bit of a discount to Torrent's valuation. Now, phase 2, JB Chemical shareholders will be receiving 51 Torrent shares for every 100 JB Chemical shares. So that's the share swap ratio, and that will result in the merger of the two companies. Valuations, now the deal is at around an 11% discount to JB Chemicals' Friday closing price. The open offer is also at an 8.9% discount. The deal is likely to be funded via a combination of internal accruals, debt funding, as well as QIP. So Torrent could probably take on debt as much as around 10,000 to 12,500 crores. The total debt could, on a combined basis, go up to even 14,500 odd crores. The impact of this is that it strengthens Torrent's domestic portfolio. It will become the 4th largest domestic pharma company in India. Domestic sales as a whole for the company will rise 35% based on the FY25 numbers. They've gained chronic brands that JB Chemical has in the cardiac and gastro space. So Silacar, which is a 785 crore cardiac brand, Metrogil, which is a very popular gastro brand for around 342 crores in terms of size. And they've entered the CDMO lozenges space as well, where JB is around a top 5 global player within that segment. Remember that Torrent has a very strong track record when it comes to M&A. They've acquired Elder Pharma, Unichem, Curatio, all of them in the past. So hence, the street is quite confident on what they can bring to the table. IIFL says minority shareholders should wait for Torrent shares post-merger. Nomura has said that the adjusted EPS could rise mid-single to low double digits. They have a neutral rating, and DAM Capital remains positive. They say that 2 times the EV to EBITDA leverage, according to them, on an estimated basis is not a stretch, and debt can be repaid within 3 to 4 years.
A big deal indeed. Ekta, thanks a lot for that. Well, not a significant reaction in Torrent Pharma. Mind you, the stock did move up on Friday after that upgrade that had come in from JP Morgan. So a bit of a muted reaction in Torrent Pharma, but JB Chemicals though down around 7% at the lowest point of the day. Take a short break. We continue our conversation on the markets with Manish Jain from Centrum, who joins in on the other side. Stay tuned.
पड़े।
Welcome back. You're still tuned into Trading Hour. It's time to talk about market fundamentals now. Manish Jain from Centrum is joining us now to discuss the same. Manish, good morning. Thank you so much for joining in. Well, you talk about certain factors that would lead to earnings growth in Q1 and the next fiscal as well. Can you outline them for us? What's working for the markets right now?
Yeah, so this year has been a little bit of an aberration if you look at the post-COVID world since 2020, 2021. We've kind of consistently delivered double-digit returns year after year, every single year, except for FY25, right? So after a very long time, 2010s essentially was an era of miss where we were expecting 15%, 17% kind of earnings growth from Nifty, delivering 5-6%. But this has been a different era. FY25 was the first year where we saw a massive downgrade, successive through the quarters, Q2, Q3, Q4, right? Every single quarter when earnings came out, the street downgraded the estimates. But I think we are now at a juncture where it is expected to bounce back. I'll be very surprised if Nifty fails to deliver somewhere close to 12, maybe 13% sort of earnings growth for FY26 and a very similar sort of a number for FY27. I think some of the factors that are going to contribute into this kind of a turnaround in earnings growth, number one is RBI. They have been very supportive, both injecting liquidity into the banking system, plus overall 100 basis points sort of a rate cut. Again, would be very, very surprised if we don't see at least another 25 to 50 basis points kind of a rate cut in the remaining part of this current calendar year, given that inflation footprint continues to remain at a multi-year low. The monsoons have been progressing fairly decently well. I think from a banking sector perspective, most of the NPA and asset quality related issues are now starting to bottom out. So maybe another quarter or so before you start seeing a turnaround over there. So the only sector where some sort of earnings concern continues to remain essentially is going to be IT. But except of that, I think by and large, most of the other sectors look set to come back very strongly. Largely driven by top-line growth and not margin expansion, as we've seen in the last 2-3 years. Consumption, again, is another factor that should come back. Urban consumption, discretionary consumption. And given the state of the monsoon and the inflation footprint, I think rural consumption as well. So I think a mix of everything, plus the government's fiscal policy and the budget, I think has been very, very supportive. So you will see a transition from an investment-led economy into more of a consumption-led economy, and that should progress out into the next couple of years.
Manish, good morning. Thank you for joining in. This subject of consumption picking up has been a topic of debate for a while now, and there have been opinions on both sides of the spectrum. I was reading a note from HSBC which talks about a $40 billion consumption boom in the country over the next 2 years. You were just speaking to Mukul Kochar last week, and he mentioned that from a consumption-led economy, we are moving towards a savings-led economy, and that is not very good for consumption. So in a scenario like this, you mentioned that you're expecting both rural and urban consumption to pick up for a variety of reasons. So within this basket, where is your preference lie? Within the discretionary space, within the staple space, where are you placing your bets?
No, I think I'll be more inclined towards a discretionary consumption space. I think staples consumption companies are going to continue to face a little bit of a disruption from a medium to long-term perspective, unless they really evolve in a certain way. I think what has happened with staple consumption companies, especially the market leaders, is they've kind of failed to keep up with the changing times, right? The advent of food tech space, especially quick commerce, has kind of disrupted the entire space completely. So I don't know how comfortable I would be paying, 50x multiple, say for a sector where you are expecting low single-digit kind of a sustainable volume growth going into the next few years. I'm structurally a bear in that space. But if you look at the Indian economy and the way we are poised, even in a very, very base case scenario, we should be able to deliver 5 to 6% sort of a GDP growth rate. You add about 3 to 4% sort of inflation on that, you're looking at 9 to 10% sustainable nominal GDP growth rate for a country whose population is continuing to grow at less than 1% pace. So your per capita GDP on an average will continue to rise year after year, every single year for the next 5, 6, 7 years. That's pure mathematics. And that is essentially what the key driver for discretionary consumption is going to be. And that encompasses everything at the right time, at the right place, maybe autos, white goods, brown goods, real estate, and even some of these domestic consumption plays like, for example, hotels, hospitals. I think they're all good for a certain price. And as an ancillary play, you can even look at EMS.
Okay, EMS, that's an interesting space to look at. Manish, there are a lot of sectors which will be in focus on the back of earnings. Which space do you think will not likely do well, despite the demand pickup, despite good macros?
I think IT continues to be in a little bit of a limbo. That is going to be something which is going to be very interesting to watch out for. The last quarter was obviously a little bit of a challenge. The uncertainties in and around the US economy and the demand pickup from that frontier, I think, continues to be a little bit of an overhang over there. So IT is going to be one sector to watch out for. And like I said, even though I'm a little bullish on banking from a one-year perspective, Q1 is going to be very interesting to watch out for because credit growth has not yet started picking up, right? Back to 13-14% kind of numbers. And in a scenario of rate cut, you should expect a little bit of a NIM compression over there as well. And then particularly from an MFI space perspective, it will be at least one more quarter before the kind of whole asset quality issue settles down and you start seeing a turnaround over there. So that again is going to be a little bit of a mixed bag, something which is going to be worth watching out for. But domestic consumption driven stories, I think, should report fairly strong numbers.
You know, Manish, I'd want to pick your point on the staples bit that you mentioned. You would not want to pay a 50x multiple for staple companies because you believe that they would continue to struggle. But you mentioned EMS as one of your sectoral preferences. But even those names are trading at around an 80x or 100x multiples for the likes of Dixon or for the likes of Amber, PG, Electroplast. Is this the growth runway that they have is what is justifying your conviction on these names despite the elevated valuations that they trade at?
So it's sort of 2010s which is playing out for the EMS space today as it did for the FMCG companies, back then. Multiples we saw from 20 to 24 times got re-rated to as much as 70, 75 times in those 7-8 years when nothing else worked in the Indian markets except for FMCG companies. The point basically being that people are okay paying any multiple as long as the growth holds up. When you start seeing structural growth concerns is when the multiples kind of collapse across the board. We've seen that in retailing, we've seen that in FMCG, we've seen that at certain points of time in defense in the 3 years back. So we've seen that across the board. And that's essentially the key concern. But EMS, if you see, like I said, if you're looking at a $7, $8, $10 trillion kind of an economy by mid-2030s, and you're looking at the per capita GDP going from $2,700, $2,800 to say $5,000, then discretionary consumption, lifestyle plays is going to continue to play out over here. And if that is going to be the case, then these companies, which are right now growing at a certain pace, they have kind of just explored the tip of the iceberg as far as the entire spectrum of growth is concerned, unlike the FMCG companies. So as long as the growth runway holds up, I'm optimistic.
All right, Manish, pleasure having you as always. Thank you so much for sparing time and joining us today. That's Manish Jain of Centrum. As we take a short break, here's some good news for our viewers. India's business news leader is now just a click away, and that is, of course, CNBC-TV18's all-new app. And it gives you breaking news, financial world updates, and in-depth articles, all of them at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that comes up on your screen to download the app. We take a short break, back on the other side.
Welcome back. You're still tuned into Trading Hour. Well, the market's consolidating at those levels. There's been a wee bit of recovery from the lows. When we started the show, it was down around 83 points. Now it's down 62. And a couple of stocks in the broader markets which continue to do well. So pull up something like an Alembic Pharma. That stock is up 13% as we speak. There was a drug approval, an approval that came by for the company. So that one is doing well. Overall, the PSU banking space has been doing really well since morning. So something like a PNB, Bank of Baroda, Union Bank, all of these stocks are up. SBI too, the heavyweight in the Nifty pack, is up around 1.7% as we speak. What is leading to the recovery that we are seeing from the lows? Something like an HDFC Life, SBI Life. We have some recovery come by in the Bank Nifty as well. So all these stocks have led to that little bit of recovery that we are seeing on the Nifty right now. Other stocks like Titan, that's at the day's high. Sun Pharma is at the day's high. And some of these IT names also doing well. So some recovery, but you know, it has been a day of consolidation so far.
It's been a day of consolidation indeed. And just before we toss into the bites from Mahesh Patil, you pull up Hyundai Motors, and that stock is continuing to move from where it left off last week. It was among the best performers last week. The stock has crossed its IPO price of 1960, and since then there has been no looking back on that stock. There have been multiple initiations on the stock, and with price targets of anywhere between 2300 to 2500, it's already at 2250. So keep an eye out on Hyundai Motors. And the last one they wanted to highlight is Car Trade Technologies. That stock is now at the highest point of the day, and that has seen a significant recovery as well from the lows that it had made. And it had an IPO price of 1618. It fell to levels of 400 odd, and then it has now come back to trade to levels of around 1700. But we take a leave on this edition of Trading Hour. But just as we do that, listen into excerpts from our conversation with Mahesh Patil, the Chief Investment Officer at Aditya Birla Sun Life AMC, from Sonal Me and the team that put this show together. Thank you so much for watching. Halftime report on the other side.
Overall, I think the liquidity flow into the markets is also improving. We've seen FIs slowly starting to come back. Domestic flows have been steady. And I think valuations were reasonable. I mean, markets, after the correction, what we saw around 6-9 months back, a lot of stocks had come down to decent level. We've seen now interest coming back, not only into the frontline names. I mean, the large caps were always looking good on a valuation perspective. But even the broader market, right, the mid cap and small cap have seen a good recovery. Although I would say that it is more stock specific in the mid and small cap. Not everything is moved up, but clearly I think the confidence is coming back. I mean, IT sector was the first one to underperform, right, earlier because of global concerns. And I think on that front, I think US, where you were expecting a recession, the probability was much higher around, say, 3-4 months back. Now that has receded. And looks like at least the commentary also from the IT companies is that the worst seems to be behind. That doesn't mean that you will see a sharp recovery over there in terms of volume growth. It will be still slow and tepid. But I think this is a sector where I think overall stability, I think, would be there. I think the downgrade cycle seems to be behind over there. Also, the cross-currency impact also could be slightly positive, at least in this quarter.
The government is set to invite financial bids for IDBI Bank as soon as talks on the share purchase agreement with potential bidders near a close. The move comes on the back of Finance Minister Nirmala Sitharaman indicating a completion of the deal in FY26.
Torrent Pharma will buy out KKR's 46% stake and make an offer to employees and minority stakeholders of JB Chem in an over 19,000 crore rupee deal, followed by the merger of the company. Analysts give the deal a fairly valued thumbs up.
The deadline for IndusInd Bank to send its recommendations for the CEO position to RBI ends today. Sources tell CNBC-TV18 Rajiv Anand of Axis Bank, Rahul Shukla of HDFC Bank and Anup Saha of Bajaj Finance may be named in the list.
Hope of an early US trade deal rises after Donald Trump says a very big deal with India may be possible soon. Indian trade negotiators visiting the US extend their stay, giving them more hope and legs.
Hello and welcome to a halftime report live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Manglam Balu. Well, it is turning out to be a day where we are starting the week rather on a little bit of a cautious and mixed note. So we have the mid-cap index, which is outperforming with a gain of around 0.5%. But we have the Nifty as well as the Sensex just about consolidating with a negative bias after what was a strong week last week. So the Nifty just about lower by around 68 points. The Sensex lost around 250 odd points. And the Bank Nifty absolutely flat at this point in time. But a lot of deal action. So whether it's from the paint space or whether it's from the pharmaceutical space, Manglam.
A lot of deal action. That's exactly what's taking place. But, you know, the street would like the Nifty consolidating a little bit. The broader markets are doing a lot better. We have, a bunch of stocks advancing as against the number of stocks which are declining. The crisscross lines haven't crissed or crossed. We have more stocks in the green than, they've been through the course of this trading session so far. And the mid-cap index has definitely moved to the high point of trade, telling you that the street is betting for an important support coming in for the frontline index, even as it consolidates after a big rally. But speaking about deals, one of the many that took place over the weekend, we had Rainbow Medicare. That's the first management on the show. They will buy 76% stake in Prasanthi Hospital in Telangana. To talk more about this development, we are now joined by Ramesh Kancharla, who's the chairman and managing director of the company. Thanks a lot, Mr. Kancharla, for joining in. Every time you join in, we ask you about this inorganic plan, right? This has happened. Tell us a little more. How much can you scale this by? And by when does this break even? Or what synergies are you expecting?
So this is the first expansion within the Telangana from Hyderabad. We have done it. So Warangal is the second largest, the Tri-City, Warangal, Hanmukonda and Kajipet. It's about 1.1 million population. So where the brand is a very well recognized. So we've been looking at kind of opportunities to kind of start a hospital there. This has come very handy, Prasanthi Hospital, and also fundamentals are very similar. It's a dominantly kind of obstetric-driven hospital as of now, on the neonatal. So where we can go in kind of build further to be a comprehensive children's and women's hospital.
Okay. So could you just give us a sense in terms of what presence you all would have in Telangana now with this particular acquisition? How many beds would you all have and the statistics such as occupancy that you are probably anticipating?
I think that this is a 100-bed facility. And with this addition, we have 940 beds in Hyderabad. So this will take us get past 1,000 beds in Hyderabad and Telangana. So, I mean, this 100 beds at the moment, their occupancies are kind of somewhere around 30+%. So we're hoping to kind of build a kind of a larger fort over there and have a kind of a comprehensive services for the women and children.
So this current hospital, Prasanthi, which you've acquired, has occupancies of around 30-odd%.
Yes, that's right. Yeah.
So that's quite low. What is the financials looking like? For example, the EBITDA as well as, say, the bottom line. Is it making money?
It's about, the 17% of EBITDA. And they do good numbers, actually, numbers-wise, when you look at it. They do 1,400 deliveries. They see about 4,500 outpatients, inpatients, about 30,000 of outpatients. I think what's important is that it's been driven dominantly with an obstetric-driven hospital with a neonatal care. So what Rainbow is going to make it more comprehensive.
Mr. Kancharla, I wanted to understand if there is expansion plans beyond this 100 bed that you have out there. Do they have room for you to add some more beds there? Would you have to invest a little more out there? And since you take this hospital over, what is the kind of incremental revenue and EBITDA that we can see? Because you're a much bigger chain, so there would obviously be some sort of cost synergies as well.
So traditionally, what we look at it, this we would term it as a regional spoke. As a regional spoke, 100 beds is fairly good enough. Probably what we would do is we would tweak a little more towards more intensive care beds, plus obstetrics and then pediatrics. So we drive a specialty care from the clinics from Hyderabad, and also other complex stuff will get transferred to Hyderabad. This will be a typical regional spoke. The 100 beds is fairly good enough. Probably we need to do a more capex as we move forward, as the hospital's operations are getting strengthened.
Okay. Just wanted to, ask you whether you're looking inwards into the domestic business more because of, say, the international revenue being a little challenging. We do understand that, Bangladesh, Oman, Kenya, Sudan, there was a significant decline in a couple of these countries in the past quarters. Are you now looking at domestic revenue more strategically?
I think the international business has never been the big business. I think we maximally clocked about year before 3.5%. Last year, it's dipped down because of geopolitical reasons. So that is that's a long haul. Focusing on internal business will happen over a period of time. So that has nothing to do with this one. This is a strengthening our position in Telangana state, because this is where the brand is very well known, even into the village level.
Hear of any more similar deals in other geographies as well in the very near future?
Yes, we are working on a few. Probably will come back to you very soon.
And they will be of similar size itself, right?
Probably larger.
Larger. And how many do you expect to close in this year?
Well, we'll come back to you very soon.
Okay, let's put it this way. How many are you in talks with right now?
No, we explore everything. Whatever is available in the market, we would explore it. But eventually, we see that what suits to us philosophically, and also where we can kind of build further on.
So would it be this size of an acquisition, and would it be in, the gynecology segment itself?
Yeah, this will be within the pediatrics and obstetrics domain itself. I don't think we would be kind of moving away from our core business.
And geography? Will it be this one, or are the other geographies that you're exploring? Because I remember...
Different geography, which we will...
Okay, you focused a lot on the West earlier. Is the next one coming in the West?
I'm not sure, so let's wait for it.
All right.
Just before we let you go, just a quick question, sir. Just wanted to get a sense in terms of the pickup this quarter, because last quarter you said was unusually quiet for you all. Just a quick one-word answer in terms of what you're probably tracking this quarter as compared to the last.
So we're going to come with the results very soon. So let's wait for the results. We're almost in the fag end of the quarter.
Okay.
Okay.
All right, so we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Rainbow Medicare. The stock is up around 1% odd. Small acquisition that they made of around 24 odd crores of a particular 100-bed hospital in Telangana. We'll take a short break. Up next, we'll focus on the big deal. Torrent Pharma JV Chemicals, one of the largest deals in the India branded pharma space. More on that once we're back.
Welcome back. The big deal. That's what everyone's going to talk about, right? That is the one that has come in the pharmaceutical space, where Torrent Pharma has gone ahead and bought JB Chemical and Pharma. In doing so, it's actually become a big conglomerate over the last few years, not only in the pharmaceutical space but power space, and also having interest in Gujarat Titans. But for Torrent Pharma, for now, Ekta has moved across to the big wall. Ekta, tell us more about this deal.
Well, yes, Torrent Pharma has announced a two-phase acquisition of JB Chemicals from KKR, marking one of the largest deals in India's branded pharma space since possibly the Ranbaxy-Sun merger. Torrent will first acquire 46.39% stake for around 11,917 crores and may pick up an additional 2.8% from JB Chemical employees at around 1,600 rupees per share. An open offer for 26% follows at around 1,639 rupees per share, with the total size of the acquisition for Torrent possibly going up to as much as 19,480 odd crores. Now, in the second phase, the companies will merge, with JB shareholders receiving 51 Torrent shares for every 100 held. Now, the deal values JB Chemicals at around 25,689 crores, an 11% discount to its closing price ahead of the deal. With the JB Chemicals acquisition, Torrent Pharma is now poised to rise from the 6th to the 4th largest pharma company in India. The deal, in fact, is expected to boost its domestic revenues by 35%, surpassing 8,600 crores based on FY25 numbers. Torrent will strengthen its dominance in cardiac and gastro segments, gaining top brands like cardiac drug Cilacar with sales of 785 crores and gastro drug Metrogyl at around 342 crores in terms of a size of a drug. It also secures entry into ophthalmology and expands its footprint in the global CDMO space. Torrent Pharma may in fact fund the JB Chemicals acquisition through a mix of internal accruals, debt and equity via QIP. It could take on as much as 10,000 to 12,500 crores of debt, pushing the combined net debt to around 14,500 crores and a net debt to EBITDA to around 3 times on an FY25 basis, according to analysts. However, analysts including DAM Capital are not overly concerned. They point to Torrent's steady free cash flows and believe a 2 times EV to EBITDA leverage is reasonable and the debt could be paid down in 3 to 4 years. Now, while JB Chemicals currently operates at a lower EBITDA margin than Torrent Pharma, analysts are not overly concerned about that either. Torrent has had a strong track record of cost rationalization as seen in its past acquisitions of Elder, Unichem and Curatio, which saw margin expansions within 1 to 2 years. While we could see near-term dilution, analysts believe the combined entity could target EBITDA margins of 34 to 35% over the next 3 to 4 years. Lastly, what are the brokerages saying? IIFL recommends JB shareholders should avoid tendering in the open offer and wait to swap their shares in the merger. Nomura expects the adjusted EPS accretion in the mid-single to low double digits. They maintain a neutral rating with a target price of 3,580. HSBC expects the deal to be 3% accretive to FY27 estimated EPS estimates. They retained a buy with a target price of 3,775.
All right, Ekta, thanks a lot for that. So that is the big pharmaceutical deal that took place over the weekend and the sum and substance of it all, as explained by Ekta. So to talk more about this, we do have Sumit Gupta, AVP Research at Centrum, and Suresh Subramaniam, who's a partner and National Life Science and leader at EY. Let's go to EY first. You know, when we look at this deal, we look at deals of this size, typically analysts assume a 500 to 600 crore sort of cost synergy that has come by. As someone who's been looking at this M&A space, specifically of this deal, what would you suggest would be the cost synergies here between the two players?
I think there are tremendous potential for cost synergies. We can't kind of actually guess or put a number to it as to how much it would be above 600 crores. But it might be suffice to say that there are a lot of areas where the synergies can play out. One is in increasing capacity. You can do more with less. The JB Chemicals has 8 manufacturing sites. Combine it with the 16 manufacturing, combine it with the manufacturing sites of Torrent. Your ability to serve in terms of capacity to the global markets is very high. And if you look at the portfolios, the portfolio synergy is very high. It is both complementary and consolidating. So again, there is a huge play of synergy. There's a lot of scope for cross-sell. And I think all these will kind of impact the synergy number that you put out.
Okay. All right. Suresh, just wanted to ask you about the possibility of how Torrent itself is growing, because they've jumped from 6th to 4th. They've made a string of acquisitions in the past couple of years. What do you think, the strategy for a Torrent Pharma would be in the domestic market? Are they going to become a force to reckon with?
Yeah. So you're right. When you look at their past acquisitions of Elder Pharmaceuticals, and subsequently Curatio, the smaller ones, they've always kind of enhanced their brands they acquired, be it Shelcal or be it the Derma brand from Curatio. So I think given by the potential of the big brands that are there, Nicardia, Metrogyl, Silacar, and Rantac, which are both in the gastro and the cardiovascular area, as you alluded a while ago, there is tremendous potential to kind of get into the Torrent outreach, and there is a scope of growing these mega brands, right? And these are very big brands. So that's one thing for sure. So the second one is very clearly in the area of tier 2. Tier 2 areas, Torrent has a very big reach, about 8,500 field force, or probably 9,000. And juxtapose it with, the JB Chemicals field force, which was probably 2,500 or so. There is a tremendous scope to kind of penetrate markets with these big brands and the augmented portfolios, if you may. The next piece is also to kind of play a bigger role in the OTC market. Given their manufacturing capability through their CDMOs, their ability to serve their OTC aspirations are much bigger now. So I think what we're seeing is a rapid movement, because these are two companies growing at above 12%, and you can expect a much higher growth through the synergies.
Sure. Sumit, I just wanted to narrow down on what you would be recommending, say, to your clients if in case they do have JB Chemical shares. Do you tender in the open offer? Do you stay put for the share swap?
Offer, so just stay put with the Torrent share, so JB Chem share. So basically, I see more synergies going on, and once the merger finalizes, then it will be beneficial from the shareholder point of view. As of now, one should not tender.
All right, that's the view. Just hang in there, gentlemen, because at the bottom of your screen, there was a clarification that is coming from Reliance, where they've gone ahead and denied any information with regards to sale of Naira Energy to Rosneft. This morning, the stock was doing fairly well on account of reports. There was a PTI report on talks to buy Rosneft's stake in Naira Energy. Reliance Industries has gone ahead and denied that. The stock has been doing fairly well over the last 10 days or so, has recovered a strong bit from the lows, and has been one of those, supporters of the Nifty as it's moved higher. But right now, it's flattened out on the denial of the PTI report of talks to buy Rosneft's stake in Naira Energy. So that's the big corporate development that has come in on Reliance. But Sumit, you're saying that people should not tender in the open offer. From your model, if you track both the companies, I wanted to understand how long before this deal becomes EPS accretive for Torrent Pharma, and what are the kind of revenue and cost synergies that you're penciling in? Suresh said it could be between 500 to 600 crores. Without giving a specific number, could perhaps be more than that as well. What are you factoring in here?
Yeah, so basically it will be, as of now, for the near term, 1 to 2 years, we are expecting EPS dilution. of around 5 to 6%. However, it depends on how the deal structure would be done. So if it is all debt, then it would be more EPS dilutive. However, if there is equity and a mix of debt, then it would be EPS accretive in the first 2-3 years only. So it depends on how the deal is going to be structured. So we need clarity on that.
Okay. And on synergies, cost synergies, 500 to 600 crores, is that a fair estimate?
So, yeah, cost synergies would be there. So with respect to Torrent, obviously in the first few years, 1 or 2 years, basically, I'm expecting around 100 bips kind of decline in Torrent's margins from 33 to 32. So basically, it's nothing significantly detrimental to Torrent's, but overall, over the medium to long term, it would be very much beneficial from Torrent from combined entity point of view also.
Okay.
And if we see Torrent's acquisition of Kuroshi also, it has a historical track record of turning around the businesses. So I'm positive on Torrent's execution. So they can also give JB Chemical margins a fillip over the next 3 to 4 years.
Okay, so just Sumit, just on the debt that Torrent will be taking on, ranges are 10,000 crores to almost around 12,500 crores. The consolidated debt could be around 14,500 crores on the books for the two entities. How concerning is that for you?
Not that concerning. As of now, Torrent's debt to net debt to EBITDA is basically 0.6 times. However, suppose if it goes to all debt deal also, in that case, it would be around 2.5 to 3x. However, I'm expecting a mix of debt and equity. In that case, it would be around 1.2, 1.3 times, which is very much comfortable.
Okay, Suresh, what about you? The overall deal structure, for example, we don't know the combination right now in terms of equity and debt, but the fact is that there will be a huge debt component which Torrent will have to take on. Do you think that they are probably going to be able to service it more easily, and what would the past acquisitions tell you?
I think they've managed their past acquisitions and they've managed to, get better EBITDAs around cost synergies around in both the Elder, the Curatio deals, and the way they've integrated the company and kind of made brands more profitable, I think indicates that they can pull out more money from their operating cash flows. And so I think it's a good story. The debt is manageable. They have a track record of doing that. And besides, I think global markets is something that we should not discount. They've kind of, if you really see, Torrent is strong in US, Germany, and Brazil. And, what JB Chemicals brings in is, while it brings in consolidation of US, it kind of brings in, Russia, South Africa, and a whole lot of emerging markets. So their ability to get more out of their portfolio, globally be able to cross-sell on their portfolio will be of a higher magnitude. All that encourages me to think that the revenue they generate and the profitability that they already have would enable them to kind of service their debt much more easily.
Suresh, Sumit, thank you so much for joining in and giving us your perspective on this big deal. What we'll do is take a short break, come back. On the other side, we get you more of the markets and a lot of other stock-specific action, which is currently underway. The Nifty Bank is just about moved into the green as we speak.
Welcome back, and joining us now is Rahul Kapoor. He's Vice President, Head of Shipping Analytics and Research at S&P Global Commodities Insights. Rahul, hi, thank you so much for joining in. And shipping clearly has been a place to be for last couple of years now, where after Red Sea, it's about Strait of Hormuz now. While we do understand that there are no concerns within the voyages there, but would you say there have been some restrictive actions taken by some companies? How have you seen the number of ships? Because the last time I kept account, 100 to 120 ships pass every day via that area.
Yeah, certainly. Thanks, Manisha. Good to be back. I think if you go back just a few weeks, right, I think Strait of Hormuz has always been in the focus, right? Its dependency for the top Asian buyers and what it means for the global oil flows, LNG flows, right? Right at the time of the escalations, we did see a bit of a pause on the traffic. But overall, if you look at particularly the tanker transits, right, as well as other ships, they have been robust. We haven't seen material decline in terms of the shipments across Strait of Hormuz, the oil flows as well. There were some interferences, particularly with what was happening with the GPS as well as the AIS. But overall, I think there is calm returning. But the fact is freight rates are still up, right? The freight rates, particularly for the tanker markets, effectively doubled in that short period of time. You have higher insurance premium. There's war risk premium as well. That will take its own time to come off because there's still some concern. But overall, shipments and transits have been particularly fine.
Just to get a sense of the freight rates, really, they did double. They've come off slightly a bit of as well. On a year-on-year basis, how would you look at those numbers?
Yeah, so I think if you just go back before the conflict started, for the big VLCCs, the very large crude carriers, the freight rates were around $20,000 to $25,000 per day. They went all the way to $70,000 to $80,000 per day. There were certain ships which were fixed even for $100,000 per day, close to that, right? We are somewhere in 50 to 60 now. We haven't come off totally because, like I said, there's still some concern, as well as these are over a period of time when that risk goes off completely. The freight rates would start coming off, right? Oil prices have certainly corrected, but the freights haven't fallen to the levels before pre-conflict.
Rahul, when you look at the crude oil prices, when you talk about that, it is said that it is 80% geopolitics, and the way geopolitics has been right now really seems to be making prices very, very volatile. How would you read into the geopolitics from where they stand? Would you say it's eased off considerably? Have we seen all of that premium go over?
Yeah, I think particularly for the oil prices, that has certainly come off. But like I said, if you look at just the global trade or for that matter, global shipping, right, geopolitics is playing a much larger role. We've seen from the Red Sea, there's still, as in terms of the attacks of the merchant shipping, those have come off in 2025. But the shipping companies certainly haven't gone back en masse to the Red Sea. We're seeing some opportunistic traders as well as operators, particularly for the tanker shipping, go back to the Red Sea. But the Suez Canal, for that matter, Red Sea is still not to the levels where it was pre-conflict, right? Same on the Hormuz as well. Like I said, on the oil prices, the premium might have come off, but it hasn't come off fully on the freight rate side. So geopolitics is still very, very central to what's happening with global trade and global shipping at the moment.
Rahul, and geopolitics is one part of it yet again, because you have tariffs and sanctions and compliances. I mean, there's no end to that story.
Yes, indeed. Yeah. Yeah, I think that's something which we've been highlighting, right? If you see, and we have to give credit to global supply chains as well as shipping, because if you look at the last 5 years, we've had COVID-19, we've had Panama Canal drought, we've had Suez Canal, in the Red Sea situation, we have Russia-Ukraine conflict, right? But the supply chains have been resilient, and shipping industry, for that matter, has been supplying goods to all of us, right? So I think that's important as well. But again, coming back to it, like I said, geopolitics is now essential to global trade, your tariffs as well. And that forms our view that you will continue to see global trade come off, right? This year as well, we are expecting flat to slightly negative growth in terms of global trade, whereas your global trade, your global GDP still continues to grow. So overall, global trade to GDP continues to compress, right? That's a long-term phenomenon which we're talking about, primarily because of what's happening with geopolitics and protectionism rising.
And Rahul, with that as a background, would you say investment and capital flows get impacted within the sector?
No, I don't hear anything.
Rahul, do you think with all of that happening, there could be an impact on the investment within the sector? All right, looks like we've lost Rahul there, but interesting points he was making, saying that when it comes to freight rates, well, we did see it going from 25 to 80 and coming back now at 50 to 60. So clearly way, way higher than where it was before the Israel-Iran conflict started. And another interesting thing that he said was that it is a very flat global trade growth that we're looking at. not at all aligning with what the GDP growth looks like in the global markets. So this is a sector to keep an eye on. Interesting to get a conversation going on what really is seen in sense of investment and capex there. But that's for another time, looks like, guys.
We'll take that on board, Manisha. Thanks a lot for that. And most importantly, look out for the impact of this and the results of all these shipping companies as well, whether they reflect this time around or not. Before we take that short break, pull up Angel One. That stock has moved to the high point of trade. And by and large, the mid-cap's doing a lot better. What we'll do is take a short break, get you updates from the F&O on the other side. Welcome back. Let's take a look at the F&O setup during the day, and it's not particularly bad. Why do I say that? Because the frontline indices are consolidating, absolutely flat for the Nifty, bank filling between red and green. The Nifty's giving up just a smidge of the gains that it had made all of last week. And the broader markets, they are doing very well. So the mid-cap and the small-cap indices come up for you. Way more stocks advancing than the number of stocks which are declining. So all of this sets us up for maybe a pause and thereafter an up move. Why do I also say that? Because, on Friday, we had a couple of indicators that suggested maybe the market was overheating a little bit. Those indicators were, one, the India VIX. That had fallen to levels of 12.4. And this morning we pointed out that maybe it's factoring in complacency. That's coming back to normalized levels. And secondly, the put-call ratio typically moves from 1.2 to 1.3. That's the overheated zone. It's now cooled off to close to 0.94 or 95. And that's, telling you that, okay, bulls are making some room for a further up move after this pause for breath. What are the active options? 25,600 call, fairly active. 25,650 call, equally active as well. So 25,650 call has a premium of almost 100 rupees. At the lower level, we are seeing 25,600 put, seeing a fair amount of writing. And at the high level, 25,800 call too sees some writing at a premium of 50 rupees. What does all of this data mean in terms of levels? Well, strong support seen around 25,450 to 25,500. That's where we are, closer to 25,550 thereabouts. And congestion between 25,750 and 25,850. Two stocks I'm watching out for. A lot of long positions added on LIC. Life insurance companies have done well in the first half of this year, calendar year so far, and LIC sees some fresh bidding. And RBL Bank may be the first stock to enter the F&O ban in the July series. So we'll keep an eye out on that one. That's about the market. Take a short break. On the other side, we have the management of Zydus Wellness joining in on demand trends and their FY26 outlook. Welcome back. Zydus Wellness management usually does not speak much, but over the last 2 weeks or so, the stock has been on our radar on account of a large trade that took place. We had, TPG Capital Investment arm selling about 7.5% stake. On the buying side was PPFAS, Parag Parikh Mutual Fund, which bought about 7.3% stake at 1,900 rupees a piece. Since then, seen a rally of almost 7-8% or itself. The company joined us post their fourth quarter numbers, said that they are targeting early teens revenue growth in FY26 with a margin glide path of 17 to 18% in the next couple of years as well. Tarun joins in now to talk more about this. Tarun Arora, obviously the CEO and director at the company. Tarun, always a pleasure speaking with you. We'll speak about the long term, the medium term, the aspirations of the company. But here, in the near term, can you tell us a little about the underlying consumer sentiment? Have we seen any improvement from the last time to now? There have been rains, but also there have been unseasonal rains which may impact some of your prickly heat powder business.
So, Mangalam, always a pleasure to talk to you and be on CNBC. So thank you for having me here. I think this summer's been brutal for anyone who has a, summer business. And we have not one, but two brands, both Glucon-D and ISIL, which rely heavily on this. So it's actually gone worse. And typically in between rain, you're prepared and you do expect some bit of surprises. But there it is. Has been a continuous rain throughout the quarter, throughout the last few months. So obviously it has impacted a lot of our momentum in these two brands. Everything else stays on track, largely in line with what our expectation and plans are. So, it's bittersweet in a way because we've had good traction on some of our initiatives, new products. Our acquisition, Max Protein, has seen a good traction. It's in the right space. Some of the large, high momentum and summer spaces have really pulled us down. So very happy with Everyuth. When I look at Everyuth, Neutralite, when I look at, products like Max Protein, even a sugar-free Delight range. But things will, that's what it is.
Tarun, if you could give us a sense in terms of how much these two brands have been impacted. If you have to compare, say, the performance last summer to this summer or the average performance, how much is it lower by?
So, sitting on 30th June, I'll avoid getting into numbers. But I can tell you it's been brutal. It's been worse than we would have imagined. And therefore, I would say that there is always situation when there is off-season rain and you kind of deal with it. It catches up and there is a momentum. But here it has been non-stop. So obviously the impact on these two brands have been significant. And leave it at that. We hope that the remaining 3 quarters will hold us in good stead and help us catch up on the numbers that we wish.
So the early teens revenue growth guidance that you've given for this year, does that stand at risk because of what the first quarter was like?
So, look, my view always remains that we'll be a double-digit growth over a medium term, and therefore we retain that view from a medium term. For this year, like last time I spoke, and the numbers change every day. So I think rather than me commenting on if that number changes, we'll have the numbers once we publish it. But our focus remains to execute consistently, and whatever we lose this quarter, we will try pretty hard to recover through the next few quarters. But that's
just from a bookkeeping standpoint, how much do Glucon-D and Nycil account for in your overall annual business?
We don't specifically share brand-wise numbers, but their largest share of numbers happen between Q4 and Q1. Almost 85-90% of the business happens between these 2 quarters. So therefore, there's a big chunk sitting for these 2 brands.
Let's talk about a larger trend then, Tarun, because you had indicated that the rural markets have been outperforming for you all as compared to the urban segments. Is that trend still playing out, and by how much of a margin? And do you expect that trend to play out? If you could just give us more details.
Sure. So I've seen over last financial year and even continuing trend, if I really look at it, rural has been 3 to 4% as reported by all syndicated data, been growing faster than the urban. Of course, urban gets compensated because when I look at sources like Nielsen, they do not cover the quick commerce. So it gets compensated. But from a consistency and a general trade point of view, rural has been always leading. Even our distribution is substantially, disproportionate to the share of sales. So 25% kind of sales coming from revenue coming from rural, but almost 50-50 share between equivalent presence in our distribution for rural and urban. So clearly we are prepared for a larger growth in rural, and it's consistently done. Urban, I'm hoping that post this, current actions that the government has done, they've action on tax, the interest levels have been lower, some level of urban momentum will catch up. The good thing is I do see some categories still showing a good urban momentum, some premium spaces, newer building spaces. So that can really keep us doing well in urban as well.
Got that. The only problem is that the contribution of those are not as much to drive the entire bus forward. They're just enough to, spur near-term growth. Just wanted to understand about the MFD category, right? Because milk prices have increased, and typically when that happens, categories such as Bonvita, Horlicks, Boost, Complan, all of them see a bit of a downtake. Add to that, you've also very recently had a leadership change in HUL, where the foods business has a new leader with a view to grow Boost and Horlicks. So there is strong competition, a new leader among the competition places, and higher milk prices. In light of that, what's the prognosis for Complan?
Sure. So first of all, I think if they manage to grow the category, because it's, first of all, I think we need to recognize is there's a category level issue. And a market leader with 50-55% market share, if they drive the momentum forward, I think it'll be good for everyone. So I really hope that they succeed in what they're wanting to do. So I'm less worried about competitive action, but I'm more positive. I'll be more positive if the category really shows a higher momentum and if they are able to do that. So I'm completely with any actions they take, which is category building. Having said this, for us, I do recognize that there are opportunities for Complan to fight against the challenge that we face at a larger level, environmental level. And therefore, we are trying to place newer SKUs, newer, need spaces, which Complan never serviced. For example, the last year, about 8-10 months back, we launched an adult nutrition VMAX. We also have a Complan Nutrigo, which we'll try and rework and build it forward better for the future, which is in the toddler space. There may be a couple of more ideas over next 3 quarters that we will explore. We have it in the pipeline. We'll just take a call basis of how the market shapes up. If we could help launch those as well. So my view is that, one, I would hope that the leader really moves the market in this tough environment where the milk prices are going up. There is other alternatives which are driving forward. While we do that and we'll wait for them to act on it, we are looking at segments or need spaces where Complan has opportunities and we're building around those. So as the market moves up, we could move even faster as we build around.
Okay.
There's also an opportunity around clean labels, which we'll consider across our portfolio as consumers are getting more and more conscious about some of those things.
Okay. Tarun, you join us on a day where there's a huge deal which has taken place in the pharmaceutical space, and that has many OTC brands. It just reminded me of the Heinz India acquisition, which took place in 2019 by all, and that was worth around 4,500, 4,600 odd crores. Just give us a sense in terms of what the M&A strategy would look like for the company going forward. Any such big transactions on the cards? What would be the cash on books which you would be ready to deploy?
So first of all, I think we've clearly M&A has been part of the strategy at Zydus Group and Zydus Wellness itself. It allows us to one side scale, which is what Heinz deal did, but also play in spaces that we want to, which is food and nutrition on one side and skincare on the other side. We do believe there are spaces where we can build further and add to the our portfolio in the right direction. Food and nutrition, which is already a much larger part of our portfolio, we are very, very keen that we can continue to add, and that's why this Right Bite deal happened, where we have Max Protein, which is really helping us build and play the protein part very well. We do believe there are spaces like VMS, which we could increase. There are some health food opportunities we are looking at. There are also skincare spaces. And third, which we look at is increasing our footprint beyond India, which will help us play a much larger game. And last, fourth, which I would say that we evaluate is from a D2C or a online space, which gives us a big opportunity. So if you pull this together, we're looking for deals which make these four, which tick at least 1 to 2 of these boxes. Right now, we've recovered all the cash that we had deployed for Max Protein, and that should be good for us. Further deals, largely, we will try to do without any external input. Will either be self-generating cash or debt.
Take that point. And finally, before we let you go, Tarun, what's the long-term aspiration of the company? 5,000 and 7,000 crore revenue by when?
That's mathematics. In a continuous basis, without accounting for any acquisitions, I think a good double-digit teens growth should take us 4 to 5 years. Add to some exciting acquisitions that we are evaluating most of the time, it could get much faster. But no specific time frame for me to share. Organically, we obviously have an inside plan, but could happen much faster if 1 or 2 of those deals really shape out.
All right, so the street will read that as 3 to 4 years, 5,000 crores is something that you get at with close to 17 to 18% margins. That's your aspiration. The funds which are buying into the company are hoping for that to happen as well. We take a short break, come back, get you more opinion on the market on CNBC-TV18. Stay with us.
Welcome back. Well, for the Bank Nifty is just about flat, trading with a little bit of a negative bias. But what seems to stand out today is definitely the mid-cap index, which is going from strength to strength. So up around 0.5% currently for the mid-cap index. And we have the advanced decline ratio as well, which is managing to stay on the positive side. So we have 2,300 stocks advancing to around 1,700 stocks declining on the Bombay Stock Exchange. Just keep your eye out on the small caps as well, because that is up around 0.7% at this point in time. So that's outperforming even the mid caps. Well, on that note, it's a wrap on Halftime Report. Stay tuned. Business Lunch up next.
Stocks take a breather after strong gains in the past week. Realty, metals and financials drag even as industrials and healthcare eke out gains. The government is set to invite financial bids for IDBI Bank soon as talks on the share purchase agreement with potential bidders near a close. The move comes on the back of Finance Minister Nirmala Sitharaman indicating a completion of the deal in FY26. Torrent Pharma will buy out KKR's 46% stake and make an offer to employees and minority stakeholders of JB Chem in an over rupees 19,000 crore deal, followed by a merger of the company. Analysts give the fairly valued deal a thumbs up. The deadline for IndusInd Bank to send its recommendations for the CEO position to RBI ends today. Sources tell CNBC-TV18 Rajiv Anand of Axis Bank, Rahul Shukla of HDFC Bank and Anup Saha of Bajaj Finance may be named in the list. Hope of an early US trade deal rises after Donald Trump says a very big deal with India may be possible soon. Indian trade negotiators visiting the US extend their stay, giving this hope more legs. Well, the Nifty is at 25,500. It has given up most of its gains seen this morning, and the markets are taking a bit of a breather after 4 consecutive sessions of gains. The markets did attempt to post a modest recovery, but they're back at the day's lowest point. At the broader end of the market, though, that is doing quite well for itself. Take a look at the advance decline ratio. It is largely in favor of the advances, but since morning the gap has been narrowing, and that is reflecting in the mid cap as well as the small cap index. The mid cap as well as the small cap index both are doing quite well, although we're seeing some bit of cool off from the day's highest point. As far as specific sectors are concerned, it's the PSU banks that are leading the gains. Look at the Bank of Maharashtra, up almost 4%. PNB, Union Bank, all of these counters are trading with gains upwards of almost 3%. But Nifty Realty was the top sectoral loser last week. It continues to be the, it continues to decline in trade today, down almost 0.5%. Let's also look at some specific stocks then. Take a look at Hiranba Industries. Big moves out here. Last I checked, the stock was up almost 13%. Alembic Pharma also seeing very good gains. But, let's move on and let's talk about Mega Pharma deal between Torrent Pharma and JB Chemicals and Pharma. What are the contours of the deal? How will the deal impact the business of both? And what are brokerages making of this deal? Ikta is standing by the wall to tell us more. Ikta?
Well, yes, Torrent Pharma has announced a 2-phase acquisition of JB Chemicals from KKR, marking one of the largest deals in India's branded pharma space since possibly the Ranbaxy-Sun merger. Torrent will first acquire 46.39% stake for around 11,917 crores and may pick up an additional 2.8% from JB Chemical employees at around 1,600 rupees per share. An open offer for 26% follows at around 1,639 rupees per share, with the total size of the acquisition for Torrent possibly going up to as much as 19,480 odd crores. Now, in the second phase, the companies will merge, with JB shareholders receiving 51 Torrent shares for every 100 held. Now, the deal values JB Chemicals at around 25,689 crores, an 11% discount to its closing price ahead of the deal. With the JB Chemicals acquisition, Torrent Pharma is now poised to rise from the 6th to the 4th largest pharma company in India. The deal, in fact, is expected to boost its domestic revenues by 35%, surpassing 8,600 crores based on FY25 numbers. Torrent will strengthen its dominance in cardiac and gastro segments, gaining top brands like cardiac drug Silicar with sales of 785 crores and gastro drug Metrogil at around 342 crores in terms of a size of a drug. It also secures entry into ophthalmology and expands its footprint in the global CDMO space. Torrent Pharma may in fact fund the JB Chemicals acquisition through a mix of internal accruals, debt and equity via QIP. It could take on as much as 10,000 to 12,500 crores of debt, pushing the combined net debt to around 14,500 crores and a net debt to EBITDA to around 3 times on an FY25 basis, according to analysts. However, analysts including DAM Capital are not overly concerned. They point to Torrent's steady free cash flows and believe a 2 times EV to EBITDA leverage is reasonable and the debt could be pared down in 3 to 4 years. Now, while JB Chemicals currently operates at a lower EBITDA margin than Torrent Pharma, analysts are not overly concerned about that either. Torrent has had a strong track record of cost rationalization as seen in its past acquisitions of Elder, Unichem and Curatio, which saw margin expansions within 1 to 2 years. While we could see near-term dilution, analysts believe the combined entity could target EBITDA margins of 34 to 35% over the next 3 to 4 years. Lastly, what are the brokerages saying? IIFL recommends JB shareholders should avoid tendering in the open offer and wait to swap their shares in the merger. Nomura expects the adjusted EPS accretion in the mid-single to low double digits. They maintain a neutral rating with a target price of 3580. HSBC expects the deal to be 3% accretive to FY27 estimated EPS estimates. They retain a buy with a target price of 3,775.
Well, thank you so much, Ekta, for a comprehensive roundup of that development. But moving on, the government will soon be inviting financial bids for IDBI Bank. Sapna Das joins in with the latest on this.
Absolutely. So this is going to be a completion of a long journey. If you can recall, way back in October 2022 was the first instance when the preliminary bids for IDBI Bank disinvestment had been called. And we are now in 2025. So what we're clearly given to understand is that probably the government is close to, agreeing or rather finalizing the share purchase agreement with potential bidders for IDBI Bank stake sale. And once that important milestone has been crossed, the next stage, of course, would be calling for the financial bids, and we are given to understand that there may not be too much of a gap between both the exercises. Of course, approval from the ministerial panel, which is headed by the finance minister herself, that will be sought, and the finance minister herself has already indicated that the government expects to close the IDBI deal in FY26. So my sense is that before H1 ends, I think the government will be in a position to call for financial bids, if not sooner than that.
Thanks for that, Sapna. That explains why the stock is up almost 2.6%. But moving on from one bank to another, today is the last day for IndusInd Bank to submit potential CEO names as per RBI's June 30th deadline. Ritu joins us with more details. Ritu, what do you have for us?
Well, yes, June 30th is the deadline that was given by the Reserve Bank of India to the board of IndusInd Bank to submit the list of potential CEO candidates that we've been reporting on. And, there are three that the board actively considered and we believe has submitted to the RBI. This includes Rajiv Anand from Axis Bank, Anup Saha from Bajaj Finance, and Rahul Shukla of HDFC Bank, all three candidates with about 3 decades or more of experience in this field. Now, Rajiv Anand, currently the Deputy MD of Axis Bank, who is overseeing the wholesale and digital banking functions, is one of the strongest contenders, as what we've been given to understand. Importantly, he's already announced his retirement from the bank and is set to step down in early August. That would make him available to take charge at IndusInd if selected. And our sources do point out that he's very much the #1 man for the job that, the regulator's also looking at. Anup Saha, who was recently elevated to the position of Managing Director at Bajaj Finance, is also seen as a strong contender. And the third candidate is Rahul Shukla of HDFC Bank, who earlier oversaw the corporate book and then later commercial and rural banking, but is currently on a sabbatical from HDFC Bank. Now, we understand the board has been engaged with RBI on these names informally for the past few weeks. And given the extraordinary situation at the bank with the leadership vacuum at the moment, the regulator is also likely to fast-track this approval process.
Thanks for that, Ritu. But do stay on. Now, on to the latest in the JP Associates resolution then. Sources are saying 6 suitors submit bids, but only 5 qualify. Ritu, can you give us the details?
Well, yes, as we reported last week, there are 6 suitors that had come forward. However, one of them has been disqualified, and that leaves 5 suitors in the fray for JP Associates. And these are heavyweights like the Adani Group, Vedanta Group, Dalmia Bharat, and Jindal Power from the Naveen Jindal Group. You also have listed infrastructure player PNC Infratech that is also in the fray. Now, our sources indicate while Suraksha Group controlled JP Infratech had submitted a bid, it has been disqualified because it did not submit the deposit amount. Now, while the financial terms of these offers have not been disclosed yet, some of the bankers we've been speaking to say that that 12,000 crore rupee offer that was earlier made by the National Asset Reconstruction Company to acquire the stress loans of JP JP Associates from banks could be used as a benchmark by the bidders, and some expect that the offers that come in will be lower than this 12,000 crores given all the litigation that is going around the company's prized land assets in Noida. Remember, there's claims of more than 57,000 crores, so an offer like that would imply a steep haircut for lenders. So we'll have to see how the bidding unfolds, especially with these kind of high-profile corporate names in the mix, but hopefully a step closer to resolution for what has been now an 8-year-long process.
Well, hopefully a step closer indeed. And Ritu, thank you so much for joining us with all of those details. But as we slip into a very short break, remember to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back. You're watching Business Lunch on CNBC TV18. As we wrap on the first half of the year, Hormas joins us to break down how the benchmarks and the broader market fared in 2025 thus far. Hormas, take it away.
More action than an action film, more drama than a drama film. I guess the markets have seen it all in the first 6 months of the year so far. And it is after making new lows for the year, building onto that recovery, is when the Nifty now stands 8.5% higher at the first half of 2025. And this is after an 18% recovery that the index has seen from the tariff lows that it had made on the 7th of April. The Nifty Bank, which is already at new highs, is up 13% so far this year. And this this tinge of green that you see in the mid cap and the small cap index has come on the back of a near 30% recovery that both these indices have seen from the lows that they made earlier in the year. So now, which are the common top performers on the Nifty so far in this year? Well, BEL, Bajaj Finance, the first 6 months though belong to the life insurance companies. Both SBI Life and HDFC Life are up over 30% each. If you take a look at the list of the underperformers, it is the IT stocks that are forming a common theme here, be it Infosys, TCS, Wipro, all of them are part of the list. So is Trent and so is IndusInd Bank, despite a 35 to 40% recovery from the 52-week lows. You take a look at the mid-cap index, Solar Industries, which has been the talk of the town in recent times, is up 80% in the first 6 months, as is Bharat Dynamics. BSE is at new highs, but L&T Finance is up 50% as well this year. What is down 50% this year, though, is Ola Electric, and that stock is among the top underperformers on the mid-cap index, with names like Oracle Financial, Kalyan Jewellers, Voltas as well. And a common theme across the benchmarks and the broader markets is defense, and Garden Reach Shipbuilders is the top performer on the small cap index, returns of nearly 90%. Narayana Health was making new highs as of last week, is up 80% as well. Godfrey Phillips, Redington and Naveen Fluorine, after a slew of brokerage positive commentary, is up 50% as well. And among the underperformers, well, Brainbees, Natco Pharma, Anant Raj, all of these names seeing losses of anywhere between 35 to 40%. Well, it's been an action-packed first half of 2025, and the bulls would definitely be hoping that the second half may be less action-packed, but it definitely delivers the returns as we have seen in the last few months.
Well, fingers crossed for that, Hormaz. But moving on then, earlier we spoke with Mahesh Patil, Chief Investment Officer at Aditya Birla Sun Life AMC, on the market outlook and his top sectoral bets. Let's listen in.
Overall, I think the liquidity flow into the markets is also improving. We've seen FIs slowly starting to come back. Domestic flows have been steady. And I think valuations were reasonable. I mean, markets, after the correction, what we saw around 6-9 months back, a lot of stocks had come down to decent level. We've seen now interest coming back, not only into the frontline names. I mean, the large caps were always looking good on a valuation perspective, but even the broader market, right, the mid cap and small cap have seen a good recovery. Although I would say that it is more stock specific in the mid and small cap. Not everything is moved up, but clearly, I think the confidence is coming back. Would be preference would be more towards domestic plays, because global uncertainty, I think, on the tariff front, while we've seen that, I think that might still prevail for some time. So domestic plays, especially, as I said, the focused on the rural consumption. So we've seen that even some of these agrochemical companies are likely to report very good numbers in this quarter, because volume growth has been strong. But as we move forward, right, we should see some of the discretionary consumption, especially as we move into the festive season, should do well. Rate cuts have happened, and we've seen the transmission of that happening pretty fast, and that should help some of the interest rate plays. Especially, say, if you're looking at banking and financial, then the financial services, the NBFCs in particular, I think should see a better growth not only, but also improvement in the margins over there. I mean, the IT sector was the first one to underperform, right, earlier because of global concerns. And I think on that front, I think US, where you were expecting a recession, the probability was much higher around, say, 3-4 months back. Now that has receded, and looks like, at least the commentary also from the IT companies, is that the worst seems to be behind. That doesn't mean that you will see a sharp recovery over there in terms of volume growth. It will be still slow and tepid. But I think this is a sector where I think overall stability, I think, would be there. I think the downgrade cycle seems to be behind over there. Also, the cross-currency impact also could be slightly positive, at least in this quarter.
Well, moving on then, on the back of the easing tensions in West Asia, we spoke to A.S. Sane, chairman of Indian Oil Corporation, and asked him about the update on their Nagapattinam project. Listen in to what he had to say.
The Nagapattinam refinery is, we have gone back on the drawing board because the viability of that refinery was not becoming very good. So now we have gone back on the drawing board, and we are putting into more and more petrochemicals into it. So it might change the financial outlay, but it will be more of a petrochemical plant now going forward instead of a pure refinery play. So we are reconsidering our configuration, and again we will go back to our board for taking approval for that and then move forward.
Well, that was the management of IOC, the stock trading with a cut of 0.3%. But as we slip into a very short break, here is some good news for our viewers. India's business news leader is now only a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen. Welcome back. You're watching Business Lunch on CNBC TV18. Back in Washington, the president addressed another looming deadline. Trump said he's unlikely to extend the July 9 trade deadline he set for countries to reach new deals with the U.S. to avoid higher tariffs.
Is that July 9th date a set for tariffs to snap back, or could there be a...
We can do whatever we want. We could extend it. We could make it shorter. I'd like to make it shorter. I'd like to just send letters out to everybody. Congratulations, you're paying 25%.
Meanwhile, Trump has said he is cutting off trade talks with Canada immediately as the country looks to start enforcing a tax policy targeting big tech companies. The latest move comes as neighboring nations had been working to agree a trade deal by mid-July. Both countries have imposed tariffs on each other's goods after Trump sparked a trade war earlier this year and threatened to annex Canada using economic force. Canada's Prime Minister Mark Carney said complex negotiations will continue in the best interest of the Canadians. Let's listen in.
Any reaction to the news you put on?
No, look, we'll continue to conduct these complex negotiations in the best interest of Canadians. It's a negotiation.
Well, Senate Republicans pushed U.S. President Donald Trump's tax cut and spending bill forward during a marathon weekend session on Saturday. It comes even as Congressional Budget Office estimates that the bill will add over $3 trillion to the U.S. deficit. NBC's Ryan Nobles joins us with the details.
Democrats forcing the Senate clerk to spend nearly 16 hours reading every word of what President Donald Trump has dubbed his big, beautiful bill.
139L, the following new.
That bill could add more than $3 trillion to the deficit over the next 10 years. The GOP wants to overhaul social programs like SNAP, also known as food stamps, and Medicaid. The cuts to Medicaid are what led North Carolina Republican Senator Tom Tillis to vote against moving the bill forward, prompting threats from President Trump to meet with primary challengers. Then today, in a shocking announcement, Tillis announced he would not seek re-election and slammed gridlock in Washington. The Senate's bill would tweak the way states receive Medicaid funds, reducing the amount they take in via a special tax, instead creating a $25 billion fund to help support rural hospitals. The new funding formula leaving people like Sierra Matthews from Missouri worried her hospital could shut down.
If we take that away from a small rural area already, is that another 2-hour drive? Is that a 3-hour drive just to see a doctor?
Democrats argue the bill's growth is out of control.
This bill stinks. It's a moral abomination. Everybody that learns about it hates it.
It's filled with special carve-outs, like $85 million to move the retired Space Shuttle Discovery from a museum in Virginia to Texas, the creation of a $1,000 Trump saving account for all newborns, and requiring a $100 fee for anyone applying for asylum.
On to updates from the Russia-Ukraine war. A Ukrainian F-16 fighter pilot was killed while repelling a Russian attack. This comes as Moscow intensifies overnight air barrages in the 4th year of the war. Take a look at this report.
A Ukrainian F-16 fighter pilot was killed while repelling a Russian attack overnight that involved hundreds of drones, cruise and ballistic missiles, Ukrainian authorities said on Sunday. In Kiev, families huddled in metro stations for shelter after air raid sirens rang out. Machine gun fire and explosions were heard across the capital and in the western city of Lviv, where such attacks are less common. Russia has intensified nighttime air barrages in recent weeks, causing widespread damage and killing many civilians. The Ukrainian Air Force said the pilot did everything he could and flew the jet away from a settlement but did not have time to eject. Kiev has not revealed how many F-16s it operates, but they have become a central and heavily used part of Ukraine's air defences. It has now lost 3 since it began operating the US-made jets last year. President Volodymyr Zelensky called for more support from Western allies to bolster Ukraine's air defences after the attack. Under President Donald Trump, Washington has not committed to new military aid for Ukraine. Trump said he was considering a Ukrainian request for more Patriot missile batteries after he met Zelensky at a NATO summit last Wednesday.
Let's move on then. A reactor explosion ripped through a pharmaceutical plant in Telangana. At least 2 workers are feared to be killed and 15 others injured, according to PTI. The police, fire services and other personnel launched rescue and relief operations. Ambulances were also seen at the spot to shift the injured to hospitals. The injured were admitted to government and private hospitals. The conditions of some of the injured is stated to be critical. Well, that's all we have on this edition of Business Lunch. Don't go anywhere because Midcap Radar comes up next.
Good afternoon. Welcome to Midcap Radar, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra, and with me is Hormaz Patakia. Hormaz, some more the decline is what we are seeing in the markets right now. The midcaps, though, they continue to outperform.
They are continuing to outperform, and slight bit of losses being extended. The midcap index is still in the green, and that's possibly the only saving grace. We need a lot to cover ground on over the next 30 minutes. So these are the top headlines at 1:30 this afternoon. Stocks are taking a breather after a strong performance in the week gone by. Realty, metals and FMCG are the big drags, even as PSU banks are the outperformers. The midcap index too is holding on to gains.
Shares of Karnataka Bank fall over 5% after lender's managing director and CEO Harihar Sharma, along with executive director Shekhar Rao, both quit, citing personal reasons.
Alembic Pharma shares are up over 13% after securing a US FDA approval for a drug that can be used in the treatment of ovarian cancer and other such disorders.
Hind Rectifiers gains after bagging orders worth 220 crore rupees from Indian Railways. The stock is up over 2%. Okay, those are the top headlines. We'll discuss them in greater detail through the course of the show. For the markets right now, as we were pointing out, Nifty has extended those losses. There was a wee bit of recovery at around 11:30, but that has been sold into almost near the day's low. So it's a 125 point cut that we are looking at. The Bank Nifty down 0.1%. We have Sensex too, which is down around 0.5%. What has led to this fall from the highs? Something like a Kotak Mahindra Bank. There's Reliance as well, which is at the day's low. That's of course all about the large caps, and on this show we usually speak about the mid caps because that continues to do well. It is in the green, that particular index today. So this is our segment, mid cap movers. Hormaz is now joining us at the wall. Tell us about the mid caps that are moving around in trade, Hormaz.
Some saving grace. The mid cap index still holding on to some of the gains, but considering the fact that the screen is predominantly red, we'll start off with the losers then within the broader markets, and there are plenty of them. You look at Narayana Health, until last week was making new highs, so some profit booking coming in at higher levels. JK Cement, Home First Finance too at the lows of the day, losses of anywhere between 4 to 5%. The newsmakers too predominantly have seen a negative reaction this afternoon. JB Chemicals after the deal is down 6.5%. Karnataka Bank after the top brass quitting down 5.5%. Slight recovery from the lows. Jyoti CNC of course after the block deal. Alembic Pharma at one point was up 13%, still holding on to gains of around 9%. PSU banks are the outperformers today, and every single stock in the PSU Bank index trades with gains anywhere between 3 to 4% among the top movers like Bank of Maharashtra and PNB. Some stocks that are doing well on the volumes front, and there are some other names that are bucking the trend. Look at Aavas Financiers is up 6%. Raymond Lifestyles is up 14.5% as we speak, and SKF India too trading with gains of around 4% this afternoon. And lastly, a pocket that has also done well today despite the struggles that the index is facing are the capital market names. Look at CDSL at the highs of the day, Aditya Birla Sun Life, AMC also at the highs of the day, and as is Motilal Oswal, gains of anywhere between 3 to 6% zonal.
Okay, all right. So that's what's happening with the mid-cap space. But it's a good time to get a technical check on the markets. Let's welcome Ruchit Jain from Motilal Oswal Financial Services for just that. Ruchit, good afternoon. Thank you so much for joining in. Well, you know, this cut has come in after a stellar rally that we have seen as well. But do you think there could be further pressure from the levels?
Yeah, very good afternoon, Sonal. Very good afternoon, Hormaz. No, it seems to be a corrective phase within an uptrend because we have not seen that broader markets or the market breadth getting deteriorated in today's down move. You can see the advance decline still in favor of the advances in spite of Nifty down by about 120-25 points. So since last few trading sessions, we have already seen a run-up. There could be some cool-off, but does not vary much on the broader market fronts. I think on the pullback moves, any dip towards 25,400, 25,350 should get bought into. So it remains a buy on dip, and this is just a corrective dip within an uptrend, it seems.
And what would your individual technical picks be, Ruchit?
Yeah, so a couple of recommendations on the long side. One is from the PSU banking space. Certainly, if you look at the Nifty PSU Bank Index, and it is on the verge of a breakout from its recent consolidation phase, within which the leadership clearly can be seen from the large cap stock SBI. So SBI, where we have seen a good amount of consolidation over last few months, is on the verge of a breakout. Today's up move supported by good volumes is the initial signs of that. So short-term traders can go long in SBI with stop below 800 for potential targets around 855. And we are quite positive on healthcare space as a whole since last few weeks, within which Apollo Hospitals technically looks quite positive. We have already seen a corrective phase in the stock. The price of moves are getting supported by good volumes now, whereas in between corrections which are there, we are not witnessing any volume-based selling happening over there. So for a positional perspective, one can go long on Apollo Hospitals as well, with stop loss below 7,000 for potential targets around 7,600.
Two large cap recommendations from Ruchit. Thank you for joining in with your views on the index and on specific stock ideas as well. Take a short break here on Midcap Radar, but remember to tune in to the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at noon for the Global Reset, at 1 p.m. for the Big C, and the Global Lens at 8:30 this evening. Take a short break. Back on the other side. Welcome back, and still 130 points lower on the index as we speak. Almost a 500-point cut now on the Sensex. But of course, Raymond Lifestyles is the one that is continuing to move higher, as we just highlighted a few minutes ago. 13.5% higher on the stock, and not just that, even the parent company Raymond is doing fairly well for itself. 12% higher on that stock as well. So keep the Raymond Group stocks on your radar. Of course, Raymond Realty will be listing tomorrow, so we will keep that in mind as well. Of course, some of the other movers on the downside though, SBI Cards is one of them, 3% lower on that stock. BLS International, that too is trading with cuts of around 2.5%. 2%. And some of the other movers, then Go Digit is down 2%, as is Devyani International. So predominantly a stock-specific move that you're seeing within the broader market, Sonal, although the index continues to move in a narrow range.
That's been the case, right? So that's a very stock-specific market today. At the headline level, of course, we are seeing some pressure. But, you know, one space that has been in focus, and that's been the fertilizer segment. Reports have suggested that China has halted specialty fertilizers export to India. So we'll discuss that in greater detail with an analyst in just a bit. But as I've been pointing out, it's a stock-specific market. And you are looking out for, you know, Minda, Hormaz.
You know, positive initiation that is coming from CLSA on Uno Minda. And the stock has done fairly well over the last month or so. It's up around 10-12% over the last month, although not doing much today. But initiation with an outperform recommendation, a price target of 1,300 rupees. And they are saying that even in a market like this, it is shown very limited cyclicality when it comes to the auto ancillary space. That is because of the diversified product and customer base that the company has. Now, they are expecting Uno Minda's margins to see a recovery, and that is because of an overall revival that the industry has seen, the expansion that it is taking place, the scale that it is going higher, premiumization coming into play, and a product mix that is getting better, which could aid margins for Uno Minda going forward. And as a result of which, they are expecting the earnings for the company to double or nearly double over the next 3 years, that is by FY28. And they are seeing Uno Minda as a high growth compounding play with a lean balance sheet, and they are not factoring in that their free cash flow that they are generating, that will be reinvested back for further M&A activity, and that, according to them, is an upside risk, is what CLSA has said. So a positive note coming in on Uno Minda, a 1,300 rupee price target, so a fairly decent upside even from current levels.
Yes, but the stock refuses to take note of that particular note, so we'll watch out for that one. But it's time to slip into a break. When we do that, here's some good news for our viewers. India's business news leaders now click away, introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen. Welcome back. You're still tuned into Midcap Radar. Let's shift focus to the fertilizer segment now. We were talking about reports suggesting that China has halted specialty fertilizer exports to India. In fact, the report suggested that no shipments have been cleared for over 2 months, despite there not being an official export ban. Prashant Biani, who is the Vice President of Institutional Equity at Elara Securities, joins us now to discuss more. Prashant, good afternoon. Thank you so much for joining in. First, if you can explain the difference between these specialty fertilizers versus the generic ones, if they are being used at a high volumes in the industry as well, and how has this move impacted the industry so far?
So specialty fertilizers are different than bulk fertilizers. Specialty fertilizers are used in friction of quantity in compared to the quantum in which bulk fertilizers are being consumed. So that way, these are not major fertilizer as far as fertilizer imports are concerned. These fertilizers are primarily used to increase the yields of the crops. So that way, this is the difference between bulk and specialty fertilizers. Most of the listed companies in the space are primarily dealing in bulk fertilizers like urea and some phosphatic micronutrients, and these specialty fertilizers are very minuscule as far as the overall percentage of top line is concerned.
Prashant, good afternoon. Thank you for joining in. So, if at all there is an impact of this move on Indian listed companies, you mentioned that they trade mainly in bulk fertilizers more than the specialty ones. But for those who do have a minuscule exposure, do you see an impact, or there are alternative sources from where they can offset any potential loss that comes in from this move from China?
See, part of the impact was already there on the day when this news came. Fertilizer stocks were down on that day. And there are several sources from where you can have these fertilizers. Fertilizers in general globally, Middle East, North Africa are also major markets, not only China. So North Africa, Middle East, and Russia are markets where we can have our supplies from. It is just the fact that pricing from here on for these fertilizers can be a bit higher. But till the time we have availability of them, I don't see a major challenge. In case there is a question of availability as well, then for some category of fertilizers, some category of specialty fertilizers, even nano fertilizer can be used to some extent to compensate for the yield.
Okay.
So I don't see a major impact of this that China stopping these fertilizers will have on the Indian companies.
Okay, that is good to know. Just on the bulk fertilizer bit, Prashant, we do import other raw materials as well for even bulk fertilizers. I assume ammonia, and there are other raw materials as well. Has there been any impact on the supply chain because of the global geopolitical crisis that we've been seeing, or all is good for the industry right now?
No, supply chain concerns have been there, and that has led to increase in price. So sulfur prices have gone up to around $300 versus $100 in October last year. And the same we have seen in phosphatic fertilizers as well. For example, DAP prices, I think right now are between $700 to $740, which used to be around $520 to $540 a quarter back. So phosphatic fertilizer space has seen a bit of price increase because of all this. But availability is not a challenge as of now. This last leg of increase in phosphatic price has been happening because of export ban from China of DAP as well. So the bans from China is not questioning the availability, but it is giving a reason for the suppliers to jack up the price.
What about this quarter, Prashant? How is this sector likely to do in the quarter that will be reporting results in just a few days from now? So which are some of the names that are likely to do well, some of them that are not likely to do well? What's your order of preference here within this sector?
See, structurally, I think within the fertilizer space, we like phosphatic fertilizer universe, which is Coromandel and Paradeep phosphates. Both of them offer a very good opportunity in terms of import replacement of fertilizers is concerned. Both of them are expanding capacity, not only in finished product, but backward integration space as well. So both these stocks we like from a structural view. Of late, we have seen a good run up in the stock price. So in the near term, we are not expecting anything significant from these stocks. And as far as the quarter is concerned, we expect them to report mid-single to high single-digit top-line growth. But because of a good backward integration benefit, I think EBITDA growth should be much better from these companies.
Got it. Prashant, last question before we let you go. Which are the top picks and what's the rating on them?
So we have a rating. We used to have a rating of accumulate on Coromandel, but now I think after the recent run-up, we will revisit our rating around the results time. But structurally, we like both these stocks, as I mentioned. Both these stocks offer very good earning potential, and from a returns perspective, also over the next 3 to 5 years, as both these companies are aggressively expanding capacity across all segments.
All right, Prashant, thank you for sparing time and joining us today with your views on this move that has come in on the specialty fertilizer curbs that China has implemented. We're talking about Zydus Wellness now. We spoke to the management just a few minutes earlier on the road ahead for their business, and they said that they are hopeful to make up for the lost sales in the first quarter over the next 3. Listen to excerpts of that conversation.
I think this summer's been brutal for anyone who has a summer business, and we have not one but 2 brands, both Glucon-D and Isel, which rely heavily on this. So it's actually gone worse, and typically in between rain, you're prepared and you do expect some bit of surprises, but there it has been a continuous rain throughout the quarter, throughout the last few months. So obviously it has impacted a lot of our momentum in these 2 brands. We hope that the remaining 3 quarters will hold us in good stead and help us catch up on the numbers that we wish to do. Rural has been 3 to 4%, as reported by all syndicated data, been growing faster than the urban. Of course, urban gets compensated because when I look at sources like Nielsen, they do not cover the quick commerce, so it gets compensated. But from a consistency and a general trade point of view, rural has been always leading. Even our distribution is substantially, disproportionate to the share of sales. So 25% kind of sales coming from revenue coming from rural, but almost 50-50 share between equivalent presence in our distribution for rural and urban. Clearly, M&A has been part of the strategy at Zydus Group and Zydus Wellness itself. It allows us to one-side scale, which is what Heinz deal did, but also play in spaces that we want to, which is food and nutrition on one side and skincare on the other side. We do believe there are spaces where we can build further and add to the our portfolio in the right direction.
All right, that's the word coming in from Zydus Wellness, but it's time to talk about the mega pharma deal between Torrent Pharma and JB Chemicals and Pharma. What are the contours of the deal? How will the deal impact the business of both? And what are the brokerages making of the deal? Ekta is standing by the wall to tell us all this and more. Over to you, Ekta.
Well, yes, Torrent Pharma has announced a 2-phase acquisition of JB Chemicals from KKR, marking one of the largest deals in India's branded pharma space since possibly the Ranbaxy-Sun merger. Torrent will first acquire 46.39% stake for around 11,917 crores and may pick up an additional 2.8% from JB Chemical employees at around 1,600 rupees per share. An open offer for 26% follows at around 1,639 rupees per share, with the total size of the acquisition for Torrent possibly going up to as much as 19,480 odd crores. Now, in the second phase, the companies will merge, with JB shareholders receiving 51 Torrent shares for every 100 held. Now, the deal values JB Chemicals at around 25,689 crores, an 11% discount to its closing price ahead of the deal. With the JB Chemicals acquisition, Torrent Pharma is now poised to rise from the 6th to the 4th largest pharma company in India. The deal, in fact, is expected to boost its domestic revenues by 35%, surpassing 8,600 crores based on FY25 numbers. Torrent will strengthen its dominance in cardiac and gastro segments, gaining top brands like cardiac drug Silicar with sales of 785 crores and gastro drug Metrogyl at around 342 crores in terms of a size of a drug. It also secures entry into ophthalmology and expands its footprint in the global CDMO space. Torrent Pharma may in fact fund the JB Chemicals acquisition through a mix of internal accruals, debt and equity via QIP. It could take on as much as 10,000 to 12,500 crores of debt, pushing the combined net debt to around 14,500 crores and a net debt to EBITDA to around 3 times on an FY25 basis, according to analysts. However, analysts including DAM Capital are not overly concerned. They point to Torrent's steady free cash flows and believe a 2 times EV to EBITDA leverage is reasonable and the debt could be paid down in 3 to 4 years. Now, while JB Chemicals currently operates at a lower EBITDA margin than Torrent Pharma, analysts are not overly concerned about that either. Torrent has had a strong track record of cost rationalization as seen in its past acquisitions of Elder, Unichem and Curatio, which saw margin expansions within 1 to 2 years. While we could see near-term dilution, analysts believe the combined entity could target EBITDA margins of 34 to 35% over the next 3 to 4 years. Lastly, what are the brokerages saying? IIFL recommends JB shareholders should avoid tendering in the open offer and wait to swap their shares in the merger. Nomura expects the adjusted EPS accretion in the mid-single to low double digits. They maintain a neutral rating with a target price of 3580. HSBC expects the deal to be 3% accretive to FY27 estimated EPS estimates. They retain a buy with a target price of 3,775.
Thanks a lot for that, Ekta. We take your leave on this edition of Midcap Radar. Just as we do that, the Nifty has now slipped below the mark of 25,500, 150 points down now on the index. The Sensex too down 550 points. Among the top losers on the index that are the big drags in today's session, Tata Consumer is one of them, Kotak Mahindra Bank is the other, and the auto names, Hero MotoCorp, Maruti Suzuki and the likes are also proving to be a drag on the index, and of course HDFC and ICICI Bank too, the index heavyweights, as is Reliance Industries, contributing to the downside. We take a leave on this edition of Midcap Radar from Zonal, me and the team that put this show together. Thank you so much for watching. Your stocks on the other side.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in as always. Now, markets, they have come off the day's highest point, actually trading in the red. Do not forget, last week was a very good week for the markets, right? We did see that run-up coming in, and today we're seeing a decline coming in for the markets. So Nifty 50 as of now is trading at the day's lowest point. Let's pull up the Nifty Bank as well, because that also is seeing a bit of a subdued performance. So that will be something that we'll be watching out for. Nifty Bank is also down in today's trading session, and 0.2% of decline. I want to see what's the broader end of the market doing. You know, is it managing to perform better than the benchmark indices? Nifty Midcap was managing to hold on to some bit of a green. So yes, Nifty Midcap as of now also is holding on to those morning sort of gains that we've seen. 0.4% of gain for the Nifty Midcap. Small cap, some bit of a decline has come in the last 1 hour or so. 0.3% of gain is still what the broader end of the market is managing to hold on to. So surely broader markets doing better than the benchmark indices, what we're watching out for. FMCG, metals, autos among the top sectoral losers. But this is a show where we solve all your stock-related queries, and to do just that, today we have our experts joining with us, Somil Mehta, Head of Alternate Research, Capital Market, Mirai Asset Sharekhan, as well as Gaurang Shah, Senior Vice President at Geoteeth Financial Services, to answer all the stock-related queries. Somil, you know, before we get started, a bit of a decline coming in for the markets right today, but given the run-up that we've seen last week, is this just a bit of a tiny blip? And again, you know, it's going to be around this range now.
Hi, good afternoon to everyone. It's just a pause. I think we've seen a 1,000-point rally in the last 7 to 8 trading sessions. So I think it is just a pause. It's a very healthy pause, and I absolutely think that this is a buying opportunity. There are sectors which are doing really well. For Nifty, I think 25,400 would be the first support, and the second support would be around 25,300. So this is a small support zone for Nifty, and I think this will be a very good buying opportunity. On the upside, I'll be expecting 25,900 in the very short term, and the medium term outlook, I think all-time highs would be retested very soon. So buy on decline should be the strategy, and absolutely stay focused on sector specific. Right now, PSU banks are really doing good. Mid caps are doing good. So a sector specific should be the focus.
Sector specific should be the focus, and buying should be dips should be taken as a buying opportunity, is the word coming in right now for the markets. But let's get started with the stock related queries. The first query for today is coming from Aniket, who's writing to us from Navi Mumbai. He's holding 96 shares of Anantraj. This is at a price of 505 rupees per share. Wants to know the long term as well as the short-term outlook for Anantraj. Gaurang, good afternoon. What's your view coming in for Anantraj, both long-term as well as short-term?
Thank you so much for having me on the show. Good afternoon to you and to everyone. Unfortunately, we don't have coverage on Anantraj. I won't be able to give you any specifics. Sorry for this.
Okay, so okay. Anantraj, on the technical front then, Somil, you know, what are we watching out for? Last 6 months has seen a decline coming in. Right now, the viewer is not making any sort of that much of a loss or anything. But is it a bit of a worry given that there was a bit of a declining trend coming in?
Overall, if you see, Anantraj was in a very good long-term uptrend. And in the last 6 months, we've seen a good correction from the highs of 940 and the lows we've seen is 390. Very good correction, healthy correction. A small inverted head and shoulder pattern has broken on the upside. So I think I'm very positive in the medium-term outlook, in the very short term as well, because right now it is just trading about 200 daily exponential moving average, and it is being tested by 20 and 40 daily as well. So I think from here, support would be 533. That can be a stop loss as well for a positional call. And on the upside, 730 would be my target in the medium term outlook. Even in the short term, I think I'm positive, and it will be around 630. Targets would be around 630.
Okay, keeping an eye out on those levels for Anantraj on the technical front. Let's move on to the next query. Afcons Infra. Padma is writing to us from Andhra Pradesh. She's holding 32 shares of Afcon Infrastructure for 63 rupees as a buying price, currently making some bit of a loss here. She's saying, should she continue to hold this for 2 more years, and wants to know the prospects of the stock. Gaurang, your view coming in for Afcon Infrastructure. obviously fairly recent listing, right? November 2024. So what are we watching out for here?
So, Vinny, before I say that, all recommendations are part of our fundamental research team. My company, our company, Jujit, or I do not have any personal investments or any other financial interest or any conflict of interest. But we give similar recommendations to our clients. They might have their investment position. As far as Afcon Infra is concerned, I don't recollect even having a IPO note on this. But as a sectorial theme, Vinny, our sense is that this sector is going to do well because of the kind of spending that the government is doing, both at center and state level. Some of the companies that we have coverage in the infra space is NCC Limited and HG Infra and Engineering. PNC Infra is the third one where we have a coverage. So the sector looks good.
Okay, sector overall is good, and you've mentioned some of these other names that are there as well. Your view coming in on the technical front, Saumil, Afcon, I know there's not much charts here, but anything that you have seen?
At this point of time, it has been struggling. The stock has been struggling below 200 daily exponential moving average. So I don't see anything positive in the medium term outlook. Even in the short term, there's a triangle, a bearish triangle formation here, and I think it will be broken on the downside. The previous lows would be retested around 400 levels. So maybe that would be the right time to revisit this stock again. But however, overall infra space looks good. IRB infra, GMR, all of them look good. But this stock, especially medium term, negative, short term negative.
Medium and short term is a negative view coming in right now, given that there's a bit of a downtrend that's going on here. But sector-wise, both on the fundamental and the technical front, it's a thumbs up coming in for the infrastructure. There are infrastructure sector. There are other names that our experts mentioned as well. Let's move on to the next query for today. We have Bharti Dave, who's writing to us from Gujarat. She's holding 40 shares of Nestle India. Price is 2,640 rupees per share. Wants to know the 3-year horizon on the stock. Is it a good deal to continue to hold such a big FMCG name? What's your view coming in on this one, Gaurang? Nestle India, should you be continuing to hold this? Or, maybe look at some of these other names that are coming in here?
Well, I honestly, Vinny, I think big names are all the more reason why you should hold on to the FMCG segment. And primarily because, Vinny, we've seen good spread of monsoon. And for the FMCG sector, traction in terms of demand from semi-urban and rural India is going to be the driving force as far as the top line volume growth, as we call it, is concerned. And if you have a decent volume growth, but by default, you have a positive impact on your profitability and net bottom line. So we have a whole recommendation on Nestle India from a long-term point of view.
Okay, hold recommendation coming in for Nestle India on the fundamental front. On the technicals, Saumil, what are we watching out for? Last 1 year, stock is, it just remained in that range. Not much of a uptick, downtick that we're seeing here. So now what should we watch out for? 3-year time period is what the viewers were willing to hold on for.
Nestle has had a good correction in the last couple of years, I think. And now there was a basing out pattern in the last 3 to 4 months. This basing out pattern has broken on the upside. So I'm very positive on the stock now. I think the previous swing highs would be retested. 2770, 2780 would be my targets for the medium term outlook. In the very short term, there is a flag pattern forming just above the 200 daily exponential moving average, which is a good sign for the stock. Supports would be around 2346. That will be the stop loss in the medium term outlook, and the targets would be 2770.
Okay, keep an eye out on those levels over there for Nestle India. Next query for today is coming from Shishil Kamble, who's writing to us from Noida, holding 3,600 shares of REC at 400 rupees per share and 4,000 shares of PFC, and this is at a price of 430 rupees per share. So obviously it's around the buy price, right now, the stock as well. Wants to know the future prospect of REC as well as PFC. Gaurang, your view coming in. Dividend surely come in, but both these as a pair, should they continue to hold both of them for the long term?
Vinny, I think they were star performers, 23, 24. And the entire transmission, distribution, power project finance looks very, very positive in terms of whatever government has lined up in the next 3 to 5 years, whether it is conventional hydropower or whether it is to do with the new clean and green energy. We used to have coverage on PFC and REC some time back, but currently we don't have. One company that we cover in this space is Power Grid, which has almost about 70-75% of grid transmission network pan-India. So the sector is looking extremely promising. I think given the past performance, possibly the stocks are trading in some narrow range. Won't be able to give specific buy, sell and hold since we don't have a coverage on PFC and REC, Vinny.
Okay. View coming in on the sector over there from Gaurang. Saumil, your view, PFC and REC, what should we be doing with both these stocks? Should they continue to hold this? Should they look to now sell this, both these, and, you know, because it's around the buy price, or look to add some more? What would your suggestion be?
I think let's start with REC. REC is very range bound, extremely range bound, struggling to go about 200 daily exponential moving average. I think I will still expect this stock to keep consolidating within the range of 380 and 431. Once it closes above 431, I think that will be the right time to buy again. Or maybe you can hold as well because the medium-term outlook does not look very negative. So on the downside, 380 would be a very strong support. And on the upside, once it breaks out of this range, the next target would be around 500 levels in the medium-term outlook for REC. So hold for REC. For PFC, again, PFC is forming a triangle pattern, and this triangle pattern has, I'm expecting this to break on the upside. Definitely positive in the short term, in the medium term outlook, both. The stop loss would be around 410, very good risk reward ratio at this point of time. The targets would be around 475.
Okay, keep an eye out on those levels over there for PFC and REC. But on that note, you know, we're going to actually slip into a very short break. But viewers, remember to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back to Your Stocks on CNBC TV18. This is a show where we solve all your stock-related queries. And keeping it going with that, we have our experts, Saumil Mehta as well as Gaurang Shah, who are still with us. Let's move on to the next query, gentlemen. This is coming from Sai Babu, who's writing to us from Vijayawada. He's holding 100 shares of Aarti Industries. This is at a price of 700 rupees per share. He's been holding it for the last 4 years, now making considerable loss of this one. Other than that, he's also holding 100 shares of IndusInd Bank. This is at a price of 1,240 rupees per share. Gaurang, your view coming in for Aarti Industries as well as IndusInd Bank. Now, obviously, IndusInd Bank is inching closer to that finalizing the new CEO, giving those names coming in as well. Your thoughts on both these stocks? What should the viewer do? They're making a big loss on both these names. So should they continue to hold, wait for a recovery? Outlook?
Well, Vinny, I think he needs to put a strategy in place, to be very honest. Because when you're stuck in a stock for a long time at a level which is much, much over and above the current market price, if you have, first of all, investable amount, first of all, on both these stocks, on Aarti, we have an accumulate. On IndusInd Bank, we have a holder recommendation. Yes, whatever happened in the recent past with IndusInd Bank was something which should not have happened. The management should have been proactive in letting the authorities and market know as to what went wrong with the derivative losses of 1,950 crores. However, everything said and done, post that 3 forensic audits have happened, I believe, and we are maintaining a whole stance. So first of all, hold on to it. Would be a very prudent thing to average some at lower levels. See, from the levels of the lows of IndusInd Bank, it has come to almost about close to 875 or 900. Even Aarti Industries have come up from the lows. So not at current levels, but when you get dips in the market, you need to average. And this strategy would definitely prove to be prudent, because if you are a long-term investor, nothing is wrong. Yes, the stocks have corrected quite a bit because of the news flows and the numbers and the reported earnings. But long term, we remain positive on both, but you need to average at lower levels.
Okay. Long term remain positive on both, but need to average at lower levels. That's the word coming in there on the fundamentals. On the technicals, Saumil, what are we watching out for? Now, obviously, we had those issues that came in for IndusInd Bank, that sharp drop came in, and then we've seen some bit of that comeback coming in for IndusInd Bank. If things start easing off, everything falls into place. On the charts and technicals, IndusInd Bank, how is that looking? And Aarti Industries, last 1 year specifically, it's down 32%. Is this a time maybe to, add some bit more, given that their buying price is high? And what would you also concur with Gaurang?
I think Aarti Industries looks good to me in the medium-term outlook. However, the buying price should be only above 495, which is a multiple resistance zone for the stock. This stock has been taking resistance around those levels for a little while now. Once it goes above 495, it will be a great stock to hold on to. And 594, 595 would be the next target in the medium-term outlook. On the downside, Aarti Industry does not look like it will correct very sharply. Very strong support around 410, 418 levels. So that will be a strong level to go in and probably buy again. But yes, good stock in the medium-term outlook, positive for Aarti, not in the short term. For IndusInd Bank has been struggling to go about 200 daily exponential moving average for a very long time. It has been trading about 20 and 40 daily moving average, which is great. And it has just broken out of a small flag pattern. So bullish in the very short term. Targets would be around 960, 965 levels for short term. But in the medium term outlook, IndusInd Bank does not look good to me. It will probably start looking good only about 200 daily exponential moving average, which is above 965, 970 levels.
Okay, so short-term targets are given for IndusInd Bank. Aarti Industries' medium-term outlook is positive. That's the word coming in from Saumil. So keep an eye out on those levels over there that are mentioned by him as well for both Aarti as well as IndusInd Bank. Next query for today is coming from Manoj, who's writing to us from Hyderabad. He's holding 2,000 shares of Hind Copper, and this is at a price of 130 rupees per share. Obviously making a profit on this one right now. Wants to know if he can continue to hold the stock for a year more or exit at the current levels and book out the profits. Gaurang, your view for Hindustan Copper?
Well, so again, no specific coverage, but see, he's also asking for a switch, Vinny.
Yeah.
Something like an Hindalco would look augur well in case if he's got a long-term time horizon. So it's a switch from Hindustan Copper to Hindalco, subject to, of course, his view is to come out of it. Then he can switch on to Hindalco from a long-term point of view.
Okay, that's the view coming in on the long-term front. They're making a profit, and if you're looking to switch, then you can look at Hindalco also, which is a better option for the long-term, is Gaurang's view. Saumil, your view coming in for Hind Copper. Should they actually move out of the stock or, continue to hold this for a time period of 1 year?
To hold the stock. This is my current favorite in the middle spec. Looks great to me. A small consolidation has broken on the upside. If you see the last 3 to 4 months, a small basing out pattern has also broken on the upside, which is on the weekly charts. The momentum indicators on the higher degree time frame are buy side and looking great. On the upside, I think the next target would be around 330 in the medium term outlook. So hold is my suggestion. And on the downside, 240 would be the stop loss, a very strong support zone.
Okay, keep an eye out over there for Hindustan Copper in terms of levels, stop loss as well. Next query for today is on coming from actually Sampath Kumar, who's writing to us from Telangana. He's holding 130 shares of Coal India. This is at a price of 433 rupees per share, making a loss on Coal India. The other one is 30 shares of Dabur. This is at a price of 554 rupees per share, making a loss here as well. So long-term view, Dabur and Coal India. Gaurang, what should they be doing? They're making a loss on this one. Coal India does have that dividend factor that comes into play, but does it make sense holding the stock now?
So, very dividend for public sector companies are kind of a little bit of silver lining. The reason why you invest in a stock is to get an appreciation on fallback of earning visibility, management commentary, taking the business forward, etc., etc. On both these stocks, Coal India and Dabur, we have a hold on Coal India. Again, this year also, Vinny, the problem is getting invested at higher levels. But from a long-term point of view, if you have investable amount, maybe close to 360 or close to those levels, you can average Coal India. Dabur at current levels doesn't look bad at all to average, but definitely needs to average both to bring down the investment level from the higher levels to a lower level and continue to hold on from a long-term point of view.
Continue to hold on from the long-term point of view. Saumil, your view coming in, because Dabur, when I'm looking at it also in terms of a move, last 6 months, it's just been on a downward trend. So is it time actually, better to just get out of the stock right now, look at some other FMCG name, or continue to hold Dabur? And Coal India also, what's your view?
Let's start with Coal India. Coal India, triangle pattern, struggling to go above a 200 daily exponential moving average. Very strong resistance around 412, 415. In the very short term, definitely negative on Coal India. In the medium term outlook, maybe the stock will take support around 360 levels and then again start the up move. But I will wait. I'll wait till the close above 415, 420 levels, and then probably the next target for Coal India would be much higher. But wait and watch would be my suggestion on Coal India. For Dabur, Dabur has been struggling same thing. In the last 6 months, it's not been able to go above 20 and 40 daily moving average. It's been struggling. It goes up and then dips down again, breaks the previous swing lows. So not very positive on this stock. Nestle would be a great buy. Even Britannia looks good. Probably if you want to switch to Britannia or Nestle would be a good strategy.
Okay, Britannia or Nestle would be a good strategy in the FMCG pack. That's the word coming in from Saumil. But that was the last query for today. So Saumil as well as Gaurang, thank you so much for joining in with us as always. And viewers, thank you so much for sending us your queries. Keep sending us your queries. You can see the email ID that's flashing at the top of your screens for you all, and we'll solve them on Monday, Wednesdays and Fridays. But with that, we'll wind down this edition of Your Stocks today. Nifty almost in the day's lowest point as of now as well. Don't go anywhere. Up next, you have Closing Bell to take you through the last hour of trading.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Shanghai, some bit of a positive start coming in here as well.
Torrent will first acquire 46.39% stake for around 11,917 crores.
But in the past few years, they've really clamped down on free market capitalism.
After 4 days of a run-up, there is a pause in momentum.
Practically no impact of crude supplies during this last 10-15 days.
India, we like the industrial side, we like the healthcare side.
In some senses, there is going to be a little bit of upward bias towards these money market rates.
Fair to say that we have seen it all this year. Tariffs, wars, ceasefires and everything.
Today, PSU banks definitely doing really well.
This stage may be set for calling for the financial bids for IDBI Bank divestment.
Investors themselves have voted against Goenka's leadership last year.
The mid-cap index is still in the green, and that's possibly the only saving grace.
Well, that was the day so far. The downward slide on the markets continued. The Nifty is now below 25,500, 150 points gone in the Nifty. Sensex down nearly a little more than 500 points. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Nigel D'Souza. Hi.
Well, Reema, par for the course, right? Some kind of a pullback. I think that's perfectly okay. And I'll tell you what, a lot of portfolios will still be feeling good. The reason I say that is though the Nifty is down 150 points, though the Nifty Bank is down 250 points, but the number of stocks that are advancing are way more than the number of stocks declining. So that's telling you still a lot of interest in the broader markets.
Indeed, the mid-cap index is up close to about 0.5%. The small-cap index is a gain of nearly about 0.8%. So even as the frontline indices are struggling because of cuts in heavyweight stocks like an HDFC, many of the private sector financials like an Axis, Kotak, Reliance Industries is down over 1%. Broader markets, individual stocks are still very active. But the star sector of the day is PSU banks. Yeah. The Nifty PSU banking index is up nearly 2.5%. And look at the kind of gains that we're seeing in many of these names. A Bank of Maharashtra 4.5% up. PNB is up nearly 3.7%. Union Bank 3%. Bank of Baroda up close to about 3% odd. I mean, even some of the private financials like an RBL, Canara, across the board, I think the mid-cap banks are very, very active. So there's something going on there.
Well, that's right, Reema. And from the broader markets, a few stocks I was looking at just in the last few minutes. J&K Bank, you pull up the intraday chart out there. That as well as moving with some good traction, currently at the high point of the day. Pull up an intraday chart of Suzlon. I think that as well has seen a bit of a spike up in the last few minutes. So good going on some of these names. On the flip side, Belrise, I think it's up close to around 15% in this month itself. For today's trading session, it's currently moved to the low point of the day. But what's the reading then in terms of the markets? Mitesh Thakkar joins us to help us out with his call. Mitesh, what's the call? 150 points down, opportunity to buy, or you're seeking lower levels?
Well, I think, good afternoon. One, we were slightly overbought, so just a pullback to me. I think it will be a buying opportunity slightly more lower if you get it, closer to about 25, 350, 380 is the best entry zone, though we're still far away from that. But I think if you get it there, the risk-reward equation becomes very favorable to you. But as you rightly mentioned, the stocks and the directional bias on, a lot of these stocks remains very, very positive. And therefore, I think, it might be good if you can, trade with clearly long biases and avoid any kind of shorting idea. So on the stocks, I'm trading with long bias, but on the index, I would wait for more declines to buy into.
Okay. You said you would wait for further declines on the Nifty to buy. So what would be an appropriate level?
So I mentioned about 25, 350, 380 is the entry zone on the index. And then, that will give an entry with a stop just below levels of 25,300, 290 is what I would recommend on this spot. And we maintain those targets of 25, 700, 750 levels.
And stocks, Mitesh?
So stocks, I have buy on DV's lab. I think that's one stock which is just trying to break on the upside. So buy here with the stop below levels of 67.60. Look at targets of around 69.20. And Canara Bank, I think you were mentioning PSU banks as a package which is doing well. So Canara Bank is on the verge of breakout. The intraday high is around 114.6 and the breakout happens above 115. So buy about 115, keep a stop at 112.5 and look for targets of 121.
Okay, got that. Let's talk about IDBI Bank. The government is likely to invite financial bids for IDBI Bank. Sapna is here with the latest. Sapna?
Absolutely. What we're given to understand is that the call for the financial bids for the stake sale of government equity as well as the LIC's, share in IDBI Bank, that could be sooner than later. The invitation for financial bids. We are also given to understand that the government is close to kind of finalizing or concluding the share purchase agreement with the potential bidders for IDBI Bank. And once that's over, the next stage, of course, is the calling for the financial bids. So in all likelihood, it's just possible that before H1 ends, either the financial bids are going to be called for, or maybe could be even earlier than that. There is a process that's involved, so it's a ministerial panel that will have to give the approval in terms of the finalization of the SPA, that's the share purchase agreement, and once that's done, the next stage comes in. The finance minister, in the meanwhile, has already indicated that they expect, or rather the government expects to conclude the IDBI Bank transaction in FY26 itself. So I think the next 2 odd months are going to be very crucial. We'll have a clear sense before the month of September as to where the transaction is going. But, this much I can indicate very clearly that everything is at a very advanced stage. Once the SPA is done, the next stage is the calling for the financial bids, and that will, hopefully we should be hearing soon on that.
Okay, all right. Thanks a lot for that, Sapna. Well, let's go across to Deepan to ask him about, all right, I think first let's address the news that's at the bottom of your screen. Insurance regulatory body IRDAI has been without a head for almost 4 months. Yash is now picking up. The post of chairman will soon be filled. Yash, who are the likely contenders?
Well, Nigel, so as you rightly pointed out, it's since March that the previous IRDAI chairperson, Debashish Panda, vacated the position. And since then, the government has been on the lookout when it comes to the next IRDAI chairperson. What we've been given to understand from our sources is that the current Department of Financial Services, or DFS Secretary, M. Nagaraju, has emerged as a likely contender when it comes to becoming the next IRDAI chairperson. There are 2 more candidates, of course, Finance Secretary Ajay Seth as well as Defence Secretary Giridhar Armane, which we had reported were in the race as far as the next IRDAI chairperson is concerned. But the name as far as M. Nagaraju is concerned is very, very crucial. Someone who understands the sector, someone who's been working closely with the sector in his current role of Department of Financial Services Secretary. The name becomes very important, as a prospective candidate when it comes to taking over the position of IRDAI chairperson. Very recently, what makes the name more important is the fact that in his capacity of DFS Secretary, Mr. M. Nagaraju also met the CEOs of the life insurance industry, general insurance industry, as well as health insurance industry. Importantly for the life insurance sector, he discussed the point on mis-selling, and he assured the industry, this is what we were given to understand from our sources, that there won't be any action which will be taken on the contentious issue of restricting bank assurance sales, for the purpose of insurance sales, as long as the industry is responsible with keeping the number on mis-selling low. So that becomes very important, and that makes his role as a prospective candidate for the next IRDAI chairman very, very crucial and positive and beneficial for the industry.
Thank you very much for that. That's an important story. Deepan is now with us from Elixir Equities. Deepan, any thoughts on this name as the new IRDAI potential chief? And what's happening in banks today, mid-cap banks?
Yes, Rima, thank you for having me on your show. No, I have no comments on the new IRDAI chief, but I'm sure he'll do a great job. And insurance regulation, I think, has been phenomenal as compared to some of the issues we have faced on the stockbroking and the investor side. I think on the insurance side, I think things have been pretty much smooth. It's been very heavily regulated industry. which is great for investors because that does tend to protect minority shareholders. Coming specifically to banks, I think that's emerging as the favorite sector amongst all professional investors. It is one sector where we are seeing growth coming in now because of lower interest rates, which have been cut by RBI, and improvement in the overall loan growth rates. At the same time, I think there'll be some amount of reduction in terms of provisioning as compared to the pre-provisioning profits, and valuations are still reasonable. A lot of investors who want to beat the Sensex and Nifty, they have to get adequately weighted in these financials because I think almost 33% plus is banks and other financials. So I think it's justified, and this run, I would say this phase of the bull market may be led by the banks.
Okay, all right, got that. Any view on a couple of these other names, Deepan? We had a couple of these stocks that were moving around earlier today. Shilpa Medicare, any view on this name?
Yeah, Nigel, I think Shilpa Medicare, has got a lot of, I would say, support from very influential investors per se. It's a great company. Its main differentiating point is that it is manufacturing very difficult to manufacture APIs for cancer medication. And it's got backward integration, lowest cost of production, and a lot of their products have been approved in the US FDA. Past track record, 3-4 years, I would say was okay. But I think going forward, the growth phase is expected to be phenomenal. A lot of investors, analysts saying 25-30% growth rate also is possible. And if you look at the entire pharma industry, the winners here are the ones who identify key molecules where there's limited competition, difficult to manufacture, cost advantage. And then those companies are doing exceptionally well. And I think Shilpa Medicare is one of those companies as well. And as I said, I think it's got a lot of influential investors interested in the company, which is why always from time to time we see a lot of momentum in the stock as well.
Okay, Shilpa Medicare. Let's get back to the financial space. Clearly in the spotlight, Karnataka Bank, RBL Bank are buzzing. Vamakshi is here with the reasons.
Well, Reema, both of these counters are in focus today. Karnataka Bank is down and out in trade today because the top leadership has resigned. Keep in mind that the MD and CEO, Sri Krishnan Harihari Sarma, as well as the executive director, who is Sekhar Rao, both have resigned from their position, citing personal reasons, and that is the reason the stock is taking a knock in today's trading session. But on the flip side, RBL Bank, last I checked, was doing quite well, and that is on the back of a note that has come in from Citi. They've opened a 90-day positive catalyst watch on the counter, have a buy rating target price of 285. They're expecting the return on asset trajectory to improve by around 45 to 50 basis points, driven by much awaited normalization of credit costs. Now they're expecting the credit cost to normalize to 2.2%, and this would largely be led by the stress in the joint liability group as well as credit card, which will be further subsiding in Q1 as per their expectations, as well as moderation in their slippages to 4.5% as compared to 4.7% in the previous quarter. The repricing of floating rate portfolio mix change in favor of secured segments could also lead to around 28 to 30 basis points of pressure on the NIMs. But however, they also highlight that the NIMs for this company are expected to bottom out much sooner as compared to some of its peers in Q1 itself. They're expecting overall industry average loan growth of 9% year-on-year, 2% sequentially, and deposit growth of 10% year-on-year and 1% sequentially. So therefore, they have given a thumbs up to RBL Bank. The stock resultantly is up almost 4% in trade today.
Got it. Okay. All right. Thanks a lot for that, Vama. Well, going back to Deepan. Deepan, pick up the pack from the banking names, and also a quick word on IndusInd Bank. I recall, when the stock went down, you were saying with due disclosure, we are in, now we're waiting by. Stock has bounced back considerably, and some of those very, very strong names are doing the rounds to taking over at the helm. Your view on it?
Nigel, this is a case of rising tide taking all boats up. So whether it's RBL Bank or whether it is IndusInd Bank or Bandhan Bank, all these stressed out banks who destroyed a lot of shareholder value and then cleaned up their books, change of management, change of strategy, they seem to have improved their lending standards, collection mechanism. I think all of these banks are going to be the outperformers, the momentum stocks of the banking industry. And that's a lot of investor money and I think speculative money also will go into these banks. So if you have a high risk return appetite and a lower sector weightage, then certainly these companies can do well for you. But within the entire banking space, I'm surprised to say, but yes, I think PSU banks are the darlings. And the reason is that we are going to see an improvement in the P multiples over there, and expansion is certainly taking place over there. You compare the PSU banks and the private sector banks, and on various growth metrics, or even in terms of their NPA ratios, all of them are now more or less in line. And PSU banks have improved upon their service, their technology. And again, I think they've been so well capitalized that they are growing their loan book as well. So if you have to pick, then go for the PSU banks. A lot of choices are there depending upon your risk factor. And then there are the stressed out, erstwhile stressed out banks, which may give good returns. But all of this is kind of, I would say, little high risk, high return. But the stable banks, of course, ICICI, HDFC, Axis Bank, those also should do pretty well.
Got it. Okay, all right. Deepan, stay with us. Let's talk about one of the favorite stocks, Trent. That's getting in trade. Equirus has gone ahead and upgraded the stock to add from reduce. Mangalam, on a day-to-day basis, brokerages, they are having contrary viewers out here. Equirus has turned for the positive. You tell us, what are they saying?
Well, so Equirus hasn't turned a lot of things around in terms of their estimates for Trent, because the company had held its annual investor day a couple of weeks ago itself. What they're looking at right now is this decline on the stock price, which is an attractive opportunity for them to buy. So they've upgraded the stock to add from reduce earlier, and they have a target price of 6,400 odd itself. They say that post this near 30% correction that we've seen from its highs amidst concern over future growth, stock now trades at a lot more reasonable valuations. In terms of their estimates, they are modeling for about 75 to 510 store additions over the next 2 to 3 years for Westlife as well as Zudio. 510 stores in Zudio itself, they believe the company will add. They are expecting mid-single digit like-for-like growth. They are modeling 24% standalone revenue compounding, not too different from the company's own guidance of 25% going forward. And they do believe that, apart from Zudio and Westside, which have been proven models for them, they're slightly circumspect on Star, but they are believing that the company will place bets on about 20 experimental ideas. Even if 1 or 2 of them hit pay dirt, that would be the next leg of growth for Trent itself. They don't see much scope for EBITDA expansion from here on. 17% is what they believe the EBITDA will be over the next couple of financial years versus 16.5% that the company reported in the previous financial year. So all said and done, this 30% correction and a 25% growth runway is what is making them a lot more constructive on the stock than any other fundamental change on Trent right now.
Got it. All right. Well put, Mangalam. Thanks a lot for that. Deepan, what do you make of Trent? Stock was 8,000 rupees. Everyone then started throwing in the towel and it went all the way to around 5,000 rupees. Currently at around 6,200. What's your take?
Nigel, first of disclosure, we are invested in it and resisting a lot of temptation to sell, because every time you look at the P multiple, 153 times, it was you trading at even higher P multiples. So that does tend to kind of, induce at least a thought in your mind that what are you doing buying such an expensive stock? End of the day, it's a physical business and they can only grow so much. Although growth rates have been phenomenal, eventually it will start to slow down. But look, there's the scarcity of stock. It's a very highly fancied company as well, and it's got best-in-class growth rates. So you remain invested, but from a fresh investment perspective, I'm not so sure. There's not much margin of safety. 1 or 2 bad quarters, anything going wrong, which results in reducing the P multiple, can certainly lead the stock to underperform. At best, you can expect returns which are in line with the earnings growth, which is about 15-20% or thereabout on a longer term basis, 3 to 5 year basis or so. So I would say it's a hold for us, and maybe if there's a steep correction, you could look at buying into it.
I wanted to ask you about this other name as well, Deepan. Not sure if you track it. Force Motors. The stock saw a very, very sharp correction when the markets went into a tizzy. But just take a look at the bounce. We here at CNBC-TV18 had explained the company, in terms of what's working for them. They launched the Urbania. It has, they make engines for the likes of Mercedes as well as of BMW. And the parts are coming together because the focus is on premiumization now. Just take a look at the stock. It's more than 15,500 rupees now. I think it's up more than 50% in 3 months. Any view on this name?
Yeah, I think it's a very conservative management and they hardly speak to the press. So sometimes it's very difficult to understand what their strategies are, and more information about the company is always welcome. But it's a niche player. It's a quality player. It's been around for decades and the company has kept on reinventing itself and keeping itself relevant. And the numbers have been quite phenomenal. And because they are in that particular niche segment where they have a good dominating market share, and it's not so much linked to cycles as much as it is linked to overall investments, say like for ambulances or for mass transportation, I think their turf is pretty much safe. And definitely this manufacturing engines for BMW and Mercedes has been a growth engine for them. So I would say that, look, Force Motor certainly looks interesting at this point of time. Attractive if the stock price will be 15-20% lower or so. That would give some amount of margin of comfort. It was trading at much lower P multiples. Now I think it's fairly valued.
Interesting. Dipan, even when I presented that piece, I had said one of the problems is the management. They're not very, they don't have too many analyst meets, so they don't talk to the press as well.
They don't have any analyst meet.
Yeah, that's what. I mean, and I've personally tried to reach out to them, but hopefully, Dipan, in the next 6 months or so, we'll try to feature them here on CNBC-TV18, a management that has never spoken in many, many years. But I'll tell you what, I hope that I'm successful at that particular.
All I can say, Nigel, is you can try your charm.
Absolutely. Hope it works. Thanks, Dipan, for joining in and giving us your view on a lot of those stocks. Well, time to slip into a short break. On the other side, Jigar Mistry is waiting for us. He'll tell us how he's positioned in the markets and what he likes and what he believes is fairly valued.
investing.
Welcome back. Well, there's some news at the bottom of your screen. Reliance Defence and Coastal Mechanics to set up a JV at Mihan, and they have got into agreement with the US-based Coastal Mechanics for defense repair upgrade market opportunity. The stock has been buzzing on this hopes that they're going to sign a lot of deals, and we've seen a couple of them that have been signed in the last 2 weeks or so. One notable deal, I think it was a 600 crore deal that was announced in the last 10 sessions or so. And this is another one out there. So we'll have to see how it flows into numbers. But the last I checked, the balance sheet is looking in far better shape. So let's see how that goes. The stock clearly excited. I think it's up more than 20% in the last 1 month or so, 25% actually, to be precise. Well, let's get in Jigar Mistry, co-founder, Point Capital, who joins us. Hi, Jigar. Since there's something happened on defense, let's ask you about that. That's the theme that has been red hot. What's your view on defense? Are you in the camp that believes that in the next 10 years it's going to be, India has a big opportunity? Or do you believe all these stocks have already factored in the best? How are you all positioned?
Hi, Nigel. Good afternoon. Thank you, as always, for getting me on your show. I think forced to choose camp, I'll have to side with the fact that, great opportunity, but we are pricing in more and beyond. Last time I was there, I did mention that we did well in that skirmish, despite a lot of these companies not delivering on time. The opportunity and the runway is large. Maybe it's just the start. But essentially, when you do a reverse DCF on a lot of these companies, you are pricing in a lot. Secondly, if you look at the number of shareholders that have increased, in many of these cases, retail has become the largest ownership after the promoter group. And that does not really inspire a lot of confidence, especially when the institutional capital is not backing this up in a big manner. So also the way in which they corrected in the September to February correction in the market, and they've just completely gone back up. So we don't really own a lot in defense.
Can you share some new ideas, Jigar? So much has happened in the markets in the first half of the year, but at the end of it, we've been fairly resilient. Commodities have started declining. Crude prices, particularly, 13% lower last week. Any new trends, any new ideas that have come?
Right. So I think one thing we are taking home, or rather two things I would say, is that, one, eventually the markets will have to transition from a liquidity-driven rally to a more like an earnings-led phase. Right? Because if you look at the FY25 earnings growth, you are still at around 6-7%. And that was also driven by a lot of cyclical considerations. So for the first time, I think since COVID, consensus estimates have started correcting. That used to be the case before COVID in India. For the 5 years, including COVID, you saw a reasonably stable start of the year and end of the year consensus estimates. But for FY26 and FY27, those have started correcting. The one big takeaway, I think, in that transition that we think is happening is, we've discussed the pivot of the governments away from capex into consumption. It started with the central government with, giving 1 lakh crore in terms of lower taxes to medium income housing. States, if you look at what they are, for the lack of a better word, call them freebies. What they're giving in terms of freebies, the announcement exceeds 3.5 lakh crore. What's budgeted is still around 1.5 lakh crore or thereabouts. So you total these two, that's 2.5 lakh crores. Then you start adding in that eighth, pay commission is around the corner. If you total that, that's in excess of 3.5 lakh crores. So combined, you're talking about 6 odd lakh crores, which is like % of GDP, coming away from the sort of state central coffers into the hands of people. And then you will have to start looking at what benefits, discretionary, more or less, staples may not be so much. So I think there is an emerging opportunities that I think a lot of these companies and sectors have not performed well. And I think that is one big thing. We are still evaluating. I won't say we have answers to all of those, but that's an interesting space in terms of what's on offer versus what's priced in.
All right, Jigar, I wanted to ask you about the banking names. Today, the frontline names have taken a bit of a breather. And Karnataka Bank is lower because of its own set of issues. But if I look at the other stocks, you look at RBL Bank, you look at J&K Bank, that one as well is higher. RBL Bank is higher. These are banks that are trading at less than 1 time actually price to book. And my colleague Gaurav actually has neatly put this data together. What is your view? Some of these banks, IndusInd Bank, everyone is throwing in the towel at 650 rupees. Boy, oh boy, now you have 850. The problem in some of these is how is the book looking? What's your view? Would you stick to the large cap names, or do you believe some of these smaller names, they're offering some value out there? And we saw a deal with Yes Bank. There could probably be a deal with IDBI Bank. So there is interest and appetite out there for smaller banks. How would you read it?
Absolutely, Nigel. So I think let's take sort of a bigger call first and then boil it down to names. The bigger call is sort of if you looked at, say, a era before 2015, evergreening was abound. After 2015 until I would say 2018, 2019, you had sort of the NPLs come through. And since then, I think, you've shafted the wheat away from the rust. So essentially, you now have a situation where there are two large business models. One that allow you to report ROAs in excess of 2%, which are all these big boys. And then people are aspiring to be around 1% ROA. And there you have a lot of these emerging companies. Some of the names you did mention do report elevated ROAs, but are trading at a lower valuation. That's entirely sort of stock pickers market there. One big part that we are talking about is, while we spoke about central and state capex taking a back foot, corporate capex for the first time has crossed the central capex of 11 lakh crores or thereabouts. And now you are looking at net debt issuances from the corporates, which is after a decade, if memory serves, the companies are borrowing to invest rather than repaying debt. So I would, if I sort of had that opportunity, I would much rather focus on corporate banks rather than retail banking incrementally, because I think that's where the money would flow. Obviously, we can't discuss stocks, but I think in terms of names, we would be banking on a lot more corporate lenders and retail lenders incrementally.
Anything in this entire oil marketing companies? We've seen the decline in crude prices. Is there an opportunity in the oil and gas space?
I think yes. Essentially, you will have a situation where we are not budgeting for an elevated level of crude prices as we go. There will be skirmishes which will lead to these spikes, but eventually we are looking at it being in the 60-65 handle. So net, you will sort of model those recurring margins for many of these businesses. We do own one of them in the oil marketing space, but I think beyond a point, this still state-owned, so you can't build a very large exposure. So it's a middling level exposure for us as well, but neither here nor there sort of.
Do you own any two-wheelers in your portfolio?
No, we think they are, representing a very large optionality in terms of who gets to win the EV game. And, as far as PEs are concerned, it's a good spray and pray approach for them. It's like spread around $1 billion to a lot of players. And then, one of them becomes a winner and then you take it home. But when you're investing from a public investing space, those optionality become a very large part. And although, as I said, discretionary does present an opportunity, we think two-wheelers are more or less sort of pricing that in. So we don't have a large exposure. We don't have any sort of exposure, so to speak.
Okay, all right, Jigar, good to hear your thoughts. Thanks a lot for joining in and filling us in with all of those details. By the way, look at the bottom of your screen. Those BharatNet orders continue. ITI has signed an agreement with BSNL for NER2 package 15 of the BharatNet project worth around 1,900 crore rupees. Stock locked up 5%. I think that's the circuit limit today. The street likes it. I'm sure our team is trying the management. Maybe we'll try to get you more details on that front. Time to slip into a short break, but Nimesh is waiting for us on the other side. He'll tell us what's happening with dealing rooms, and also then we'll be getting our technical experts to help us out with a couple of calls.
Welcome back. 30 minutes to go to wrap today's trading session. The Nifty is above 25,500 just by a smidge, but it's still down close to about 128 points. So benchmark indices have retraced, seen profit booking after its 4-day run, but mid-cap action activity, positive activity continues. Mitesh is now back with us for a few BTST calls. Mitesh?
Yeah. So actually, I have one estimate on Dora Developers with a stop at about 1395 for targets of 1350. That's one stock which is turning weak. In fact, the reality as a pack is turning slightly in the weaker side. And on the buying side is MGL. It's given a good pullback today. So buy here with a stop below 1474 for targets of 1505.
All right. Thank you very much for that. Let's get to Nimesh now. He's at the National Stock Exchange and he's going to join in with the chatter that he's picked up. Nimesh.
Hi, Rima. So markets marginally under pressure today, but I guess it's more to do with profit booking after the recent run-up that we've seen across the Nifty, Bank Nifty, as well in the broader markets as well. So not very much alarming. In terms of flows, slightly mixed with a negative bias is what my sense is. But again, there is going to be a small MOC basket buying at a leading FID. So that gets impacted in the last 30 minutes of trade. So that's something to watch out for. I guess the sector clearly stands out is the PSUs. Again, the PSUs in general are doing good, but within that, it's a day for the PSU bank stocks to do well. And I guess that's backed by some FI buying as well. I've been saying this for a while now that it's the PSU which is attracting a lot of institutional interest and in terms of flows as well in the last many days, and today is the case as well. Broader markets have seen some bit of profit booking today, but again, nothing alarming, so to speak, a bit of profit booking after the recent run-up. But I guess from a broader market point of view, the fact that now there could be no further supply in terms of blocks and PE stake sales, the sense I'm getting is maybe at least in the very near term, the mid and the small cap indices are likely to outperform.
Indeed, Nimesh. But what about individual stocks? What are you picking up? You've got an interesting list as always.
Thanks, Nigel. So the first stock on my list today is Keynes Technologies. That's been buzzing in trade. Remember, there was a large QIP as well, which happened last week, and after that, you've seen a bit of outperformance. And generally, there is a buying interest back in all the EMS stocks. Dixon is also buzzing in trade, and so is Keynes Technologies in today's market. So that's the first name. The second stock is Indraprastha Medical. For second day running, that's been buzzing up 5-7% last I checked. The volumes have also picked up in that particular stock. And for Indraprastha Medical, the big buzz is that maybe the company is going to announce a large capex. And more, at least the bed capacity can be 3x more from here. So that's the buzz as far as Indraprastha Medical is concerned. The third couple of stocks where there is delivery-based buying in today's market, 361 as well as Interglobe Aviation. Both are buzzing in trade. For Interglobe, apart from the fact that there are bid orders, also now that the trading window is closed for promoters, the risk of a large block seems to be at least away for the time being. So that also explains a bit of short-coming rally as well as buying interest in Interglobe. So that's a stock to watch out for. And the last one is Vintage Coffee. Normally we don't talk about this stock too much, but that's been buzzing in trade today. The flows are strong, as I understand from HNI desk. And also for Vintage Coffee, the buzz is that the company might raise funds via preferential issue very soon. So that's a trigger as far as Vintage Coffee is concerned.
Interesting one, Nimesh. That's new. Vintage Coffee. I was just looking at the financials. They should do 20-30 crores on a quarterly basis of revenues. Last time they did close to around, I think, 100 crores that one. So we'll keep an eye out on all of those names and some coffee as well in that mix. Well, let's focus though on 100 crores is what they did in the past quarter in terms of a revenue and margins of around 18% from, I think, 30-40 crores on a quarterly run rate earlier. But let's talk about the big pharma deal that was announced late last evening. Torrent Pharma as well as JB Chemicals and Pharma. What are the contours of the deal? How will the deal impact business of both of them? And what are brokerages making of the deal? Well, no one better than Ekta to join us and tell us more about all of this. Ekta.
Well, yes, Torrent Pharma has announced a two-phase acquisition of JB Chemicals from KKR, marking one of the largest deals in India's branded pharma space since possibly the Ranbaxy-Sun merger. Torrent will first acquire 46.39% stake for around 11,917 crores and may pick up an additional 2.8% from JB Chemical employees at around 1,600 rupees per share. An open offer for 26% follows at around 1,639 rupees per share, with the total size of the acquisition for Torrent possibly going up to as much as 19,480 odd crores. Now in the second phase, the companies will merge, with JB shareholders receiving 51 Torrent shares for every 100 held. Now the deal values JB Chemicals at around 25,689 crores, and 11% discount to its closing price ahead of the deal. With the JB Chemicals acquisition, Torrent Pharma is now poised to rise from the 6th to the 4th largest pharma company in India. The deal, in fact, is expected to boost its domestic revenues by 35%, surpassing 8,600 crores based on FY25 numbers. Torrent will strengthen its dominance in cardiac and gastro segments, gaining top brands like cardiac drug Silicar with sales of 785 crores and gastro drug Metrogyl at around 342 crores in terms of a size of a drug. It also secures entry into ophthalmology and expands its footprint in the global CDMO space. Torrent Pharma may in fact fund the JB Chemicals acquisition through a mix of internal accruals, debt and equity via QIP. It could take on as much as 10,000 to 12,500 crores of debt, pushing the combined net debt to around 14,500 crores and a net debt to EBITDA to around 3 times on an FY25 basis, according to analysts. However, analysts including DAM Capital are not overly concerned. They point to Torrent's steady free cash flows and believe a 2 times EV to EBITDA leverage is reasonable and the debt could be paid down in 3 to 4 years. Now, while JB Chemicals currently operates at a lower EBITDA margin than Torrent Pharma, analysts are not overly concerned about that either. Torrent has had a strong track record of cost rationalization as seen in its past acquisitions of Elder, Unichem and Curatio, which saw margin expansions within 1 to 2 years. While we could see near-term dilution, analysts believe the combined entity could target EBITDA margins of 34 to 35% over the next 3 to 4 years. Lastly, what are the brokerages saying? IIFL recommends JB shareholders should avoid tendering in the open offer and wait to swap their shares in the merger. Nomura expects the adjusted EPS accretion in the mid-single to low double digits. They maintain a neutral rating with a target price of 3580. HSBC expects the deal to be 3% accretive to FY27 estimated EPS estimates. They retain a buy with a target price of 3,775.
Ekta, thank you very much for that comprehensive explanation on the big pharma deal. But 20 minutes left and we wrap up the first half of this calendar year. It's been one roller coaster ride. So much has happened. Hormus is now joining in to break down how the benchmark indices and the broader markets have fared so far in 2025. Hormus?
More action than in an action film, more drama than in a drama film. Well, I guess the markets have seen it all in the first 6 months of 2025, be it tariffs, be it war, be it ceasefires. And after all of this, the Nifty has trumped up with returns of 8.5% in the first 6 months of the year. And this is after an 18% recovery that the index has seen from the lows that it had made at the start of 2025. The Nifty Bank, which is already trading at record highs, is up 13% so far in the first half of this year. And this tinge of green that you see in the mid-cap and the small-cap index is after a near 30% recovery that these indices have seen from the lows that they made earlier this year. Now, which have been the top performers on the Nifty in the first 6 months? No prizes for guessing, but it is BEL and Bajaj Finance. The 6 months, though, belong to the life insurance companies. SBI Life and HDFC Life, both of them are seeing their second best calendar year already in terms of returns, and Bajaj Finserv, of course. And the underperformers, of course, it is the IT names that form the predominant list. TCS, Infosys, Wipro, all of them in there, along with Trent and, of course, IndusInd Bank, despite a near 35% recovery from the lows. You take a look at the mid-cap index, and Solar Industries has been the talk of the town in the last few months. Almost 80% returns in the first 6 months. Bharat Dynamics, BSE, L&T Finance is up 50% so far this year. What is down 50% this year, though, is Ola Electric, continuing to make new lows from its IPO price, along with names like Oracle Financial, Kalyan Jewellers, Premier Energies, too forms a part of this list. Defense has been a common theme. across the Nifty, the mid caps, and even the small caps, because Garden Reach is the top gainer on the small cap index, almost 90%. Narayana Health until last week making new highs. Reddington and Naveen Florin, after a slew of positive brokerage commentary, is up almost 50% so far this year. And among the underperformers, though, it is names like Brainbees Solutions, Anantraj, Natco Pharma, losses of anywhere between 35 to 40%. So it's been an action-packed first half of 2025. Well, the bulls would definitely be hoping that the second half is less action-packed, but it has enough legs to take the Nifty past its record high levels.
Thank you. But action will start, tomorrow? We've got the auto sales numbers for the month of June, which will be out. And the trend is that two-wheelers will continue to accelerate. So expect good numbers from the two-wheelers, thanks to strong domestic demand and some export recovery. Tractors have also seen a healthy uptick because you've seen rural markets beginning to bounce back. But the problem is the passenger vehicles, they're losing steam. Demand continues to remain soft. Inventory correction is also weighed on volumes. So here are some of the CNBC-TV18 estimates year on year for the wholesale numbers. Passenger vehicles on the whole down 5%, two-wheelers up 3%, tractors up 6%, and MHCV down 1%, but that's largely on account of Tata Motors underperforming. Now, when it comes to two-wheelers, Bajaj and Hero MotoCorp sales are seen up close to about 6%. The standout is likely to be TVS Motors, 23% up, while even Royal Enfield is likely to do well. 17% is the estimate in terms of a growth rate. Now, passenger vehicles expect growth. So for Maruti Suzuki, Hyundai, Tata Motors, expect a decline. So sales are seen down between 5 to 8%. Again, here it's M&M Auto, which is bucking the trend, where numbers are, we're expected to see a sales jump of close to about 13%. In CV, Ashok Leyland sales are seen up 3%, M&M Tractor sales seen up 7%, and Escorts is seen up close to about 4%. So two-wheelers, okay so far. But passenger vehicles is likely to remain under pressure in the month of June. But remember, for two-wheelers, there's also the draft notification which has come out talking about a mandatory, a compulsory anti-braking system, ABS, from 1st of January 2026. And if that comes through, we are talking about a cost increase. UBS estimates about a 4,000 to 5,000 rupee per vehicle cost increase, which basically means it will hurt some of the lower priced vehicles, because in percentage terms, it will be a jump in price. So Hero MotoCorp could be affected quite a bit. According to UBS, 77% of Hero MotoCorp's portfolio could be affected because their two-wheelers are not fitted with ABS. So if they have to fit it in, 77% gets affected. Eicher Motors, on the other hand, it's not affected because all the two-wheelers already premium and they already have ABS fitted in it.
Good, you educated me about the bike I come on as well. Great. All right. From a stock market perspective, though, that explains why the rational remarks given with regard to why Hero MotoCorp is under some pressure. Anand Tandon, market expert, joins us on the show. Hi, Anand. Good afternoon. Hope it's a good start to the week for you as well. What are you making of the auto pack? And what do you like out there? If you could tell us from the auto listed stocks or even from the auto ancillaries, is there a couple of stocks that you like?
Well, the two-wheelers are actually priced to perfection and then some. But if you have to pick up something in the two-wheeler space, I guess the one that is showing the best performance, both in the markets as well as in terms of their own performance, is probably TVS. Eicher is, of course, now not only exposed to the domestic market, but international as well. So then becomes a little more hard to judge. Overall, I'm not particularly bullish on that particular segment. As you mentioned in your roundup just now, tractors is probably a safer bet because for the moment, at least this year, you will get better demand, and we are already seeing that in the numbers. The farm output is also likely to be better. The passenger vehicles, I think too many players in it with too many new models coming in right now. So while you might see volume growth, I think you are still going to be pretty much tied down to the SUV segment. And that there is really only one way to play that, and that is Mahindra's. So there isn't that much of a choice right now. Mahindra is also not particularly cheap. So the best thing is to stick with, probably Mahindra in your portfolio if you want to be having a sector kind of approach. And just stay with it because you're also getting some of the other consumer discretionary spaces involved through the Mahindra listing.
But Mahindra, as you said, M&M is expensive. So in terms of fresh purchases, would you recommend it at these levels?
So by and large, I'm saying that, fresh purchases should be kind of indexed. because it is not as if the market overall is very cheap, right? And trying to figure out which sector is doing well when almost all the sectors are priced for a growth which is much higher than what we're likely to see doesn't leave you too much choice. So you should kind of benchmark your portfolio to some index that you're comfortable with and stick with that. So when you look at the index itself, it is expensive, which means almost all the sectors and all the stocks involved will also be. That said, the market is still moving up, and if you're therefore playing the momentum, the best way of doing it is to be somewhat passive, even in an actively managed portfolio.
I don't know whether the street is sniffing a very, very strong showing from Force Motors, but that stock from the time we started the show itself has moved up even more. Now it's a 16,200 rupee stock. I'll tell you what, when we had presented it on Midcap Microscope just around 3 months ago, it was only 9,000 rupees after the sharp correction. But clearly the street is sniffing something. We are not sure what the reason is, but this stock is moving with a lot of momentum as we speak. Well, Anand, I want to ask you about another stock, that is MediAssist. The stock is up close to around 7% at the high point of the day. Any view here?
So, I mean, I can, MediAssist is not a stock that I'm currently tracking. On Force Motors, clearly the market is pricing in a kind of defense order, right? So because everything in defense has to do well, so has this company.
But I think the defense order came. There appears maybe something else they are factoring in, because the long-awaited defense order, I think a couple of months came, it did come about. I think 2,500, if I remember, the Gurkha. Yeah, maybe something more.
Possibly, maybe a higher order, but the point is that, right now we are looking for clutching at straws. So when the order comes, price goes up. When that translates into revenue, price goes up. And when that translates into profit, price goes up again.
Raymond Realty will be listed tomorrow. So that would be another company from Raymond's stable. And I think the Raymond stock itself is up close to about 12 to 13%. So any thoughts on Raymond Realty? I was just looking at the numbers. I think their revenues were about 2,300 crore rupees. They've got a gross development value of 40,000 crore rupees, 10,500 crore of projects which are already launched. I mean, how would Raymond Realty compare versus the other real estate players that we have?
So we should wait to see where it actually lists at. But the reality business in Bombay seems to be doing exceedingly well. And, they have a self-owned bank, a land bank, which is fairly large. So therefore, to that extent, the initial margins that they make will be substantial. That will obviously flow through into the valuations of Raymond as well. To a large extent, probably already is. But otherwise, the reality business, if you look at other markets, I don't think that's looking too exciting to me. The numbers are still very strong, but I think, we are at a stage where probably you are at or near a peak, if not already just about past it. It depends on the specific city. For example, in the city I am in, we are well past the top. The sales have dropped this year in terms of new registrations by almost 33%. Construction continues unabated. We've already seen that in some of the other cities as well, but Bombay seems to be right now immune to that kind of slowdown. So, till that market continues to do well, I would imagine that at least prices are not falling, volume pick up. Even if it sells at a certain level, even if it maintains the current level, you'll probably get a big uptick in a company like Raymond.
Today, Raymond and Raymond Lifestyle, even that should come up for you on your screen. So both those two Raymond listed companies are higher, and Raymond Realty, which lists tomorrow, 1st of July, would be the third one. The second one is Raymond Lifestyle, I think.
All right. Well, Anand, since you mentioned in the city that you're in with regard to real estate, I want to ask you about the cement stocks, but I'll tell you what, we'll get some market opinion first. Mahesh Patel, the Chief Investment Officer at Aditya Birla Sun Life, tells us that liquidity in the market is improving and valuations are reasonable. Let's listen to his comments.
Overall, I think the liquidity flow into the markets is also improving. We've seen FIs slowly starting to come back. Domestic flows have been steady. And I think valuations were reasonable. I mean, markets, after the correction, what we saw around 6-9 months back, a lot of stocks had come down to decent level. We've seen now interest coming back, not only into the frontline names. I mean, the large caps were always looking good on a valuation perspective. But even the broader market, right, the mid cap and small cap have seen a good recovery. Although I would say that it is more stock specific in the mid and small cap. Not everything is moved up, but clearly, I think the confidence is coming back. I mean, the IT sector was the first one to underperform, right, earlier because of global concerns. And I think on that front, I think US, where you were expecting a recession, the probability was much higher around, say, 3-4 months back. Now that has receded. And looks like at least the commentary also from the IT companies is that the worst seems to be behind. That doesn't mean that you will see a sharp recovery over there in terms of volume growth. It will be still slow and tepid. But I think this is a sector where I think overall stability, I think, would be there. I think the downgrade cycle seems to be behind over there. Also, the cross-currency impact also could be slightly positive, at least in this quarter.
Welcome back. Markets off the lows, though we're still down close to around 120 points. Broader markets doing better. But before we went into the break, Anand was telling us that in his side of town, he believes maybe the best of the real estate is already in the price. But Anand, the street is speculating that there could probably be some inorganic growth on the cement companies. And that's why after a treacherous past year, actually, you have stocks like Sagar Cement, Deccan Cement, they are bumped up in rate. And there is hope that there could be some consolidation. What's your view on these names?
Well, consolidation has been an ongoing process for the industry for a while now. We have now 2 or 3 large players, and they are clearly now becoming more and more dominant in most. In fact, in most of the subsegments of the market, if you see, the top 2 players now probably control at least 70% of the cement supply, and that's probably why your cartelization of prices has been able to sustain much better than it did in the last cycle. But that said, right now also the capacity addition that is happening in the industry is outstripping the demand growth. And therefore, the ability to continue to maintain an upward trajectory in price as well as volume simultaneously seems somewhat weak. On the other hand, we are also seasonally in a poorer side of the market because you are in the monsoon segment where you will have lower sales. So what we are looking at among the smaller players is clearly M&A action. And that is, it's difficult to understand which one of them will be sold, but almost anything which has a few million tons of capacity and more importantly, access to limestone is something that would be a fair target to look at for acquisition.
We've had 2 big deals in the last couple of days. One of them is JSW acquiring AkzoNobel, and the second one is the one in pharma, Torrent Pharma and JB Chemicals. Any thoughts? Is there any play in either of these 2 M&As?
So in the first one, in the paint sector, I think M&A was necessary because again, we had two new players coming in. They would be fighting for market share, and that is exactly what you're seeing. That they have actually, one of them has been aggressively acquiring and has increased the share of their market share. They're now the fourth. That said, is it over quite yet? I don't think so. Grasim has done quite well. They have actually managed to set up a huge capacity as well as and not lost too much money on it, probably less than what was originally thought. And their market share increase has also been fairly significant. But will they be happy with where they are? I doubt it. So I think there is probably at least another 3-4 quarters of market share juggling that will happen before the market settles down into a more playable area. Till then, I would imagine that prices will remain somewhat subdued. There will be outperformers like we've seen in Berger, where they have obviously managed to do quite well, and therefore the market is rewarding them. But the question is whether you want to bet that trend will continue or there will be a new leadership emerging. The other one, JB Chemicals, obviously, again, similar things. Torrent has done well. It is way more expensive than JB is. And though its EBITDA margin is a little better, it's not as if the market has not already rewarded it for it. So from that perspective, it's good time to be actually able to consolidate. JB was the target again because you had to have a private equity player who had to find an exit. So I think it's a good deal again for Torrent.
All right, that's it. Thanks a lot, Anand, for giving us that view. By the way, a quick recap of what went on during the course of the day. The Nifty ended with a cut-off around 125 points. The good news is we came way off the low point of the day. The Nifty Bank as well cut its losses towards the end, though that as well goes on with the cut-off around 120 points. What didn't do well? Tata Consumer was down 2.5%. Kotak Mahindra Bank came in for some profit-taking. And Axis Bank as well was down closer around 2%. Hero MotoCorp from the auto pack, well, that one was weighed under pressure. UBS as well had come out with a note that most of their vehicles will get impacted by the new regulations that will come out. So that's why that was down 2%. What did well? Trent, upgrade coming in from Equirus, the street laxer. That stock is bouncing up. BEL, we had spotted the stock actually a couple of sessions ago that it went through a bit of correction. But if you want to play a stock frontline, Nifty pack, with some kind of opportunities in terms of the higher European spend and NATO spend, well, this could possibly be the name. That was up close to 2%. And SBI and IndusInd Bank, both of them went home with gains. But the story was about the broader markets. Stocks that we normally don't talk about were flying away. Shimaru up 20%. Raymond up 15%. You had Sanofi Consumer that was up close to around 13%. A couple of other notable movers. Force Motors, that was up more than 10% in today's trading session. Banco, another stock we don't talk about too often, that was higher. Visakha as well was up close to around 8.5%. So there were a lot of stocks from the broader markets doing a jig of their own. And that's why, it wasn't such a bad trading session, though the Nifty goes home with a cut of around 120 points. I'll tell you what, we'll wrap up on this edition of Closing Bell. Don't go anywhere. Markets Forward comes up next. Market snaps the 4-day gaining streak. The Sensex drops 400 points while the Nifty trades below the 25,600 mark. The mid-caps continue to outperform with the Nifty mid-cap index ending higher for the 7th straight session. PSU banking stocks were among the top gainers while private banks were among the top losers.
Torrent Pharma will buy out KKR's 46% stake and make an offer to employees and minority stakeholders of JB Chemicals in an over 19,000 crore rupee deal followed by a merger of the company. Analysts give the fairly valued deal a thumbs up.
The government is set to invite financial bids for IDBI Bank soon as talks on the share purchase agreement with potential bidders near a close. The move comes on the back of Finance Minister Nirmala Sitharaman indicating a completion of the deal in FY26. Hello and welcome to Markets Forward, your go-to show where we aim to get you up to speed with regard to today's trading action and set you up for tomorrow. I'm Nigel. With me is Hormuz. Hey Hormuz, not such a bad trading session after all.
Not a bad trading session. And of course, after gaining almost 700 points in 4 sessions, you take a bit of a break as well. Respecting key levels, we ended above the 25,500 mark. That's the bigger takeaway.
Well, that's right. And in the next 20 minutes, we are going to be sorting you all out. The big news, key developments on the Dalal Street, top corporate voices, and all the events you need to track going ahead. But Hormuz, a couple of points with regard to today's trading session. The Nifty, yes, it was down closer to 120 points. The Nifty Bank as well was lower. But the good news is, as that intraday chart is telling you, both the Nifty and the Nifty Bank, they came off the low point of the day. That's heartening. And the breadth of the market actually was far better. So if you look at the mid-cap index, that consistently traded in the green for almost the entire trading session, which is good news. Even the small-cap index did see some traction. But the reason that your portfolio will be feeling good on a day that the Nifty, in fact, went home with a cut of around 120 points is because the breadth of the market was favoring the number of stocks advancing. Number of stocks advancing were close to around 1,500, while the number of stocks declining were around 1,100, 1,600 or thereabouts. So that, in fact, was a pretty good data point by the time we did wind up. Hormuz?
Indeed, the broader markets did well, and that was the one saving grace today, even though the index remained in a bit of a range. But a couple of pockets that stood out, one of them was the PSU banks, and the PSU bank index was the top sectoral gainer today. And that was the standout, be it Bank of Maharashtra, be it Union Bank, be it PNB. All of the constituents of the PSU bank index were higher in today's trading session. So that is one. And of course, there were a lot of these newsmakers that dominated headlines in today's trade, and those some of them including the likes of Jyoti CNC, of course the block deal that took place in earlier in the day, that stock ended 5.5% lower. Some positive developments coming in for Alembic Pharma, the US FDA approval for the injection that it had. It came significantly off the highs of the day, yet managed to end around 5% higher because at one point was up almost 13%. And of course some corporate developments with regards to Karnataka Bank, with the top brass announcing their resignation over the weekend, 5.5% lower on that stock as well. The lender issued a clarification just a few minutes before closing with regards to their financial position and saying that depositors' interest is paramount for them. So these were some of the newsmakers in today's trading session. So let's take the conversation forward then with our guests, Anand Tandon, market expert, and Sudeep Shah from SBI Securities joining in today. Get the levels out of the way first. Gentlemen, good evening. Thank you for joining in. Sudeep, took a bit of a pause today, but the fact that we have managed to hold up above 25,500 should be heartening for the bulls, right? What are the next levels that you are tracking on the index?
Good afternoon, Hormuz. Absolutely. Today we had some kind of a sideways session, and that is quite okay considering the move that we have seen in the last 5 to 6 sessions. And towards the end, the advance decline also slightly improved, and that is why we feel that it's just a day off for the markets. And overall, 25,300, 25,350 now will become a decent support on the downside. Another couple of 200 points from here on. So 25,300, 25,350 we feel will act as a very important support zone until the time this zone is held. On the upside, we see levels of 25,800 and 26,000 coming very soon on the Nifty.
Got it. Okay. All right. Thanks a lot for that, Sudeep. Well, let's talk about the big deal of the day. Torrent Pharma set to buy out KKR's 46% stake and make an open offer to the employees and the minority shareholders as well of JB Chemicals in an over 19,000 crore rupee deal. That's going to be followed by the merger of the company. Ekta joins us to explain this deal and also tell us what are brokerages making of it. Ekta?
Well, yes, Torrent Pharma has announced a two-phase acquisition of JB Chemicals from KKR, marking one of the largest deals in India's branded pharma space since possibly the Ranbaxy-Sun merger. Torrent will first acquire 46.39% stake for around 11,917 crores and may pick up an additional 2.8% from JB Chemical employees at around 1,600 rupees per share. An open offer for 26% follows at around 1,639 rupees per share, with the total size of the acquisition for Torrent possibly going up to as much as 19,480 odd crores. Now, in the second phase, the companies will merge, with JB shareholders receiving 51 Torrent shares for every 100 held. Now, the deal values JB Chemicals at around 25,689 crores and 11% discount to its closing price ahead of the deal. With the JB Chemicals acquisition, Torrent Pharma is now poised to rise from the 6th to the 4th largest pharma company in India. The deal, in fact, is expected to boost its domestic revenues by 35%, surpassing 8,600 crores based on FY25 numbers. Torrent will strengthen its dominance in cardiac and gastro segments, gaining top brands like cardiac drug Cilacar with sales of 785 crores and gastro drug Metrogyl at around 342 crores in terms of a size of a drug. It also secures entry into ophthalmology and expands its footprint in the global CDMO space. Torrent Pharma may in fact fund the JB Chemicals acquisition through a mix of internal accruals, debt and equity via QIP. It could take on as much as 10,000 to 12,500 crores of debt, pushing the combined net debt to around 14,500 crores and a net debt to EBITDA to around 3 times on an FY25 basis, according to analysts. However, analysts including DAM Capital are not overly concerned. They point to Torrent's steady free cash flows and believe a 2 times EV to EBITDA leverage is reasonable and the debt could be paid down in 3 to 4 years. Now, while JB Chemicals currently operates at a lower EBITDA margin than Torrent Pharma, analysts are not overly concerned about that either. Torrent has had a strong track record of cost rationalization as seen in its past acquisitions of Elder, Unichem and Curatio, which saw margin expansions within 1 to 2 years. While we could see near-term dilution, analysts believe the combined entity could target EBITDA margins of 34 to 35% over the next 3 to 4 years. Lastly, what are the brokerages saying? IIFL recommends JB shareholders should avoid tendering in the open offer and wait to swap their shares in the merger. Nomura expects the adjusted EPS accretion in the mid-single to low double digits. They maintain a neutral rating with a target price of 3,580. HSBC expects the deal to be 3% accretive to FY27 estimated EPS estimates. They retain a buy with a target price of 3,775.
Ekta, thanks a lot for that. You posed that question to Anand Tandon. Anand, thank you for joining in. Big deal, yes, but based on what brokerages are mentioning, it should not be a cause of concern, particularly for Torrent Pharma. Do you see that as a fair deal and a positive, considering it hasn't had a history of positive acquisitions in the past as well?
Well, absolutely. I don't see them, as you mentioned, they have managed to acquire lots of companies in the past, and that has been a favored method of growth for them. And they've done a fairly decent job of it. And with this acquisition, the debt does go up, but not out of whack. And, there is, as you mentioned, about 3-4% difference in the EBITDA. That may likely change. They are also using the fact that they trade at a much higher PE than, let's say, a JB does. And therefore, if you use your shares to actually, you will get, if nothing else, if you were to retain your PE, you will get a valuation increase with the same kind of numbers coming through. So by and large, I think, most of the parameters seem to be in an order of magnitude which is manageable. And given their past track record, they pretty much know what to do. So I would imagine that the strengthened portfolio will do quite well under the leadership of the Torrent management.
Okay, all right. Got that. Anand, stay with us. Well, let's focus on auto stocks. They were under pressure over commentary coming in from brokerage firm UBS on the anti-lock braking systems. Rima joins us to explain this and also tell us why Hero was the underperformer today. Rima?
Thanks so much for that. So the government on the 27th of June issued a draft notification which makes it mandatory for anti-lock braking systems for most two-wheelers. Now this, remember, is a draft notification. But if it is implemented, if the ABS or anti-brake system is implemented for two-wheelers, we're talking about a cost increase. So UBS estimates about a 4,000 to 5,000 increase for 80% of the industry two-wheelers. And already the industry is reeling with a lot of price increases in the recent past. So they're saying the industry has seen a 6 to 7% price increase every year for the last 7 years, which is higher than historically when the price increase would be to the tune of 1 to 2%. Now, amongst the two-wheeler players listed in India, it's Hero MotoCorp, which will be the most impacted. Royal Enfield, that's Eicher Motors, will not be impacted because their two-wheelers are already fitted with ABS, being the premium vehicles. So they're saying that the most impact will actually be on the entry level two-wheelers, because in percentage terms, when you put that 4,000, 5,000 in terms of a price increase, it will hurt them the most. UBS has also given the exposure, in terms of revenues for each of the two-wheelers. So Ather is about 100%, Hero MotoCorp is the most at 77%, TVS is at 52%, for Bajaj it's about 21%. So in that sense, a bit limited, while for Royal Enfield it's 0, because all their two-wheelers are fitted with the ABS system. So according to UBS, this regulation will further dampen the investor sentiment, and you are seeing the negative cut coming through on Hero MotoCorp on the back of this draft notification making anti-brake system mandatory for two-wheelers from 1st of January 2026.
Rima, thanks a lot for that. All eyes, of course, will be on the auto sales numbers later this week. Now, the government is set to invite financial bids for IDBI Bank as soon as talks on the share purchase agreement with potential bidders is nearing a close. Sapna is here with more details on this. Sapna, over to you.
Absolutely. What we're given to understand is that the call for the financial bids for the stake sale of government equity as well as the LIC's, share in IDBI Bank, that could be sooner than later, the invitation for financial bids. We are also given to understand that the government is close to kind of finalizing or concluding the share purchase agreement with the potential bidders for IDBI Bank. And once that's over, the next stage, of course, is the calling for the financial bids. So in all likelihood, it's just possible that before H1 ends, either the financial bids are going to be called for, or maybe could be even earlier than that. There is a process that's involved, so it's a ministerial panel that will have to give the approval in terms of the finalization of the SPA, that's the share purchase agreement, and once that's done, the next stage comes in. The finance minister, in the meanwhile, has already indicated that they expect, or rather the government expects to conclude the IDBI Bank transaction in FY26 itself. So I think the next 2 odd months are going to be very crucial. We'll have a clear sense before the month of September as to where the transaction is going. But, this much I can indicate very clearly, that everything is at a very advanced stage. Once the SPA is done, the next stage is the calling for the financial bids, and that will, hopefully we should be hearing soon on that.
Got it. Okay. All right. Sudeep, let's come across to you first. How is Hero MotoCorp looking on the chart? Today it was under some pressure, but actually it managed to defend the lower of the day. And also, if you want to tell us on IDBI Bank, that ended in the green, but off the high of the day.
Nigel, if you see Hero Moto, in the last several weeks, the stock is virtually doing nothing between, say, 4,100 and 4,400, 4,500. It's just trading in that range. So I don't see any meaningful breakout unless and until the stock sustains above 4,350, 4,400 in the coming few sessions. And till then, the trend could be sideways to negative. Coming to IDBI Bank, here we have seen a decent breakout also. Although from the higher levels of the day, there was some profit booking today. But looking at the chart on a longer term chart, weekly as well as monthly, I feel stock has already broken out of its consolidation, and a strong momentum is visible here. So overall, till 97 zone is held in IDBI Bank, we see levels of 115, 120 coming very soon on this stock.
Anand, to continue with that, of the entire PSU bank basket, there has been a lot of this recent outperformance, yes, but then there is, of course, this question of more supply coming in terms of QIP and so on and so forth. Would you stick to the larger PSU banks here, or would you go on with the private lenders, which have been recent outperformers and hitting new highs, say the HDFCs and the ICICIs?
The PSUs have been are cheaper, and we are now getting to a stage where we are in the poorer asset accumulation phase. You go through that phase every 5 or 6 years, where you first clean up your balance sheet, then you for some time you are in a phase where you're trying to protect your balance sheet, then you want to muck it up, and then you get into NPAs. So we are in that muck it up stage. So at this stage, the growth will be better for PSUs and for NBFCs, because they are the ones who take risky bets, and this is not a good time. I mean, this on the face of it looks like a good time, but this is what will lead to a poor quality asset base maybe a couple of years down the road. So from a performance point of view, in terms of reported numbers, you will find PSUs probably doing well. And given the fact that liquidity is not a concern right now, therefore raising money is not an issue. For the private sector banks, typically when the markets are tighter, that's when you would expect to make more money. But private sector banks also have, compared to the rest of the market, they're relatively cheap. So while they are now made up most of the under pricing, as it were, they are still not at a premium to where they could be. So I would imagine that from a quality perspective, you want to be with the private sector banks. But if you want immediate growth, you're likely to get better growth, both in terms of the numbers as well as in the stock prices and the PSUs for the near term.
Okay, all right. Anand, quick question, since we're talking about banks, what about NBFCs? We're going to be having HDB Financial that's going to list. Those that bought in just before the IPO, well, they got rogered because the IPO was priced very, very low. But the demand has been good, and the stock is likely to open up, gap up, which could make other stocks look relatively attractive, going by the return ratios, going by the price to book. Anything looks good from there?
Yeah, as I said, NBFCs, this is a good time, usually because of the fact that liquidity is easy. They'll be able to borrow cheap and lend expensive, and lend to poorer quality. So both the volume growth as well as the margins will be protected. This is the phase which is the most dangerous in the financial markets, where you tend to accumulate junk. But during that accumulation phase, you are going to be able to show that you're growing very fast. So over a 2-year period, you want to worry about quality. For now, NBFCs and the companies which are lending to poor quality assets are the ones who will show you the best growth.
All right, Anand, Sudeep, thank you so much for sparing time and joining us on the show to discuss the day gone by and, of course, prepare viewers for the day ahead. Before we head into this short break, we leave you with some commentary from Mahesh Patil of Aditya Birla Sun Life on liquidity conditions and the valuation picture in the markets. Listening.
Overall, I think the liquidity flow into the markets is also improving. We've seen FIs slowly starting to come back. Domestic flows have been steady. And I think valuations were reasonable. I mean, markets, after the correction, what we saw around 6-9 months back, a lot of stocks had come down to decent level. We've seen now interest coming back, not only into the frontline names. I mean, the large caps were always looking good on a valuation perspective. But even the broader market, right, the mid cap and small cap have seen a good recovery. Although I would say that it is more stock specific in the mid and small cap. Not everything is Muda, but clearly, I think the confidence is coming back. I mean, IT sector was the first one to underperform, right, earlier because of global concerns. And I think on that front, I think US, where you were expecting a recession, the probability was much higher around, say, 3-4 months back. Now that has receded. And looks like at least the commentary also from the IT companies is that the worst seems to be behind. That doesn't mean that you will see a sharp recovery over there in terms of volume growth. It will be still slow and tepid. But I think this is a sector where I think overall stability, I think, would be there. I think the downgrade cycle seems to be behind over there. Also, the cross-currency impact also could be slightly positive, at least in this quarter.
Welcome back. You're tuned into Markets Forward. Well, let's go across and get in all the key corporate commentary that we got during the course of the day. First up, Indian Oil Corporation. The management says that the Israel-Iran conflict did cause short-term price volatility. However, the market stabilized quickly after the ceasefire announcement. They added that it didn't see any impact on crude supply as it sources crude from 38 to 40 countries. While 40% crude comes in from West Asia, it doesn't import any oil coming in from Iran. They also went on to talk about the Nagapattinam plant, which is more of a petrochemical plant than a refinery.
Next up is PTC Industries. As subsidiary Aeroalloy Technologies' latest MOU with Safran Aircraft Engines for military operations. Now, under this pact, both companies will co-develop aircraft engine components. The management of PTC Industries sees this as a strategic fit with their existing investments in the aerospace sector and believes that it holds huge potential. Now, they also hinted at more such agreements in the next 6 months. And that's not all. The management also gave guidance for FY26. Now, it expects revenues to almost double with margins to be over 20%. Further, it is targeting a top line of over 3,000 crore rupees with over 30% margins by FY29 and FY30.
Well, next is Texmaco Rail and Engineering. It's making global strides after securing a 535 crore rupee order from Cameroon's Kamalka for wagons and their maintenance. They added that margins should be in high teens for the recent order. It expects exports to contribute 30% of revenues in the next 3 to 4 years and is guiding for a 15 to 20% top-line growth with margins in the low to mid-teens by FY26. The management says that woes around the wheel set availability will start easing post the middle of July and states that exports, well, they're not dependent on wheel set availability issue.
And lastly, we had the management of Zydus Wellness on the channel, and the management says that due to the unseasonal rains, Glucon-D and the Nycil businesses have been badly affected. Now, they added that it will maintain their double-digit revenue growth over the medium term, but expects to make up for the lost sales in this quarter over the next 3 quarters. Now, they also said that rural growth is seeing higher traction compared to urban, and that's not all. The company is looking at opportunities around clean labels and says that M&A has been part of Zydus' growth strength.
Okay, all right. Well, before we wrap up, we'll get you all the key market events you need to track. Vamakshi is joining in to fill us in with that list. Vama, take it away.
Well, Nigel, we would have hoped for a midweek holiday, but that's not the case. But who's having a midweek holiday? It's Hong Kong as well as Canada. Now, moving on to the economic cues then, India S&P Global Manufacturing PMI data is supposed to come out tomorrow, so we'll be watching out for that. The same data is expected to come out for the US markets as well. As far as Eurozone is concerned, we'll be waiting for the CPI numbers. Now, a couple of listings lined up tomorrow. It's a whole list. First up is Raymond Realty. Apart from that, we'll be keeping an eye out on a few IPOs, which includes Karpatru Limited, Ellen Bari Industrial Gases, as well as Globe Civil Projects. Now, apart from that, auto stocks will also be in focus. The sales data for the month of June will be out tomorrow, so we'll be keeping a close eye out on that. Akzo Nobel will also be in focus because they will be holding a joint press conference with JSW Paints. Saturn Credit Care also on our radar. They will be considering fundraising proposal in their board meeting scheduled tomorrow. Keep an eye out on 2 stocks, JSW Infra as well as Sarah Sanitary Ware, because both of these counters go ex-dividend.
Well, they might not be having a midweek holiday, but the US markets do have a long weekend, considering Friday is a holiday for them. Amakshi, thanks a lot for that. But we call time on this edition of Markets Forward. From Nigel, me and the team that put this show together, thank you so much for watching. More news and updates continue on the other side.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: the Sensex and the Nifty snap a 4-day winning streak, but mid-caps continue to gain for the 7th day running. Nifty has now gained more than 8% in the first half of 2025, with bank stocks leading the rally. India's trade delegation extends its stay in the United States as negotiations continue. Sources say no consensus yet on agri, dairy, steel, tariffs and GM crops. President Trump remains ambivalent about the 9th July deadline, saying he could either extend it or even cut it short. Torrent Pharma is set to acquire 46% in JB Chemicals from KKR for just under 12,000 crore rupees. Will also launch an open offer, taking the deal size to more than 19,000 crores. The deal will make Torrent the 4th largest pharma company in India. The government is likely to invite financial bids for IDBI Bank soon. Sources say officials are close to concluding the share purchase agreement with potential suitors. It's the last day for IndusInd Bank to send its candidates for CEO position to the RBI. Sources say Axis Bank's Rajiv Anand leads the race. The bank is also likely to recommend Rahul Shukla of HDFC Bank and Anup Saha of Bajaj Finance. The US Senate passes President Trump's spending bill by a slim margin. The latest version of the bill reduces the tax on remittances to 1%, but the bill stuns the clean energy industry with a new tax on wind and solar projects. At least 12 people killed and dozens injured after an explosion at an industrial area in Telangana. The blast took place at a reactor at the Sigachi Chemicals factory, which manufactures microcrystalline cellulose. Andhra Pradesh Chief Minister Chandrababu Naidu hosts tech leaders as he aims to build a quantum valley in Amravati. Naidu says IBM, TCS and L&T have formed a consortium focused on quantum computing and artificial intelligence. That's an exclusive. Zomato's co-founder Dipinder Goyal is betting big on the aviation sector. Deep dive into his investment into a startup that promises buses in the sky. That's coming up. Well, let's start with the market action. The Sensex and the Nifty snapping a 4-day winning streak, but mid-caps continued to gain today. The Sensex finally lost about 450 points and the Nifty was down by about 120 points. 0.5% cut there coming in for both the Sensex and the Nifty. The Nifty bank closing flat, mid-caps up by over 0.5%. But that's the story for today. We're also at the halfway point of 2025, and in the first 6 months, the Nifty has gained more than 8%, led by bank stocks. Hormuz is standing by now to take us through the half-yearly report card for our markets. Hormuz.
More action than in an action film, more drama than in a drama film. Well, I guess the markets have seen it all in the first 6 months of 2025, be it tariffs, be it war, be it ceasefires. And after all of this, the Nifty has trumped up with returns of 8.5% in the first 6 months of the year. And this is after an 18% recovery that the index has seen from the lows that it had made at the start of 2025. The Nifty Bank, which is already trading at record highs, is up 13% so far in the first half of this year. And this tinge of green that you see in the mid-cap and the small cap index is after a near 30% recovery that these indices have seen from the lows that they made earlier this year. Now, which have been the top performers on the Nifty in the first 6 months? No prices for guessing, but it is BEL and Bajaj Finance. The 6 months, though, belong to the life insurance companies. SBI Life and HDFC Life, both of them are seeing their second best calendar year already in terms of returns, and Bajaj Finserv, of course. On the underperformers, of course, it is the IT names that form the predominant list. TCS, Infosys, Wipro, all of them in there, along with Trent and, of course, IndusInd Bank, despite a near 35% recovery from the lows. You take a look at the mid-cap index, and Solar Industries has been the talk of the town in the last few months. Almost 80% returns in the first 6 months. Bharat Dynamics, BSE, L&T Finance is up 50% so far this year. What is down 50% this year, though, is Ola Electric, continuing to make new lows from its IPO price, along with names like Oracle Financial, Kalyan Jewellers, Premier Energies too forms a part of this list. Defense has been a common theme across the Nifty, the mid-caps and even the small caps, because Garden Reach is the top gainer on the small cap index, almost 90%. Narayana Health until last week making new highs. Reddington and Navin Fluorine, after a slew of positive brokerage commentary, is up almost 50% so far this year. And among the underperformers, though, it is names like Brainbees Solutions, Anantraj, Natco Pharma, losses of anywhere between 35 to 40%. So it's been an action-packed first half of 2025. Well, the bulls would definitely be hoping that the second half is less action-packed, but it has enough legs to take the Nifty past its record high levels.
All right, Hormuz, many thanks. That's the Nifty report card for you. It's 6 months of the year already. Now, in less than 10 days, the 26% reciprocal tariff announced by U.S. President Trump on India is scheduled to kick in. Hectic negotiations are underway in Washington as both sides aim to iron out their differences. When asked if the July 9 deadline could be extended, President Trump remained ambivalent, saying he could defer the deadline or even shorten it. Take a look.
Is that July 9th date set for tariffs to snap back, or could there be a...
We can do whatever we want. We could extend it. We could make it shorter. I'd like to make it shorter. I'd like to just send letters out to everybody. Congratulations, you're paying 25%.
We can do whatever we want. That is the inimitable President Trump there. Finance Minister Nirmala Sitharaman, meanwhile, has said that India would love to have a big, good and beautiful trade agreement with the U.S., but not without riders. Speaking to the Financial Express, the Finance Minister highlighted that dairy and agriculture are red lines that India has drawn in the talks with the U.S. The minister was reacting to President Trump's remarks the deal could soon open up the Indian market. The Indian delegation has extended its stay in Washington for negotiations by 3 days. That is till today. Abhimanyu joins us now with more. Abhimanyu, so the trade negotiations continue today as well. Take us through where things stand.
Uncertainties over the economic fallout of reciprocal tariffs still remains, as India and the US are still engaged in discussions for an interim deal and a bilateral trade agreement. India's trade delegation has extended its stay in the United States by a day, which has raised hopes for a potential interim trade deal with the United States. Last week, US President Donald Trump had indicated that a very big deal with India was likely very soon. He had also indicated that he would write letters to several countries the US is already negotiating trade deals with, and in case the deals are not negotiated before a certain point of time, those letters itself are going to substitute for trade deals. Now, it remains to be seen how early these negotiations are going to end and whether an interim deal would be signed between India and the United States. Now, concerns remain over several issues pertaining to dairy and agricultural products, in which the US has sought lower duties. It has also sought higher access, more access for GM crops, something which is being resisted by India due to domestic concerns. It remains to be seen whether there is going to be an interim deal signed anytime soon, even as Indian negotiators till now have made it clear, as per government sources, that any deal which would be signed should be a win-win situation and should not be signed out of desperation.
All right, Abhimanyu, many thanks for joining us. So the clock ticking there as far as the deadline for the tariffs to kick in 9th July is what the date is. But as we heard from President Trump, could extend it, could even shorten the date. Now, the big corporate story, Torrent Pharma is set to acquire JB Chemicals in a deal worth more than 19,000 crore rupees. The deal will make Torrent the fourth largest player in the pharma industry. Ekta is standing by to take us through the contours of the deal and the significance. Ekta, big one in the pharma space.
Well, yes, Torrent Pharma has announced a two-phase acquisition of JB Chemicals from KKR, marking one of the largest deals in India's branded pharma space since possibly the Ranbaxy-Sun merger. Torrent will first acquire 46.39% stake for around 11,917 crores and may pick up an additional 2.8% from JB Chemical employees at around 1,600 rupees per share. An open offer for 26% follows at around 1,639 rupees per share, with the total size of the acquisition for Torrent possibly going up to as much as 19,480 odd crores. Now, in the second phase, the companies will merge, with JB shareholders receiving 51 Torrent shares for every 100 held. Now, the deal values JB Chemicals at around 25,689 crores, and 11% discount to its closing price ahead of the deal. With the JB Chemicals acquisition, Torrent Pharma is now poised to rise from the 6th to the 4th largest pharma company in India. The deal, in fact, is expected to boost its domestic revenues by 35%, surpassing 8,600 crores based on FY25 numbers. Torrent will strengthen its dominance in cardiac and gastro segments, gaining top brands like cardiac drug Cilacar with sales of 785 crores and gastro drug Metrogyl at around 342 crores in terms of a size of a drug. It also secures entry into ophthalmology and expands its footprint in the global CDMO space. Torrent Pharma may in fact fund the JB Chemicals acquisition through a mix of internal accruals, debt and equity via QIP. It could take on as much as 10,000 to 12,500 crores of debt, pushing the combined net debt to around 14,500 crores and a net debt to EBITDA to around 3 times on an FY25 basis, according to analysts. However, analysts including DAM Capital are not overly concerned. They point to Torrent's steady free cash flows and believe a 2 times EV to EBITDA leverage is reasonable and the debt could be paid down in 3 to 4 years. Now, while JB Chemicals currently operates at a lower EBITDA margin than Torrent Pharma, analysts are not overly concerned about that either. Torrent has had a strong track record of cost rationalization as seen in its past acquisitions of Elder, Unichem and Curatio, which saw margin expansions within 1 to 2 years. While we could see near-term dilution, analysts believe the combined entity could target EBITDA margins of 34 to 35% over the next 3 to 4 years. Lastly, what are the brokerages saying? IIFL recommends JB shareholders should avoid tendering in the open offer and wait to swap their shares in the merger. Nomura expects the adjusted EPS accretion in the mid-single to low double digits. They maintain a neutral rating with a target price of 3580. HSBC expects the deal to be 3% accretive to FY27 estimated EPS estimates. They retained a buy with a target price of 3,775.
All right, Ekta, that's the big pharma deal, Torrent Pharma to acquire JB Chemicals. Now, at least 12 people dead, dozens injured after an explosion at an industrial area in Telangana. The blast took place at Sigachi's pharma factory in the state's Sangareddy district. The company manufactures microcrystalline cellulose and the blast is likely to have occurred at a reactor. Officials are yet to confirm what triggered the explosion. Both state and central government have announced monetary compensation for the deceased. Coal mines across India have been asked by the government to explore ways to extract rare earth minerals. The move comes amidst export restrictions imposed by China on rare earth magnets. Now, these magnets are critical for making electric vehicles. Government sources say coal mines will explore if rare earth minerals can be extracted either from byproducts or waste materials. India is widening its semiconductor ambitions beyond fabs. That's fabrication units. Sources tell CNBC-TV18 that the government has called for expressions of interest for 2D material facilities and research and development. The government is also open to funding depending on the readiness of the industry. Currently, chips are fabricated using silicon wafers. 2D materials are significantly thinner. No country or company is producing this commercially yet. Research is underway in countries like China, US, Japan, UK and Germany. Payment and identity cards maker Manipal Cards is looking to debut on Dalal Street. The company has filed a confidential draft red herring prospectus to raise 1,200 crore rupees. According to Money Control, the IPO is likely to comprise a mix of primary and secondary share sales. Currently, promoters led by Gotham Pai family hold a majority stake of 60%. Krispy Kreme's India operator Cure Foods has filed draft papers with market regulator SEBI for its initial public offer. The offer comprises a fresh issue of shares worth 800 crores as well as an offer for sale, which will see Iron Pillar, PCC, Crimson Winter and CureFit Healthcare make partial exits. The company could hit the market between November and December this year. The proceeds will be used for expansion and equipment. On to a CNBC-TV18 exclusive. The government is set to invite financial bids for IDBI Bank. Sources say officials are close to concluding a share purchase agreement with potential suitors. Shares of IDBI Bank surging in today's trade on the back of that development. The stake sale at the bank has been in several delays over the last 3 years. Sapna is here with more. Sapna, it has been in the making for a long time. Are we anywhere closer to a deal being done at IDBI Bank?
Absolutely. So this is going to be a completion of a long journey. If you can recall, way back in October 2022 was the first instance when the preliminary bids for IDBI Bank disinvestment had been called. And we are now in 2025. So what we're clearly given to understand is that probably the government is close to, agreeing or rather finalizing the share purchase agreement with potential bidders for IDBI Bank stake sale. And once that important milestone has been crossed, the next trade, of course, would be calling for the financial bids, and we are given to understand that there may not be too much of a gap between both the exercises. Of course, approval from the ministerial panel, which is headed by the finance minister herself, that will be sought, and the finance minister herself has already indicated that the government expects to close the IDBI deal in FY26. So my sense is that before H1 ends, I think the government will be in a position to call for financial bids, if not sooner than that.
Well, not holding my breath, but looks like there is some forward movement on IDBI Bank. It's been many years in the making. Thanks very much, Sapna. Staying with the banking space, it is the last day for IndusInd Bank to send names for the CEO position to the RBI. We learned from sources that Axis Bank's Rajiv Anand leads the race. The bank is also likely to recommend the names of Rahul Shukla from HDFC Bank and Anuj Saha of Bajaj Finance. The Bombay High Court has deferred hearing a petition filed by the CEO of HDFC Bank, Shashidhar Jagdishan, against the Leelavati Trust. The bank's CEO is seeking the quashing of an FIR filed against him by the Leelavati Trust alleging cheating and fraud. HDFC Bank has denied all allegations. The court will hear the case on the 14th of July. Now, 6 suitors submitted bids for Jayaprakash Associates under the bankruptcy process, but only 5 have qualified. We learned from sources that Adani Enterprises, Dalmia Bharat, Vedanta and Jindal Power are among the bidders for JP Group's flagship firm. Sources say that JP Infratech's bid was disqualified because it did not submit the deposit amount. As per banks, the government's bad bank 12,000 crore rupee offer to acquire JP Associates may have been used as a benchmark by bidders. DLF is all set for its Mumbai debut. The real estate developer secured Maharashtra Real Estate Regulatory Authority or RERA's approval for its residential project in Andheri. The first phase of the project includes over 400 apartments across 4 towers. The launch is likely in the next 2 weeks. Sources tell us the company expects sales of around 2,500 crore rupees with that launch. Andhra Pradesh Chief Minister Chandrababu Naidu hosted tech leaders from around the world as he aims to build a quantum valley in Amravati. The aim is to attract top tech companies to focus on quantum computing and artificial intelligence. Shilpa spoke with the Chief Minister, who said IBM, TCS and L&T have formed a consortium to invest in Amravati, and Microsoft is set to follow suit.
It is one more leapfrog development in information technology.
Right.
I started iTech City to promote information technology exactly 3 decades back.
Right.
Today, quantum valley for quantum computing and also artificial intelligence,
Yeah.
AI. This is the order of the day. I want to create an ecosystem for quantum computing.
Right.
Then that will be the future. I'm giving land. Government also will be a partner to this ecosystem. We wanted to take to the logical. These 50 acres of land. Land is not the constraint. Today here, TCS and also IBM and also L&T. They are all consortium. They are working together. Now Microsoft also is coming back. Today we had a discussion. They want to start quantum computing here.
Right.
We are developing Amravati today. So Visakhapatnam also and Tirupati. These are all the areas where we are having excellent advantages. Ultimately, if you give land also, people won't come. The confidence of the government and also credibility of the government is important. That we are establishing. That's why TCS has come, Cognizant has come, Google has come, RCR Mittal has come. All these industries, they started now.
Chandrababu Naidu there on their quantum computing valley that is being thought about for Amravati. Time for us to head to a short break, but up next, Zomato's co-founder Dipinder Goyal is betting big on the aviation sector. A deep dive into what his startup that promises buses in the sky is all about when we return. In a big win for the United States, Canada has cancelled its digital services tax that targeted American tech companies. Now, the move came just hours before the tax was set to come in. Following this move, Prime Minister Mark Carney and President Trump agreed to resume trade negotiations and reach a deal by the 21st of July. The implementation of the DST would have meant that digital services companies with a revenue of over $20 million in a year in Canada would have had to pay a 3% tax. The payments would have applied retrospectively to 2022, and Donald Trump had basically said that they would have no talks with Canada on a trade deal if this tax were to come through. Canada scrapping the tax, and now trade negotiations have resumed. The U.S. Senate has passed President Trump's spending bill by a slim margin. The latest version of the bill reduces the tax on remittances to 1% in a major relief for the NRI community. An earlier version of the bill had proposed to tax remittances at 3.5%. The new version, though, has stunned the clean energy industry with a new tax on wind and solar projects. Sonal is standing by with the details. Sonal, tough times for the solar and wind energy industry in the U.S. with this bill going, perhaps clearing the way.
Well, there's a new Senate bill and it has come as a surprise to the clean energy segment. The updated Senate bill has slashed wind and solar incentives. It has also added a new tax to the clean energy space. So now remember, the initial version of the bill, it required projects to start construction by the end of 2025 to get the full benefit of the incentives. However, the fresh version suggests otherwise. It says the wind and solar projects, they need actually to be up and running by the end of 2027 itself to get all the incentives. And this has come as a setback for the entire industry in the US. The legislation has also added new tax on wind and solar projects, and this is for projects which do not meet the criteria when it comes to using Chinese equipments for their projects. So this is also something which is new and that has been added to the bill. It has added that the production of coal used in steel making will also come into the credit basket. The other thing is that the bill has included quicker end to a popular $7,500 consumer tax credit for electric vehicles. They plan to end it earlier than what was expected. So earlier they expected to end it by the end of this year, but now they say it could end as early as September 2025 as well. And the entire electric vehicle industry has not taken it positively, and it has taken up a lot of criticism.
Sonal, many thanks for joining us. Now, Zomato's co-founder Dipinder Goyal is betting big on the aviation sector. Goyal has backed a new aviation startup, LAT Aerospace, that's aiming to transform regional aviation with what it calls buses in the sky. Madhya is here to explain more to us about this new venture and the plans that it has to turn this into reality. Madhya, buses in the sky?
Yes, buses in the skies. Well, we have talked about air taxis, the electric vertical takeoff and landing machines, a helicopter-like model that aims to beat urban traffic and help people with daily commute. We have some Indian startups who are developing air taxis, but those are still in the works. Some have their prototypes ready and are conducting tests. The government is yet to finalize the rules for air taxis. But LAT Aerospace, in which Dipinder Goyal has invested, has a different pitch. The startup is talking about buses in the sky, as you mentioned, that will connect smaller cities where people mostly depend on road and trains to commute, which consumes several hours or sometimes days. Now, India already has a regional connectivity scheme where airlines use smaller jets up to 80-seater to connect Indian cities, like Indigo, SpiceJet and Alliance Air operate regional flights. Then Star Air, Fly 91 are some regional players. Then we also have helicopters that can carry up to 6 people from one city to another. But LAT Aerospace is building a system designed from scratch. In a social media post, a LAT Aerospace co-founder Surbhi Das has talked about building a 12 to 24-seater hybrid short takeoff and landing aircraft that will operate from air stops. Now that sounds like bus stops, which will be no bigger than a parking lot. Built closer to where people actually live, which means residential areas. It will have no security lines or baggage belts, and people will just walk in and fly. That's the vision LAT Aerospace has. Sources tell CNBC-TV18 the company has raised $50 million, of which $20 million are from Dipinder Goyal. They are inviting aerospace engineers and designers to join their ambitious project. In fact, Dipinder Goyal in a post has promised to match or exceed on-campus offers to attract engineering graduates. He also offered ESOPs to those joining the project as the founding team. Now, the idea looks to be in concept stage, and the company will have to first build a design, a prototype, get government approval. It will have to plan on how and where to build these proposed air stops from where sky buses will operate. A key question is how it will use the existing airstrips, and will the government come up with new rules for this kind of model? It's a promising project that could revolutionize air travel, but building it from scratch means it will take longer to take shape.
Yes, it's certainly not going to happen overnight, but as Madhu was pointing out, this is a space that is broken, but it's also a space that has seen many invest and many dreams not take off. Will this one see the light of day, and what kind of rules and regulations will be put in place for this to be able to become a reality is the big question. But many thanks for joining us. With that, it is time for us to wrap up this edition of Business 360. The news will continue. Stay with us. We're watching CNBC-TV18. We're back in a moment with you.
रिटर्न ऑन कैपिटल कि अगर आप 100 रुपए धंधे में लगाते हो एंड इफ यू कांट जनरेट 15-16 रुपीज आउट ऑफ बिजनेस, तो उस बिजनेस का मतलब क्या है? फिर तो आप जाके अगर 7-8% ही करना है तो आप एफडी में पैसा रख दो. वन ऑफ द कंपनीज which is now known in the market is a company called Solar Industries. Today, the market cap is 1,50,000 crore. When we identify, it was a 1,000 crore market cap. Narratives will work for a while, but finally, top line is vanity, bottom line is sanity, and cash in bank is reality. It's the promoter. He's the friend, he's the enemy.
Make or break.
Make or break. वही बनाता है, वही बिगाड़ता है. There are pockets of bubbles. I am completely acknowledging that. But it should not be painted with the same brush that everything is expensive.
I remember meeting Rhythm Desai at the Morgan Stanley conference, and he actually went on to say that Indian stocks are cheap.
Yeah, I mean, you have to search your pockets. And I think ये मेहनत करने का time है. For you have to go at the ground level, search for companies, search for good promoters.
Hello and welcome to Market Cafe. We are in conversation with Pankaj Tibrewal, someone who is known as one of the most celebrated mid-cap and small-cap pickers, fund managers of the country. Over 14 years of experience just with Kotak Mutual Fund, and if you put it all together, we're talking well over 2 decades of experience. And in the earlier part of this conversation, you heard us discuss, of course, the current market order, how this is a changing market. But now it's time to get a little deeper into the mid-cap stock selection process. So Pankaj, we've had a good conversation so far, but I have more questions for you. Now let me turn this around. How to use these filters carefully to avoid getting into a stock that could tomorrow become a penny stock?
Yes.
So again, give us some examples where you realize that the story is going off track and it's time, now there's a red flag, it's time to check out. And which were those filters, or you know, what told you that, okay, now my antennas are up?
So I think cash flow conversion is a very, very important part. So I said 70% cash flow conversion should happen. It's a basic thumb rule. I think wherever we see lower cash conversion is a important red flag over a period of time. So EPS growth is improving, but top line is improving, but cash flow is not. Operating cash flow, then there's a problem. The second important part to note, Surbhi, is that in one of the forensic which we have, it's very important to note profit minus dividend should add to your shareholders fund, net worth, जो भी आप बात कर लो, book value, shareholders. In many companies which are listed, we see that EPS growth is happening, but book value growth is zero. Why? Because the write-offs they need to take from P&L, they are taking from balance sheet. Okay. Third, auditor's remuneration. So we see that in many places, auditor remuneration growth is much higher than the revenue growth. Why is that happening? So, you know, if you go by a proper forensic, I think it's a very, very important piece that you will avoid big mistakes.
Sure.
And one important thing we have learned from a theory of inversion over a period is that people look at multi-baggers. We went into the history of last 20, 25, 30 years and said, what are the reasons which led to companies becoming penny stocks of value destruction? So leverage was one. Cash flows being weak, siphoning of cash, taking it to offshore entities was another. Capex untimeliness was another. Capital cycle wrong was another. One interesting thing which applies to Indian markets which we saw, that most of the companies which destroyed wealth never had lady family member as a part of the board.
Companies that destroyed wealth never had lady family members on the board. How interesting is that? And what's the correlation?
It just came out as a point that in India, we all are very protective about the lady of the house. Mother, wife, daughter, sister, whoever it is. And if promoter is doing any hanky-panky, he himself knows first. So he is of the Indian psychology is like, if any trouble comes, I can bear that trouble, but none of my other family members should have that problem. So the moment he sees some problem coming in, he separates at least the lady family member of his. So there could be genuine reasons also. Like in a chemical factory, fires are a common nature. Board of directors are liable for it. So you understand that. But whenever we see a lady family member being part of the board, we get excited that it's a hygiene check.
Oh, okay.
So it's
Interesting.
so it's a small, kind of an anecdote we have discovered. When
Women add to the trust factor.
It adds to a lot of trust factor.
That's good to know.
Especially men in India, they don't want trouble to happen to the lady family member out there. So these are small hygiene checks which we do, and we have created a template that galtiyan kam ho. I think if you can avoid big mistakes in this market, I think market will be rewarding to you. But if you make big mistakes, then markets will not be charitable. Market is investors are okay, आप 2-3% return कम दोगे, कोई नहीं बोलने वाला है. But the moment you are associated with something which destroys wealth, I think market is unforgiving on that side. So we have to avoid big mistakes. I think that is one my key learning. Ki have a process, and that process will only help you navigate cycles across the board. Otherwise you will fall into that trap and make big mistakes.
Of going for something that's sparkling.
गलतियां होंगी, छोटी गलतियां हो तब तक ठीक है, लेकिन बड़ी गलतियां जहां पर कैपिटल लॉस होना वो नहीं होनी चाहिए.
That really hurts then. Okay, so tell us through your investing career, which have been the 1 or 2 or 3 stock calls that are the closest to your heart for whatever reason. I mean, I'm not saying only because they might have been the biggest wealth creators. Could be something else, could be a new industry, but the 3 calls that were closest to your heart in 2 decades.
So one is
Solar,
for example, and that one of the things. The second one was Dixon.
Okay.
And I still remember in Dixon when the IPO came, there was a lot of apprehension that it's a electronic assembler, wafer thin margins.
Correct.
But what people missed out, that their balance sheet was super strong. And they had a negative working capital they were operating in, which is very important in this business, that they are not risking balance sheet because wafer thin margin. And they built on size and scale. From IPO, they have not raised any capital. And see the size they have created and became India's largest electronic EMS player. And we were betting on very early. The promoter and the person who is managing, Mr. Atul Lal, fantastic people. So again, the bet on those guys that they understand business and they want to move ahead into the value chain. And that is the time when India came up with the indigenous electronic manufacturing, PLI and all those things. And look at the size and scale today.
And they're still reinventing themselves from laptops, then now they're talking semiconductors,
everything.
all of
that.
So
once you get a scale and size, I think what I have realized that size gets created automatically. So I think that's another company which is close to my heart. The another one is a company on chemical side called SRF and Alkyl. So these two, and they could be part of my portfolio. I'm just giving a disclaimer right now. But the point I'm trying to say is that these companies have shown size and scales over a period of time. And look at the way SRF moved into chemicals, specialty, fluoro, and the way from there the size got created. And the another great entrepreneur whom I admire is Mr. Velayan. Look at the way he has turned around things across the Murugappa Group companies. So I think India is full of opportunities, entrepreneurs. And whenever you go down, I feel so excited and kicked. Ki boss, kitne entrepreneurs hai India mein?
You just have to bet on the
right ones who can scale size and scale. So whenever people say कि opportunity नहीं है, I somehow feel कि मैं कोई गलत कर रहा हूँ क्या? But over a period of time, I think you have to pick the right businesses, right promoters, and I think most of the job is done. So all these examples are just examples, nothing to buy and sell.
No, absolutely,
but just
your journey.
And बहुत सारे ऐसे सारे companies आए और गलतियाँ भी हुई हैं. ऐसा नहीं है कि गलतियाँ नहीं हुई हैं, but कोई भी गलतियों ने capital zero नहीं किया. So we were early on to identify those mistakes and move out. Either there was red flags on governance, either the red flags on cash flow or balance sheet, and then we were, early enough to act on that. So we may have done a 10-20%, 15-20%, 25% loss. We moved out, but then we were kind enough to accept that.
Give us one example of such a mistake, because it's important to learn from and mistake is not a mistake if you realize it quickly enough and take the corrective steps.
So I'll give you a small example. We were invested in one EPC company. into road infrastructure.
Okay.
The company was doing well, everything was okay. But quarter after quarter, the operating cash flow was negative.
Okay.
Company was giving all kind of explanation, but something was fishy. So what we did, we sent one of our analysts to the sites. Across 5-6 sites he went into where the project work was going on. And during conversation, it came across that the salaries got delayed for more than a month.
Oh.
That was a red alarm. Ki cash flows are so tight that the company is not able to pay salaries.
Salaries on time.
And salaries is the key important basic ingredient you have to pay. So that analyst came and said, there's some delay in salary. I said, no question asked. And we were fortunate enough to get an exit because somebody else was buying a block because EPS growth was looking very strong for the next 2 years.
So you decided to exit even though there was some growth visibility.
The 2 years the company kept on growing.
Okay.
But cash flows never came. Debt came in, started to increase.
Okay.
And today, I still remember it was, price was 240 or 250 rupees. Today it's a penny stock with, I don't know, 3, 4, 5 rupees. I haven't seen the price also. But I think taking that call early on where cash flows gave you that indication that something is not going right. And I think that was the key from a balance sheet and cash flow perspective. So on the hindsight, you look like saved. But
That's
I think
amazing,
those basic filters always help you. That's why I think process is underrated.
So promoter, cash flow,
balance sheet, cash flows, and then growth is also important, obviously.
Of course.
Otherwise, it's a value stock. So growth and cash flows go hand in hand over a period of longer periods of time. And I think companies which have created value and wealth, they have managed with growth along with cash flow and balance sheet.
Now that we've got the whole framework and the whole classroom and we've taken our notes down, let's apply it to the real world, the here and now. So tell us what excites you in the mid and small cap world today. I know in the past in our conversations you mentioned, chemicals is a sector, some parts of pharma, you mentioned I think auto ancillaries as well. But just expand on that, what is exciting you in this mid universe?
So I think it's as you said, bottom up market. There are various opportunities which I see which is changing in the overall landscape, which is changing. And many companies whom we are meeting today, I think it's real that the kind of inquiries over the last 2 months have gone disproportionately higher. So I'll give you a small example. We met one consumer unlisted company. It's a household brand. For 3 years, they were trying in the US markets. Product was approved, but they were not competitive enough with China. Chinese were, at a very, very low price. Suddenly post this tariff thing, all the three large buyers in US came to them and said that we want to book your capacity for next 3 years, right? He said, we are surprised, but we want to do work at our conditions. We said that we'll work with advance. The guy came in and gave advance, one of the guys. So I'm just saying that the landscape is changing and there will be many opportunities across auto ancillaries, for example. Many companies are pivoting themselves from pure auto to non-auto, which is defense, aerospace, semiconductors, because their precision engineering skills are very high. And world needs those kind of companies from a non-auto perspective. So many companies' texture will change. Chemicals is important, where CDMO, the entire contract manufacturing, production of various chemicals which are sourced from China, that will become a very large scheme to go with. Then you have the pharma CDMO players. I think incrementally big pharma and other big agro guys are coming to these companies and saying that, can you do a 3-year, 5-year, 10-year contract with us? So incrementally, I see there is a large opportunity. Electronics, another one. We haven't even scratched the surface right now.
But that's where you said valuations could
Valuations are expensive, but backward integration, one the companies who can do that, expand the scope, I think they will be the winners over a period of time. Then you have the financials. It's a slow growth year this year, but I think over the next 2-3 years, what RBI has done is created abundant ecosystem for them to grow now. So
and what in financials? Because it's a very large universe, lenders, NBFCs, non-lenders.
Initially, I will be focusing on NBFCs this year and private sector lenders for the next year, because growth will be front-ended for NBFCs this year. And then you have various other bottom-up ideas which are there in the market today. So I believe that yes, there are pockets of overvaluation, one has to avoid it, but alongside, I think there are many opportunities. Consumer discretionary. I think if my belief is this could be the best Diwali we have seen in many years.
For consumer discretionary.
For this discretionary, because see,
so jewelers.
So retailing, fast fashion, footwear, consumer durables, because you have cut interest rates, you have provided money through tax rate cuts in the hands of consumer. So second half of this fiscal, I think you
There's
could
some cash to spend now.
Finally. And look at last cycles. The consumer transmission used to take time when the interest rate cut used to happen. Now more than 45% of your loans outstanding on the consumer side is linked to external benchmark,
so
which
that's
is
instant.
Instant. So वो सारा immediately हो जाता है. So you will have that money in the hands over a period of time. So I think over next 1 or 2 years, I think consumption revival is looking for real. May not be through staples, because staples is a saturated category in many places, but I think through many discretionary categories, I think that sector on a bottom-up basis is also looking quite okay. But I think you need to pick your, from a bottom-up basis.
That's where you start applying the filters. Pick the right companies, the right management.
So top-down आपको पता है, and then try and apply those filters. And capital goods in some areas where in T&D space, for example, transmission and distribution, I think there's a huge amount of spend happening globally and locally. That's an inflection point which I see. So there are many opportunities based on valuation, based on other filters. You have to just go and pick the right winners.
Wow, that's great. So now I'm going to ask you the final question, which I said I'll come back to, and that is this whole valuation beast. Many a times in our market, when you find a company that's giving you growth, management seems clean, and balance sheet looks okay, it comes at a cost. That PE will be 70 times, and you might say, "Ki, to bahut expensive hai, I won't buy." Then it'll be 80 times, then it'll go to 90 times, and you just wonder. So I'm sure investors, even retail investors, feel this conundrum.
Yes.
ये महंगा है कि नहीं महंगा है? ये महंगा है तो like how we Indians sometimes we say कि quality चाहिए तो पैसा खर्च करना पड़ता है. That when we go shopping, that's sometimes you think of that. So how should we think about valuation and what price is okay to pay for a good company?
See, it's a big conundrum right now, because companies which are growing are at crazy multiples. Companies which are good but not growing, nobody cares for them right now. And over a period of time, what we have understood is growth is the horse, valuation is the cart. So till the growth drives, valuation follows. And we have seen in many companies, they grew at 25-30%, valuation became crazy. And the moment growth slows down, de-rating happens.
Correct.
So I think in Indian markets, people buy and come to Indian markets to invest is because of growth. Right?
Yeah.
And we saw last year, when the growth slowdown happened,
Yeah.
foreigners sold off crazily.
Yeah.
And you saw a market correction.
Yeah.
So my sense is growth should not be ignored. And that's one thing. And rather than looking at pure PE, which normally every investors look at, I think what to look at is PEG, PEG. That if a company is growing at 25-30%, I'm okay paying a 40-45 time multiple, which means a PEG of 1.6, 1.7, right? The problem arises when you pay PEG of more than 3 times.
That's when it's...
That's where over a 3 or 4 year period, you don't make money.
Yeah.
So the sweet spot is between 1 to 2 PEG. And I think rather than looking at pure P in its absolute terms, start tracking PEG, which will, for per unit of growth, what is the price I am going to pay and how sustainable that growth rate is over a longer periods of time. And that's a subjective assessment one needs to do. And I have made huge mistakes, Surabhi, over the past, where I thought absolute term mein bahut महंगा हो गया, बेच दो. And the company kept on growing and became 10x and 15x from there also. So error of commission is one thing which we spoke about, but error of omission in the life of a fund manager is also a very, very important thing. Because somebody else as a competition is owning it, they have ridden the entire thing, you underperform. Either the indices or the relative pace. So I think omission and commission have to be taken separately. And one learning has been till the company is in a growth pace and you are on it, don't sell it till you get a sign of growth slowdown.
Okay, so go for growth, but then be cautious, apply the right filters, look at management quality, look at cash flows, and then
And just
make a
one more
decision.
thing, everybody is looking to time the market. When markets came to 22,000, people said, "Ab to 20,000 aane do, Nifty, then we'll buy it." But one thing which people are missing, Surabhi, is that 6 months back, our 10-year bond yield was 7.25. Today it's 6.25. So a 13% re-rating in PE has just happened in the last 6 months because of the bond yield coming down, right? And if you were waiting at 20,000 Nifty, automatically that number is now 22.5, 23,000 on the base case. So markets in our view will be in a range bound for some time. Pick up your right companies which will show you earnings growth. Don't overpay for valuation on that side. Otherwise, if growth slows down, you will be caught in a bad thing. So it's not an easy market. It will be a tough market for next 12 to 18 months with geopolitics, interest rates in US being high. So all kinds of headwinds globally are there. And you have to pick up the right winners who can adjust to these headwinds and navigate their way to growth.
Okay. What a fabulous, fabulous conversation, Pankaj. This truly feels like a masterclass. When I started the conversation, I thought it's going to be light and easy, but I'm so glad we did this because I think in a complicated environment, volatile markets, and shifting patterns of investing, I think it's really important to know what the brass tacks are. Especially if investors, if you're going to put it through a small cap fund or a mid cap fund, that's fine. Leave it to experts like Pankaj. But if you're doing it yourself, then I think what you've given us are some fantastic golden thumb rules, and I think that'll help investors and go a long, long way.
Thank you.
Thank you so much.
Thank you.
Really appreciate you
sir.
joining us today and spending the time. This was a great conversation.
Thank you. Thank you.
All right, viewers. Well, with that, it's a wrap on this edition of Market Cafe. Thank you so much. We'll see you again soon with another conversation.
Hello and welcome. You're watching News Center and I'm Parikshit Luthra. In less than 10 days, the 26% reciprocal tariff announced by US President Trump on India is scheduled to kick in. Hectic negotiations are underway in Washington, D.C. as both sides aim to iron out the differences. When asked if the 9 July deadline could be extended, President Trump remained ambivalent, saying he could defer the deadline or even shorten it.
Is that July 9th date a set for tariffs to snap back, or could there be a...
We can do whatever we want. We could extend it. We could make it shorter. I'd like to make it shorter. I'd like to just send letters out to everybody. Congratulations, you're paying 25%.
And Finance Minister Nirmala Sitharaman has said that India would love to have a big, good and beautiful trade agreement with the US, but not without riders. Speaking to the Financial Express, Finance Minister Sitharaman highlighted dairy and agriculture are red lines that India has drawn in the talks with US. The minister was reacting to US President Donald Trump's remarks that a deal could soon open up the India market. The Indian delegation has extended its stay in Washington for negotiations by 3 days till today. Abhimanyu Sharma has all the details.
Uncertainties over the economic fallout of reciprocal tariffs still remains as India and the US are still engaged in discussions for an interim deal and a bilateral trade agreement. India's trade delegation has extended its stay in the United States by a day, which has raised hopes for a potential interim trade deal with the United States. Last week, US President Donald Trump had indicated that a very big deal with India was likely very soon. He had also indicated that he would write letters to several countries the US is already negotiating trade deals with, and in case the deals are not negotiated before a certain point of time, those letters itself are going to substitute for trade deals. Now, it remains to be seen how early these negotiations are going to end and whether an interim deal would be signed between India and the United States. Now, concerns remain over several issues pertaining to dairy and agricultural products, in which the US has sought lower duties. It has also sought higher access, more access for GM crops, something which is being resisted by India due to domestic concerns. It remains to be seen whether there is going to be an interim deal signed anytime soon, even as Indian negotiators till now have made it clear, as per government sources, that any deal which would be signed should be a win-win situation and should not be signed out of desperation.
All right, let's move on. The US Senate has agreed to advance President Donald Trump's big, beautiful bill by a slim margin. The Senate will now debate the bill before a final vote takes place. The bill proposes $4.5 trillion worth of tax cuts and reduced spending on Medicaid, food stamps and other programs. As per an analysis by the Congressional Budget Office, the bill could add over $3.9 trillion to the national debt. The latest version of the bill reduces the tax on remittances to 1% in a major relief for the NRI community. An earlier version of the bill had proposed to tax remittances at 3.5%. According to RBI's March 2025 report, the US accounted for 28% of India's total remittances of $118 billion, which would amount to $33 billion in the financial year 2024. To discuss what this move means for NRIs, students and those working with their families in the United States, I'm now joined by Lloyd Pinto, partner, US Tax at Grant Thornton Bharat. Thank you very much for joining us on the show today. Lloyd Pinto, definitely a relief for people who are working there on work visas. But could you give us a sense whether this remittance tax impacts all categories of Indian visa holders in the United States?
At this point, yes. The only exemption earlier was for citizens. The current version of the tax applies to any remittances made by non-citizens outside the US. The good part is the Senate version of this bill has an exclusion for transfers that are made via banks and other accounts held at financial institutions, and also those funded via credit and debit cards issued in the US. So that's a huge relief. The earlier version had is simple tax on all remittances made outside the US, and that would have been a non-creditable tax, so it would have been an additional burden on any transfers that would have been made outside. The current version only applies to remittances where it is funded by cash or other similar physical instruments, but would not apply to transfers that are made and funded via US bank accounts and US debit and credit cards. So I think that's a huge relief for the entire NRI and other visa holders living and working in the US.
Any possibility of refund as per the terms of this bill, and who all would be eligible if there is such a clause?
At this point, there is no ability to take a refund. It's a cost. So if it applies to any remittances, it would be an additional cost over and above the income tax that somebody would have paid on that income.
Have you been able to do any calculation as to what a 1% remittance tax would impact the flow of remittances from US to India?
At this point, we don't have any estimates on that, considering it's 1% vis-a-vis the earlier 5%, which would have been quite significant. I don't think it's going to be a major impact to individuals who have accounts with financial institutions. This could impact perhaps people in the informal trade, having cash balances and having to use cash to make remittances. But we expect that to be a comparatively lesser amount compared to the larger population that would have more formal channels of transfers.
Right. I would also like to ask you about the impact on Indian IT companies functioning out of the United States. What's the larger impact that you see there?
Yeah, I think a couple of provisions that are important to Indian technology companies who have operations in the US. One major provision is the BEAT tax, or the base erosion and anti-abuse tax of 10%. It was earlier, as per the earlier TCJA Act of Trump in 2017. There was a sunset at the end of this year, and that tax was supposed to go up to 12.5%. That tax has now been reduced to 10.5%. The Senate Finance Committee had a very interesting provision that they had released in the middle of June, where there was an exclusion for transfers or payouts made to offshoring entities where they are appropriately taxed or highly taxed. It is known as the high tax exclusion. Unfortunately, the final version of the bill does not have the high tax exclusion. So yes, technology companies who are expecting that relief may be a bit disappointed. So the tax rate benefit, yes, from a 12.5%, it's down to 10.5%. So that's a relief. But if there was a high tax exclusion as well, that would have been a much bigger relief to Indian technology companies.
Right. You mentioned the impact on Indian businesses, but overall, do you think this bill will make it less attractive to invest in the United States?
Overall, I think the provisions are a mixed bag. One of the more hotly contested and debated provision was the revenge tax, sort of the income tax version of the reciprocal tariffs that we saw on the indirect tax side. Fortunately, there has been negotiations with several countries, the G7 also trying to negotiate with the US. And the latest version of the Senate bill does not have the revenge tax or the Section 899 tax that we were talking about. This was supposed to apply to companies operating or headquartered out of countries which has what the US would call unfair taxes, like the Pillar 2 taxes or the diverted profits tax, like what the UK or the Australia has, or the digital services taxes. So those countries where you had these kind of taxes, the US wanted to retaliate and impose a higher degree of taxes on companies which are headquartered in these jurisdictions. But fortunately, the latest Senate version does not have the revenge tax included in the final bill. So that's, again, a positive for international businesses.
Right. I would also ask you about the further downside risks to the dollar. Do the changes to the bill address those concerns?
To some degree, perhaps, but I think with the major addition to the US debt, there could be definitely some impact on the exchange rates. As you mentioned, the Nonpartisan Congressional Office has predicted that about 3.9 trillion will be added to the US debt. So, of course, that is likely to have some impact on the exchange rates as well.
All right. We've run out of time, but thank you very much, Lloyd Pinto, for joining us with that update. Let's move on. The updated version of the Trump spending bill has stunned the clean energy industry with a new tax on wind and solar projects. Sonal Bhutra is here with the details.
Well, there's a new Senate bill and it has come as a surprise to the clean energy segment. The updated Senate bill has slashed wind and solar incentives. It has also added a new tax to the clean energy space. So now remember, the initial version of the bill, it required projects to start construction by the end of 2025 to get the full benefit of the incentives. However, the fresh version suggests otherwise. It says the wind and solar projects, they need actually to be up and running by the end of 2027 itself to get all the incentives. And this has come as a setback for the entire industry in the US. The legislation has also added new tax on wind and solar projects, and this is for projects which do not meet the criteria when it comes to using Chinese equipments for their projects. So this is also something which is new and that has been added to the bill. It has added that the production of coal used in steel making will also come into the credit basket. The other thing is that the bill has included quicker end to a popular $7,500 consumer tax credit for electric vehicles. They plan to end it earlier than what was expected. So earlier they expected to end it by the end of this year, but now they say it could end as early as September 2025 as well. And the entire electric vehicle industry has not taken it positively, and it has taken up a lot of criticism.
All right. Thank you very much, Sonal Bhutra, for joining us. Time for a short break, but coming up on the other side, an exclusive conversation with Andhra Pradesh Chief Minister Chandrababu Naidu as he hosts tech leaders to aim to build a quantum valley in Amravati. That's coming up on the other side.
In 2009, that was a pretty personal experience that you had to go through dealing with cancer.
You know, what happened was that in 2009, I was going to London on a flight. And then I noticed a small red dot of blood when, on the tissue. It recurred after 2 or 3 months. So I went through a colonoscopy process. They found 2 polyps. One had cancer, one did not have cancer. But fortunately for me, the cancer had not touched the wall of the colon. But there was no way to be sure. So I had to go through a 7 or 8 hour surgery where they removed 18 centimeters of the colon. And then they tested that, and fortunately that did not have any malignancy. So the point I'm making is that life is so uncertain. I mean, I had no health issues till that moment. And then suddenly out of the blue, this comes up. So it makes you realize that
the fragility of it.
The fragility of life.
But did it change?
It changed me. Till 2009, I never took holidays. You know, when I got married, as a Parsi, our marriage happened in a fire temple, early morning. And after marriage, I went home, changed, and went to work. I'm not
Are you
joking.
serious?
I'm serious.
And you're still married?
And I'm still married. And then I went in the evening back home and changed all that.
The Andhra Pradesh government is gearing up to develop and launch a 50-acre quantum valley in its upcoming capital, Amaravati, as it looks to be a front runner in the space of quantum technology, not just in India, but across the globe. And this is one of the many other initiatives that the government wants to take on the front of technology to develop the state of Andhra Pradesh, especially Visakhapatnam and Amaravati, as the next big tech hubs after Hyderabad, Bengaluru and the likes. This also marks 1 year of the formation of the Andhra Pradesh government under the leadership of the now Chief Minister, Mr. N. Chandrababu Naidu. Now, to discuss the vision that the state has when it comes to quantum technology and in terms of what the 1 year has looked like, I'm joined by the Chief Minister, Mr. Chandrababu Naidu. Sir, thank you so much for speaking to CNBC-TV18. It's an absolute pleasure, especially at a time where you've completed 1 year at the government. But let's start talking about the Quantum Valley mission. You know, I've heard you talking to the executives earlier as well, and what has been spoken before. So what I understand is about the first phase will start on the 1st of Jan 2026. Can you start off by telling me what's your vision in terms of what this will do, especially for the governance and for governments as well? I believe that's a very unique position you want to take.
No, it is very... One word I can say, it is one more leapfrog development in information technology.
Right.
I started iTech City to promote information technology exactly 3 decades back.
Right.
Today, Quantum Valley for quantum computing and also artificial intelligence,
Yeah.
AI. This is the order of the day. I want to create an ecosystem for quantum computing.
Right.
Then that will be the future, and also start backward, forward integration, how to write algorithms, academic excellence, and also players I want to bring,
Right.
industry
Right.
and governments and companies to take forward, and also institutions of excellence, IIT Chennai, IIT Tirupati and other leading institutions,
Right.
how to build this ecosystem.
So this is going to be a PPP model, right? So what is the government going to offer, and what are the companies that have already come forward, and what are they going to build?
No, I am giving land. Government also will be a partner to this ecosystem. We wanted to take to the logical. These 50 acres of land. Land is not the constraint. In Hyderabad, originally I gave piece of land for iTech City. That was the first mover where we started information technology. Today here, TCS and also IBM and also L&T. They are all consortium. They are working together. Now Microsoft also is coming back. Today we had a discussion. They want to start quantum computing here.
Right.
So this is the new area. Lot of encouragement, and also so many people are curious, and everybody is working now. Now everybody, industry is thinking how to use for their operations. Either pharmaceutical companies, even in biotechnology, even other industries, logistics, everybody is working now.
Right.
Now I created a thinking for very clearly. Everybody is thinking what is quantum computing, how it is going to help them for their industry or academic excellence.
Right.
So many areas we are working.
Right.
I wanted tomorrow we are having a conference. We are going to declare Amaravati Declaration tomorrow evening. By January 1st, we are going to start first quantum computing center in Amaravati.
Right.
This is the first of its kind in India. As you are aware, India is very strong in information technology.
Yep.
That was first mover advantage in 1995. Now quantum computing, we are taking first mover advantage again.
Right.
This will be a game changer. You are going to see the change another 10 to 15 years time.
Mr. Naidu, I want to talk to you about, 1 year of you, completing 1 year as a chief minister after such a historic win. As things stand today, what would you define have been the biggest achievements for you in the past year?
Andhra Pradesh brand during my tenure was very strong. For the last 5 years, they destroyed the brand of Andhra Pradesh. They made all institutions defunct. And also Andhra Pradesh state is in financial doldrums. 10 lakh crores credit. And no investment has come. These are all the problems we are facing. Now, within 1 year time, out of 95 centrally sponsored schemes, I was able to revive nearly 87, 88. Then at the same time, 12% growth we are able to achieve first year. First year I came to government June. It is calculating March to April. We are able to reach 12% growth rate. And also we are able to attract 9,90,000 crores worth of MOUs.
Right.
1 year we are able to ground 5 lakh crores.
Right.
We are going to create 4.5 lakh employment. You name any brand now, starting with Tata, Google, RCR Mittal, BPCL, Adani, Ambani, Jindal, Birla, and everybody is in LNG.
Right.
Everybody has come to Andhra Pradesh.
Right.
That is the biggest achievement.
You know, these industries and these companies that you're talking about, what are the kind of incentives that you're offering across industries, you know, to bring in more investments and make the state more competitive compared to a Hyderabad or other cities?
No, generally, original Hyderabad, 25 years back, nothing was there.
Yeah.
That was barren land. I started with high-tech city. Then I promoted one by one all over the world. Not only information technology. I promoted Genome Valley. I promoted pharmaceuticals. Then I promoted financial district, service sector. Today, either Telangana service sector contribution, if you see for GSDP, 67%, highest in the country. Even Andhra Pradesh, 46%. So that is the foundation I laid. Outer Ring Road, airport, and Gachibowli, high-tech city. These are all the areas we built. Because of that, now they are getting very good income also. Same thing we are developing Amravati today. So Visakhapatnam also, and Tirupati. These are all the areas where we are having excellent advantages. Ultimately, if you give land also, people won't come. The confidence of the government and also credibility of the government is important. That we are establishing. That's why TCS has come, Cognizant has come, Google has come, RCR Mittal has come. All these industries, they started now.
Right, right.
Only green energy, we are going 10 lakh crores investment.
You know, a lot of these ambitions that you talk about, that you want to build in Andhra Pradesh, you know, you have also said in the past that when you took over, you didn't start at zero, you actually started at minus. And a lot of these ambitions that you have require a lot of capital expenditure. How are you going to look at that, you know, especially when the state is reeling at a debt of about 10 lakh crores? How are you going to finance this?
No, all mega projects always I used to dream. I used to conceive, not small projects. Now, 95,000 crores BPCL. I clinched it. They are going ahead. I give best incentives. Even I have given this RCR Mittal 1 lakh crores. Or first phase 65, next phase another 70,000 crores. So everything we are going in a mega scale. And also we are giving incentives. If they start industry, then employment will come. Then they will pay GST. In turn, I have to pay back incentive. It is linked with the GST and their incentive.
Okay.
Ultimately, outgo will be not totally. I will get some money for building ecosystem and revival of economy.
But these take years to realize, right? So in the interim?
Interim, what I'm saying, tomorrow they will start the project. I will get GST.
Okay, fair enough.
Then it is always development should take place. Wealth has to be created. In the process, government will get revenue. And revenue can be reutilized for development, again welfare. It is a cycle.
Got it.
Without wealth, what can you do?
Fair.
Some people will do only welfare. That is where I'm saying from the beginning, they don't have any right to distribute welfare without creating wealth.
Got it. It's an absolute pleasure speaking to you. Thank you so much.
Thank you. Very nice.
Iran have been adversaries for nearly 5 decades, but the US had never bombed Iran in all of these years until now. Now, things change fast in Donald Trump's America. Despite a lack of public support and opposition from influential right-wing personalities, President Trump chose to drop 75 bombs targeting 3 nuclear facilities in Iran. What followed was a period of heightened uncertainty. Iran chose to stage an attack on a US military base in Qatar, which was largely foiled. Trump then announced a ceasefire. He also scolded Israel for flouting it and ordering fighter jets to turn back. 48 hours since, the ceasefire appears to be holding, at least for now. Amidst all of this, stock markets across the world were relatively calm. There was no flight to safety. Assets like gold, US Treasuries saw modest gains. Crude oil prices swung wildly, but then cooled after the initial surge. In fact, stock markets in Israel hitting a record high. Stocks have surged across Kuwait, Oman, Saudi and elsewhere, even as ballistic missiles were flying over the region. The Nifty, by the way, back home is just over 3% away from its record high. So what is going on? Why are investors unruffled by this latest Middle East flare-up? Are the markets being complacent, or do they actually get the pulse right? This is the editor's playbook. In each week, our team of editors will put the spotlight on the most compelling events across the world and try and decode what they could mean for India. I'm Shireen Bhan. With me, Prashant Nair, Nimesh Shah, Parikshit Luthra, Surbhi Upadhyay and Sri Ramayar. Welcome, guys. And Surbhi, thanks very much for joining us. You know, as I was pointing out, here we were talking about bombs being dropped, nuclear facilities being targeted, headlines were virtually writing themselves every single minute, and yet markets resilient across the board, Surbhi. And just explain to us how resilient the markets truly have been in the last few days, because sometimes we tend to forget, but the data actually presents a startling picture.
Absolutely, Shireen. Thanks for picking up this great topic, because I think, speak for Prashant, Nimesh, and myself. We were scratching our heads for the better part of the last, 7 to 10 trading sessions, watching these missiles fly, and the market just kept rising and rising and rising. And of course, now we know that things have eased off. But even back then, when you tried to get to the pulse of it, for me, 3 things really stood out. Number one, and we know now, benefit of hindsight, that there was no lasting impact on oil prices. We had about a $15 flare-up, and oil prices came right back. The Strait of Hormuz, as has been the case in history, was never closed. So that's point number one. I'll just tell you why that's important. Just an estimate to give the context. This is an estimate I picked up from SBI Research. For India, every $10 rise in the price of Brent oil would have meant 25 to 35 basis points impact on inflation, consumer inflation, and 20 to 30 basis points straight impact on GDP growth. That was a worst case scenario. It never played out. So that's point number one. Oil prices are not a concern. Number two, absolutely no impact. While it's a human tragedy playing out for years across the Middle East, but in terms of corporate earnings, whether it's US earnings or global corporate earnings, absolutely no impact as of now. And point number three is that no impact on financial stability. In the past, when markets have been disrupted, either it's oil, like with Russia and Ukraine, or with the GFC, we know it was the financial stability which was rattling markets. But we've not had any of that so far. So what next? Markets are already looking forward to the future. And it's trade talk, it's the Fed's next move, it's US inflation. All of those drivers are firmly back in the windshield now, and geopolitics, dare I say, at least for now, seems to be in the rear view. Just on this piece on trade and US inflation, what the chatter is, very quickly, the general consensus is that final US tariffs are going to be anything between 15 to 20%. BlackRock says it could be 10 to 15%. JP Morgan is saying 15 to 18%, so on and so forth. On inflation and recession, the verdict is slightly divided, but no one's calling out for a recession in the US. Most people are saying that there could be a stagflation kind of a scenario in the US, and that's where the market is exactly focused. The estimates that I looked at, for instance, Nomura is saying that by the time we get into the fourth quarter, US GDP growth would have slowed down to under 1% from being 2.5% last year. And that's the real point. What will the Fed do? And the estimates are that inflation will pick up to 3.5% in the US. So will the Fed finally move? Mr. Trump has been telling the Fed to move all this while, and they've not. But will they move? So markets basically have come back to their usual realities, their usual playground, which is the final impact on tariffs, inflation, and what the central banks do next.
Well, that is right. And, that resilience has, as I pointed out, been somewhat startling in the light of everything that we've seen happen around the world. Well, you were talking about the Fed and, you were being polite, Surabhi, that he's been asking the Fed to cut. He's gone much further than that. In fact, the reports do suggest that President Trump could be looking at, potential candidates at this point in time, to replace Powell. So, of course, that battle continues. And even as far as tariffs are concerned, look, we're coming very close now to that 9th July deadline. What happens come the 9th of July? There has been no deal with the EU. There has been no deal with India. Both those deals at this point in time look like they are stuck over sensitive issues in the case of India, agriculture, genetically modified crops, dairy. Those seem to be the asks on the US side, and India unwilling to relent. So what happens on the 9th of July? Do we revert back to the 2nd of April or not?
Listening to Trump. Nobody's listening to Trump.
Everybody's listening to Trump.
Definitely not.
He's saying if you don't listen, I'll come at you. He's telling that to even Mr. Netanyahu. He's saying that to the Iranians. He's saying that to the Fed.
Exactly.
I thought only one person is speaking, everybody else is listening.
Nobody's really conceding. That's the takeaway.
Right. And honestly, guys, I think the Indian government is also coming around to the fact that let's not compromise too much on our core interests of Indian agriculture. If there's no deal till the 9th of July, it's fine. Let's live with it.
The clock is really. But I'll tell you one point on that thing. Shireen, it's a self-imposed deadline, right? US is a self. It's not as if. So if they feel that they are making good progress with countries, friendly countries, I mean, it doesn't have to be this side or that side. I mean, live this side and die that side. They can extend it.
Okay.
And that's why the market is rallying, right? It's the proverbial kicking the can down the road. Jab hoga tab hoga. In the meantime, corporate earnings are fine. Inflation is okay. So let the party continue.
Just to add to what...
It's taco. It's taco. It's
correct.
Taco all
Exactly.
over again.
Correct.
All over again.
So, Shireen, just to add to what, Surabhi said in her opening remark about why markets are resilient, I put out a piece last week as well. The fact is, crude is the only factor which was impacting India. If you look at from a trade perspective, the trade to Iran, the trade to Iraq is very, very small. From an India point of view, it doesn't add any much of a difference to it. So I guess that's also the reason why at least India market has been resilient and not reacting.
Even global markets.
Markets.
Last week we did that piece that if you look at the only channel through which these geopolitical, especially the Middle East effects, is oil. Right? That's the cleanest expression.
Correct.
And through you go back to the 9/11 attacks. You look at everything else, right? Prices spike. But they don't last.
They don't last, exactly.
Even after Russia invaded Ukraine, prices doubled for 3 months after. But within the next 2 months, they were back below when the invasion started. So they're not durable. You see a spike, but they're not durable. And of course, I mean, if that is the one biggest impact and that is not showing up, why should other markets care?
I just want to make one more point on markets and maybe go back to Shireen and Parikshit on this. Folks, typically, I mean, from a market perspective, things like corporate earnings, what's happening with global flows, local flows, those have been the driving forces. The market till now has not been too perturbed with the way forward on the India-US bilateral trade agreement.
No, but it's not just
I want to know, just to complete this point, Sriram, I want to know from the wisdom of this group that typically you can argue that, in US is not such a huge exporting market, and anyway, we're a domestic-facing economy and all of that. But markets can at times be complacent, and no one in the market is talking about that being a risk. If there is a roadblock or the sticky issues are not resolved, we don't know how it goes out, but I know for a fact that in market narratives, a stalling of the deal or a delay of the deal is not being counted as a risk. I don't know, whoever wants to comment.
For the India market, what you're saying, Surabhi, is absolutely perfect for the India market. But I'm saying from a global market point of view as well, I think the one thing that market is not considering is every day it seems like a likely event, which is a stark political instability in the US for Trump. He is he lost his base partly during this attack. He's trying to recover that with a taco moment, like Shireen said, by pulling back from the war with Iran. And now he is in straight coalition course with none other than Tulsi Gabbard. She's not part, I mean, just a report coming out right now says that she's not part of the congressional briefing committee, and she should be otherwise. And she's been a big supporter of Trump, and now she's fallen off, especially after the Intel report that denied Trump's claim that Iran's nuclear facilities have been obliterated. The Intel report says it isn't. So there are cracks within the Trump administration, and I think market may be underpricing that. I'm not saying it's going to break the back, but it might be underpricing this political instability that's coming up.
Well, you know, on that issue of political instability, one doesn't really know. I mean, let's look at what Trump will like to present as the narrative of how he's got NATO to do what he's wanted NATO to do. I mean, let's talk about that other big event that's taken place where, you know, NATO countries have now committed to defense spending of 5% of GDP. And remember, Trump taking full credit, as he always does, for that as well. But to be fair, I mean, this was one of the things that he has put on the table. You know, so he can claim victory for that. And, you know, we saw this with Musk. We've seen this with Bannon and other sort of right-wing, you know, influential voices expressing their concern about going after Iran and so on and so forth. But, you know, we will have to wait to see how much this impacts or dents Trump politically. So I don't know whether to say that he's lost appeal or he's lost support. It might be a bit premature at this point in time. The ratings so far don't show any significant dent.
It was really bad even before this war.
No, I'll tell you. I think both sides are correct. I mean, I remember speaking with the former Foreign Minister of Singapore, George Yeo, and you know, he said that US. It's not the political risk. His point was it's so divided now, the US. I mean, politically, right? It's so stark. I mean, nobody's ready to work with the other team.
It's one thing for the Democrats and the Republicans to be divided or polarized. But the division within the Republican Party is the problem because he needs.
But beyond the point, who is there? I mean, beyond. I mean, is there, you know, it's also that what do we call it? Tino, whatever we call it, Marcus, right? I mean, he's the guy. Actually, but political risk is that deep divisions within the US. Not one party is not ready to work with the other, repealing earlier policies, etc. But I think what Shirina said is also absolutely right. I mean, actually, if anything, after this, if you read US press, etc., I mean, the general consensus is, you know, the Democrats don't know what to do. I mean, you know, Trump has got this and that, and he's got lots of victories to show.
You know, that litmus test on how deep is this risk and if it's becoming meaningful in any form, I think will happen soon enough, right? If they can push the big, beautiful bill through and some of the other legislation through, then it's Trump all the way. I mean,
this is fine right now because they have a narrow edge in both houses, which will be tested within 12 months, right? So, or 18 months. And that is why he needs this crack within the Republican Party to not, the chasm to not widen further.
Can I you know, Shireen? Sorry.
Go ahead, Prashad.
I have, let me just turn this entire thing on its head, if you guys will allow, right? So what are we talking about? We're talking about Trump, risk and politics and, you know, strikes and geopolitical instability. I want to make 2 points. One is, what if the strikes in Iran, what was the big fear? That America as a global policeman is retreating. But with these strikes in Iran, it's a point of view. Is it possible we can look at it as a decisive move by US? Well, you know, he's saying that if needed, I'm ready to do what is required to maintain stability.
He's the sheriff in town and the only sheriff in town.
So that is one point. The second point, I've just compiled 5 points, right? 5 instances, which kind of, you know, flow in that same direction, which is Trump is, as someone said, you know, Trump is a New Yorker. Right? And New York is all about business at the end of the day, right? I mean, you want to, as I don't know where Jerry Maguire, the famous character was based. I don't know if it was New York, but show me the money.
Show me the money.
That seems to be his sort of, you know, posture all along. So look at what he's doing. Actually, if you think about it, step back and think about it, it's quite unprecedented. After bombing Iran in his own style, right? What is he saying? He's saying, well, you know, we could hold talks with Iran. He's saying it's a great opportunity for Iran and the leaders there. And they've got the oil, as he put it, right? And is it possible?
This morning he says, I am not taking the oil.
No, this morning was the hilarious bit. He says, I don't care if there is a deal or not. I mean, that's...
And we're not going to take the oil.
Look at the pattern. Look at the pattern, right? What happens is after every sort of geopolitical event in the Middle East, oil output from that country goes down. That's what we've seen. What if all this Iranian oil comes back into the market? Right? That is one. Now look at Syria, which is even more stark. As Trump met with Syria's, he's an interim president, Ahmed al-Shara in Saudi Arabia. Why is it important? This gentleman's past includes imprisonment in Iraq for insurgency against US-led invasion, right? He's willing to meet with the guy. He's kind of sort of recognized. And he said, well, we want to give Syria a chance at peace under its new leadership. Look at these recent reports with Pakistan. Asim Munir, the Pakistani army chief, met with Trump, and there are reports which suggest that they are discussing rare earth reserves in Balochistan, right?
Good luck with that.
And there is, of course, counter to China, etc. as well. Gaza. I mean, I'm not making, little of course, the human tragedy there. What Trump is saying, a big real estate site for development and stability, and we will bring peace to Middle East. Netanyahu said the proposal is revolutionary. Now look at, of course, going back to the first time, North Korea, the only sitting president to meet with, the North Korean dictator, and there were all those summits. The point I'm making is, we say that Trump is transactional and we don't have stability, but all of these kind of point to the fact that he just wants to, okay, you're my enemy, but I want to work with you. You're not a permanent enemy, I want to work with you. And so is it possible that all of these things, right, if it brings about more peace, stability for a while, actually spurs growth and spurs...
You've added one more very important pillar to why the market is rallying.
Yeah, exactly. And I liked how Prashant had framed it, conflicts versus contracts. And I think that is also something that the markets are pricing in, Surabhi, at this point in time, that he'd much rather actually engage and get deals done, whatever those deals may be.
China has political, economic and every reason to support China to the hilt the way US has supported Israel. Essentially what this conflict has showed us is...
To support Iran, you mean? To
support Iran. So to support China, China has all the reasons to support Iran, just like US has supported Israel. But that didn't come through. The BRICS statement was fairly, it didn't even name US or Israel, which essentially pulls into question the integrity, the purpose and the utility of BRICS as a bloc. Because 2 years ago, Iran...
I think that the BRICS bloc anyway, the integrity
faded. I mean,
the BRICS bloc anyway is I think that question...
A brick in the wall.
It's another brick in the wall. Nice, Prashant. Good one.
But the Russian position in this was interesting as well, right? Russia categorically said that they're not looking to intervene. I mean, at least on the face of it. They were sort of following a very careful middle path.
Correct, exactly. So Russia has common interests both in Israel and Iran. So Russia's problem is slightly divided. It's like, a lot of other countries which have divided interests. But so the final takeaway of this is what? Essentially what it is showing us, this war, is that an ideological alliance is far more utilitarian than a transactional alliance like the one that Iran has with China. And if Trump is taking us towards that world where every relationship is more transactional and less ideological, then these alliances are going to be very fragile. And therefore, the risk of any conflict exploding into a market event or a black swan event in the next 2 to 3 years is more than it is right now.
I remember we did this quick cut.
It's a complete opposite. It's we have a divided house here because Prashant.
You know, I was going to say something. I said time is done. I don't want to, launch into. But I think.
No, but I remember last episode when we were missing Shireen, we did this final quick dipstick towards the end. And at that point, the bomb hadn't been dropped.
Correct.
US had not entered. And I remember all of us were saying that there'll be a deal and the US won't enter. Shriram was right. I give it to you. Full credit back on the show.
Thank you.
But
we can do. I mean, let's Prashant. Let's hear you out, right? I mean, what's
are the conflicts over? Can the markets keep marching on?
What's your contribution? But all I'm saying is, you just look at what is happening. He's working with everybody. Nobody is taboo. Nobody is untouchable.
Correct.
Right? So what does it show us?
No, I'm saying nobody is untouchable, but to what extent are you going? Because
look, Sriram, my point is he recognizes what is real politics, right? We can't change things. We can't affect all these regime changes and impose democracy on countries, etc. I think that's not Trump's view. It's never been. He just works with you as you are. Now, you may be a bad person, a good person, whatever. The point is, but let's work and let's sort of look ahead. And so in terms of whether that will lead to more productivity, more better sort of economic output overall, a net positive. I think
Prashant has a
yes.
positive spin to it. It sounds very positive.
It's logical, right?
It works as my point is. I'm not denying.
There's truth in both. I think there's truth in both that a Trump world. We are going to see more instability because, as we've been discussing, there are no permanent friends and there are no permanent enemies. But also equally true that at the end of the day, show me the money or put the deal on the table.
And think about it. If Syria comes back into the global fold, if Iran comes back into the global fold as a real actor. Right? I mean, it's like an isolated country, right? It sells most of its oil in Asia to one country. So it's not really integrated.
I don't think we are in contradiction. What you are saying is that it works till it works. I am saying the moment it stops working, it's a spiral.
Yeah.
So that
is true anyway, na?
No, that's true. But the chances of it going into a spiral is more when these coalitions are not based on cemented on.
So let me simplify it and add a little bit of Hindi. But he'll show the danda and then he'll do the deal.
1 second. Yeah, but and just to sort of play devil's advocate and taking off from where Prashant left off, if coalitions were effective and efficient and actually carried weight, then we wouldn't be in this.
We wouldn't be in this position.
Three years on
all this rules-based international order. I mean, there was no rules-based international order. He's just shown it to.
The rules-based international order worked for 30 years.
I mean,
this one will not work more than 3 years.
It worked for some, it didn't work for others, right?
Correct.
I mean, let's face it.
What has changed from June 12th to now? My question is that June 12th, June 11th, when Israel attacked Iran, from then to now, what has changed? Nothing. Just that, except for Iran is slightly weaker. We can't agree upon whether it has nuclear capability or not. Israel wants regime change. It will continue to push for it. Netanyahu is not going to give up. Trump doesn't want a war, but the people, he's falling out. He's fallen out with Elon. He's fallen out with other, now with Tulsi Gabbard.
Yeah.
So the point is that the power centers are not weaker. The players are.
Yeah.
Yeah.
So that's a good point. That's an interesting take, and that is a good point.
I think Parikshit wanted to come in here.
Just one thing that I have, and I've been speaking to many experts, and this is what Ashley Tellis also said, Shireen. He said, don't take whatever Donald Trump says too seriously, or don't take it too hard. This was his advice for India, and I think that makes a lot of sense. Don't take him too seriously. Don't feel too bad about what he says. Be very practical. Defend your interests. Be agile in the current global environment.
I mean, you look at his language every day at the White House. He speaks every day, right? What does he say? These are the very bad people, but we're going to work with them. You know, they're very unfair to us. For India, for example, right? When he first started, they're very unfair to us, but they're a great country.
No matter how much he dislikes a journalist or a media house, he gives them interviews. If only to abuse them, he speaks to them.
Yeah.
That's all.
I don't know about the Nobel Peace Prize. I didn't think in this life, at least on live television, we would have had to report on the F-bomb being dropped by a US president. But that has also happened. That has also happened. But you know, I want to end with I think it was this morning that I got a WhatsApp forward, which was really interesting if you think about it. You know, whether it's the US, where an almost 80-year-old man believes that he's 20 and still raring to go day after day. You know, it's Netanyahu also into his late 70s in Israel doing the same. Look at Iran again. You've got, you know, a leader there well into his 70s or perhaps even
80s, 85.
80s,
Yeah.
exactly. And these are men
tagline,
and leaders
Shireen,
who are,
may I suggest a tagline?
Who are, what is the tagline?
Boomers turn bombers. So, you know.
You thought this through earlier, na, Sriram? Like on the spot.
Clickbait. The clickbait. He must have checked with SEO.
No, not yet. This, you know, very impromptu.
But, you know, but that, something to be said about the staying power of these men who are still at it, who are fighting for relevance, fighting for to make an impact, fighting for their voices to be heard, and behaving like they're in their 20s. There's no sort of burnout or fatigue or any of that, which is something that we hear quite constantly from
no work-life balance.
We can do a boomer versus Gen Z debate on another show, but that's the sum and substance of where we find ourselves. I think the point that we've been trying to make is that while headlines may be screaming catastrophe and disaster, the markets are telling you a different story. Now, for now, the markets seem to have been proven right. Will they continue to be proven right is the big question. But for now, the markets clearly have this round. Prashant, Surbi, Nimesh, Sriram and Parikshit, many thanks
Shireen,
for joining us.
Notice
Yes.
the,
Yes.
the CNBC access.
New cups.
That's totally unfair. Yeah? We don't even have those mugs. What kind of a transaction is this? Yeah? This is terrible.
We can strike a deal off air. We'll call Parikshit. We'll do a deal.
But I would want to request, before we sign off, Shireen, I would like to request our users to do check out CNBC-TV18 Access. I mean, if you're watching this, you're probably on it already, but do tell your friends is what I mean. You know, if you enjoyed this episode. And please do in the comments, leave like questions for us on topics that you would like us to talk about, so that we can pick up from you and, you know, come up with, you know, think about stuff, help us think.
Yes, help us think and help us plan, and we would love to hear from you. So do visit CNBC TV18 Access, become a member today. From all of us here, thanks very much for watching. Stay tuned to the CNBC TV18 Editor's Playbook. We'll join you again next week.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: the Sensex and the Nifty snap a 4-day winning streak, but mid-caps continue to gain for the 7th day running. Nifty has now gained more than 8% in the first half of 2025, with bank stocks leading the rally. India's trade delegation extends its stay in the United States as negotiations continue. Sources say no consensus yet on agri, dairy, steel, tariffs and GM crops. President Trump remains ambivalent about the 9th July deadline, saying he could either extend it or even cut it short. Torrent Pharma is set to acquire 46% in JB Chemicals from KKR for just under 12,000 crore rupees. Will also launch an open offer, taking the deal size to more than 19,000 crores. The deal will make Torrent the 4th largest pharma company in India. The government is likely to invite financial bids for IDBI Bank soon. Sources say officials are close to concluding the share purchase agreement with potential suitors. It's the last day for IndusInd Bank to send its candidates for CEO position to the RBI. Sources say Axis Bank's Rajiv Anand leads the race. The bank is also likely to recommend Rahul Shukla of HDFC Bank and Anup Saha of Bajaj Finance. The US Senate passes President Trump's spending bill by a slim margin. The latest version of the bill reduces the tax on remittances to 1%, but the bill stuns the clean energy industry with a new tax on wind and solar projects. At least 12 people killed and dozens injured after an explosion at an industrial area in Telangana. The blast took place at a reactor at the Sigachi Chemicals factory, which manufactures microcrystalline cellulose. Andhra Pradesh Chief Minister Chandrababu Naidu hosts tech leaders as he aims to build a quantum valley in Amravati. Naidu says IBM, TCS and L&T have formed a consortium focused on quantum computing and artificial intelligence. That's an exclusive. Zomato's co-founder Dipinder Goyal is betting big on the aviation sector. Deep dive into his investment into a startup that promises buses in the sky. That's coming up. Well, let's start with the market action. The Sensex and the Nifty snapping a 4-day winning streak, but mid-caps continued to gain today. The Sensex finally lost about 450 points and the Nifty was down by about 120 points, 0.5% cut there coming in for both the Sensex and the Nifty. The Nifty bank closing flat, mid-caps up by over 0.5%. But that's the story for today. We're also at the halfway point of 2025, and in the first 6 months, the Nifty has gained more than 8%, led by bank stocks. Hormuz is standing by now to take us through the half-yearly report card for our markets. Hormuz.
More action than in an action film, more drama than in a drama film. Well, I guess the markets have seen it all in the first 6 months of 2025, be it tariffs, be it war, be it ceasefires. And after all of this, the Nifty has trumped up with returns of 8.5% in the first 6 months of the year. And this is after an 18% recovery that the index has seen from the lows that it had made at the start of 2025. The Nifty Bank, which is already trading at record highs, is up 13% so far in the first half of this year. And this tinge of green that you see in the mid-cap and the small-cap index is after a near 30% recovery that these indices have seen from the lows that they made earlier this year. Now, which have been the top performers on the Nifty in the first 6 months? No prices for guessing, but it is BEL and Bajaj Finance. The 6 months, though, belong to the life insurance companies. SBI Life and HDFC Life, both of them are seeing their second best calendar year already in terms of returns, and Bajaj Finserv, of course. And the underperformers, of course, it is the IT names that form the predominant list. TCS, Infosys, Wipro, all of them in there, along with Trent and, of course, IndusInd Bank, despite a near 35% recovery from the lows. You take a look at the mid-cap index, and Solar Industries has been the talk of the town in the last few months. Almost 80% returns in the first 6 months. Bharat Dynamics, BSE, L&T Finance is up 50% so far this year. What is down 50% this year, though, is Ola Electric, continuing to make new lows from its IPO price, along with names like Oracle Financial, Kalyan Jewellers, Premier Energies, too forms a part of this list. Defense has been a common theme across the Nifty, the mid-caps and even the small caps, because Garden Reach is the top gainer on the small cap index, almost 90%. Narayana Health until last week making new highs. Reddington and Navin Fluorine, after a slew of positive brokerage commentary, is up almost 50% so far this year. And among the underperformers, though, it is names like Brainbees Solutions, Anantraj, Natco Pharma, losses of anywhere between 35 to 40%. So it's been an action-packed first half of 2025. Well, the bulls would definitely be hoping that the second half is less action-packed, but it has enough legs to take the Nifty past its record high levels.
All right, Hormuz, many thanks. That's the Nifty report card for you. It's 6 months of the year already. Now, in less than 10 days, the 26% reciprocal tariff announced by US President Trump on India is scheduled to kick in. Hectic negotiations are underway in Washington as both sides aim to iron out their differences. When asked if the July 9 deadline could be extended, President Trump remained ambivalent, saying he could defer the deadline or even shorten it. Take a look.
Is that July 9th date a set for tariffs to snap back, or could there be a...
We can do whatever we want. We could extend it. We could make it shorter. I'd like to make it shorter. I'd like to just send letters out to everybody. Congratulations, you're paying 25%.
We can do whatever we want. That is the inimitable President Trump there. Finance Minister Nirmala Sitharaman, meanwhile, has said that India would love to have a big, good and beautiful trade agreement with the US, but not without riders. Speaking to the Financial Express, the Finance Minister highlighted that dairy and agriculture are red lines that India has drawn in the talks with the US. The minister was reacting to President Trump's remarks the deal could soon open up the Indian market. The Indian delegation has extended its stay in Washington for negotiations by 3 days. That is till today. Abhimanyu joins us now with more. Abhimanyu, so the trade negotiations continue today as well. Take us through where things stand.
Uncertainties over the economic fallout of reciprocal tariffs still remains, as India and the US are still engaged in discussions for an interim deal and a bilateral trade agreement. India's trade delegation has extended its stay in the United States by a day, which has raised hopes for a potential interim trade deal with the United States. Last week, US President Donald Trump had indicated that a very big deal with India was likely very soon. He had also indicated that he would write letters to several countries the US is already negotiating trade deals with, and in case the deals are not negotiated before a certain point of time, those letters itself are going to substitute for trade deals. Now, it remains to be seen how early these negotiations are going to end and whether an interim deal would be signed between India and the United States. Now, concerns remain over several issues pertaining to dairy and agricultural products, in which the US has sought lower duties. It has also sought higher access, more access for GM crops, something which is being resisted by India due to domestic concerns. It remains to be seen whether there is going to be an interim deal signed anytime soon, even as Indian negotiators till now have made it clear, as per government sources, that any deal which would be signed should be a win-win situation and should not be signed out of desperation.
All right, Abhimanyu, many thanks for joining us. So the clock ticking there as far as the deadline for the tariffs to kick in 9th July is what the date is. But as we heard from President Trump, could extend it, could even shorten the date. Now, the big corporate story, Torrent Pharma set to acquire JB Chemicals in a deal worth more than 19,000 crore rupees. The deal will make Torrent the 4th largest player in the pharma industry. Ekta is standing by to take us through the contours of the deal and the significance. Ekta, big one in the pharma space.
Well, yes, Torrent Pharma has announced a two-phase acquisition of JB Chemicals from KKR, marking one of the largest deals in India's branded pharma space since possibly the Ranbaxy-Sun merger. Torrent will first acquire 46.39% stake for around 11,917 crores and may pick up an additional 2.8% from JB Chemical employees at around 1,600 rupees per share. An open offer for 26% follows at around 1,639 rupees per share, with the total size of the acquisition for Torrent possibly going up to as much as 19,480 odd crores. Now, in the second phase, the companies will merge, with JB shareholders receiving 51 Torrent shares for every 100 held. Now, the deal values JB Chemicals at around 25,689 crores and 11% discount to its closing price ahead of the deal. With the JB Chemicals acquisition, Torrent Pharma is now poised to rise from the 6th to the 4th largest pharma company in India. The deal, in fact, is expected to boost its domestic revenues by 35%, surpassing 8,600 crores based on FY25 numbers. Torrent will strengthen its dominance in cardiac and gastro segments, gaining top brands like cardiac drug Cilacar with sales of 785 crores and gastro drug Metrogyl at around 342 crores in terms of a size of a drug. It also secures entry into ophthalmology and expands its footprint in the global CDMO space. Torrent Pharma may in fact fund the JB Chemicals acquisition through a mix of internal accruals, debt and equity via QIP. It could take on as much as 10,000 to 12,500 crores of debt, pushing the combined net debt to around 14,500 crores and a net debt to EBITDA to around 3 times on an FY25 basis, according to analysts. However, analysts including DAM Capital are not overly concerned. They point to Torrent's steady free cash flows and believe a 2 times EV to EBITDA leverage is reasonable and the debt could be paid down in 3 to 4 years. Now, while JB Chemicals currently operates at a lower EBITDA margin than Torrent Pharma, analysts are not overly concerned about that either. Torrent has had a strong track record of cost rationalization as seen in its past acquisitions of Elder, Unichem and Curatio, which saw margin expansions within 1 to 2 years. While we could see near-term dilution, analysts believe the combined entity could target EBITDA margins of 34 to 35% over the next 3 to 4 years. Lastly, what are the brokerages saying? IIFL recommends JB shareholders should avoid tendering in the open offer and wait to swap their shares in the merger. Nomura expects the adjusted EPS accretion in the mid-single to low double digits. They maintain a neutral rating with a target price of 3580. HSBC expects the deal to be 3% accretive to FY27 estimated EPS estimates. They retained a buy with a target price of 3,775.
All right, Ekta, that's the big pharma deal, Torrent Pharma to acquire JB Chemicals. At least 12 people dead, dozens injured after an explosion at an industrial area in Telangana. The blast took place at Sigachi's pharma factory in the state's Sangareddy district. The company manufactures microcrystalline cellulose and the blast is likely to have occurred at a reactor. Officials are yet to confirm what triggered the explosion. Both state and central government have announced monetary compensation for the deceased. Coal mines across India have been asked by the government to explore ways to extract rare earth minerals. The move comes amidst export restrictions imposed by China on rare earth magnets. Now, these magnets are critical for making electric vehicles. Government sources say coal mines will explore if rare earth minerals can be extracted either from byproducts or waste materials. India is widening its semiconductor ambitions beyond fabs. That's fabrication units. Sources tell CNBC-TV18 that the government has called for expressions of interest for 2D material facilities and research and development. The government is also open to funding depending on the readiness of the industry. Currently, chips are fabricated using silicon wafers. 2D materials are significantly thinner. No country or company is producing this commercially yet. Research is underway in countries like China, US, Japan, UK and Germany. Payment and identity cards maker Moneypal Cards is looking to debut on Dalal Street. The company has filed a confidential draft red herring prospectus to raise 1,200 crore rupees. According to Money Control, the IPO is likely to comprise a mix of primary and secondary share sales. Currently, promoters led by Gotham Pai family hold a majority stake of 60%. Krispy Kreme's India operator Cure Foods has filed draft papers with market regulator SEBI for its initial public offer. The offer comprises a fresh issue of shares worth 800 crores as well as an offer for sale, which will see Iron Pillar, PCC, Crimson Winter and CureFit Healthcare make partial exits. The company could hit the market between November and December this year. The proceeds will be used for expansion and equipment. On to CNBC-TV18 exclusive. The government is set to invite financial bids for IDBI Bank. Sources say officials are close to concluding a share purchase agreement with potential suitors. Shares of IDBI Bank surging in today's trade on the back of that development. The stake sale at the bank has been in several delays over the last 3 years. Sapna is here with more. Sapna, it has been in the making for a long time. Are we anywhere closer to a deal being done at IDBI Bank?
Absolutely. So this is going to be a completion of a long journey. If you can recall, way back in October 2022 was the first instance when the preliminary bids for IDBI Bank disinvestment had been called, and we are now in 2025. So what we are clearly given to understand is that probably the government is close to, agreeing or rather finalizing the share purchase agreement with potential bidders for IDBI Bank stake sale. And once that important milestone has been crossed, the next stage, of course, would be calling for the financial bids, and we are given to understand that there may not be too much of a gap between both the exercises. Of course, approval from the ministerial panel, which is headed by the finance minister herself, that will be sought, and the finance minister herself has already indicated that the government expects to close the IDBI deal in FY26. So my sense is that before H1 ends, I think the government will be in a position to call for financial bids, if not sooner than that.
Well, not holding my breath, but looks like there is some forward movement on IDBI Bank. It's been many years in the making. Thanks very much, Sapna. Staying with the banking space, it is the last day for IndusInd Bank to send names for the CEO position to the RBI. We learned from sources that Axis Bank's Rajiv Anand leads the race. The bank is also likely to recommend the names of Rahul Shukla from HDFC Bank and Anuj Saha of Bajaj Finance. The Bombay High Court has deferred hearing a petition filed by the CEO of HDFC Bank, Shashidhar Jagdishan, against the Leelavati Trust. The bank's CEO is seeking the quashing of an FIR filed against him by the Leelavati Trust alleging cheating and fraud. HDFC Bank has denied all allegations. The court will hear the case on the 14th of July. Now, 6 suitors submitted bids for Jayaprakash Associates under the bankruptcy process, but only 5 have qualified. We learned from sources that Adani Enterprises, Dalmia Bharat, Vedanta and Jindal Power are among the bidders for JP Group's flagship firm. Sources say that JP Infratech's bid was disqualified because it did not submit the deposit amount. As per banks, the government's bad bank 12,000 crore rupee offer to acquire JP Associates may have been used as a benchmark by bidders. DLF is all set for its Mumbai debut. The real estate developer secured Maharashtra Real Estate Regulatory Authority or RERA's approval for its residential project in Andheri. The first phase of the project includes over 400 apartments across 4 towers. The launch is likely in the next 2 weeks. Sources tell us the company expects sales of around 2,500 crore rupees with that launch. Andhra Pradesh Chief Minister Chandrababu Naidu hosted tech leaders from around the world as he aims to build a quantum valley in Amravati. The aim is to attract top tech companies to focus on quantum computing and artificial intelligence. Shilpa spoke with the Chief Minister, who said IBM, TCS and L&T have formed a consortium to invest in Amravati, and Microsoft is set to follow suit.
It is one more leapfrog development in information technology.
Right.
I started iTech City to promote information technology exactly 3 decades back.
Right.
Today, quantum valley for quantum computing and also artificial intelligence,
Yeah.
AI. This is the order of the day. I want to create an ecosystem for quantum computing.
Right.
Then that will be the future. I'm giving land. Government also will be a partner to this ecosystem. We wanted to take to the logical. These 50 acres of land. Land is not the constraint. Today here, TCS and also IBM and also L&T. They are all consortium. They are working together. Now Microsoft also is coming back. Today we had a discussion. They want to start quantum computing here.
Right.
We are developing Amravati today. So Visakhapatnam also and Tirupati. These are all the areas where we are having excellent advantages. Ultimately, if you give land also, people won't come. The confidence of the government and also credibility of the government is important. That we are establishing. That's why TCS has come, Cognizant has come, Google has come, RCR Mittal has come. All these industries, they started now.
Chandrababu Naidu there on their quantum computing valley that is being thought about for Amravati. Time for us to head into a short break, but up next, Zomato's co-founder Dipinder Goyal is betting big on the aviation sector. A deep dive into what his startup that promises buses in the sky is all about when we return. In a big win for the United States, Canada has cancelled its digital services tax that targeted American tech companies. Now, the move came just hours before the tax was set to come in. Following this move, Prime Minister Mark Carney and President Trump agreed to resume trade negotiations and reach a deal by the 21st of July. The implementation of the DST would have meant that digital services companies with a revenue of over $20 million in a year in Canada would have had to pay a 3% tax. The payments would have applied retrospectively to 2022, and Donald Trump had basically said that they would have no talks with Canada on a trade deal if this tax were to come through. Canada scrapping the tax, and now trade negotiations have resumed. The U.S. Senate has passed President Trump's spending bill by a slim margin. The latest version of the bill reduces the tax on remittances to 1% in a major relief for the NRI community. An earlier version of the bill had proposed to tax remittances at 3.5%. The new version, though, has stunned the clean energy industry with a new tax on wind and solar projects. Sonal is standing by with the details. Sonal, tough times for the solar and wind energy industry in the U.S. with this bill going, perhaps clearing the way.
Well, there's a new Senate bill and it has come as a surprise to the clean energy segment. The updated Senate bill has slashed wind and solar incentives. It has also added a new tax to the clean energy space. So now remember, the initial version of the bill, it required projects to start construction by the end of 2025 to get the full benefit of the incentives. However, the fresh version suggests otherwise. It says the wind and solar projects, they need actually to be up and running by the end of 2027 itself to get all the incentives. And this has come as a setback for the entire industry in the US. The legislation has also added new tax on wind and solar projects, and this is for projects which do not meet the criteria when it comes to using Chinese equipments for their projects. So this is also something which is new and that has been added to the bill. It has added that the production of coal used in steel making will also come into the credit basket. The other thing is that the bill has included quicker end to a popular $7,500 consumer tax credit for electric vehicles. They plan to end it earlier than what was expected. So earlier they expected to end it by the end of this year, but now they say it could end as early as September 2025 as well. And the entire electric vehicle industry has not taken it positively, and it has taken up a lot of criticism.
Sonal, many thanks for joining us. Now, Zomato's co-founder Dipinder Goyal is betting big on the aviation sector. Goyal has backed a new aviation startup, LAT Aerospace, that's aiming to transform regional aviation with what it calls buses in the sky. Madhya is here to explain more to us about this new venture and the plans that it has to turn this into reality. Madhya, buses in the sky?
Yes, buses in the skies. Well, we have talked about air taxis, the electric vertical takeoff and landing machines, a helicopter-like model that aims to beat urban traffic and help people with daily commute. We have some Indian startups who are developing air taxis, but those are still in the works. Some have their prototypes ready and are conducting tests. The government is yet to finalize the rules for air taxis. But LAT Aerospace, in which Dipinder Goyal has invested, has a different pitch. The startup is talking about buses in the sky, as you mentioned, that will connect smaller cities where people mostly depend on road and trains to commute, which consumes several hours or sometimes days. Now, India already has a regional connectivity scheme where airlines use smaller jets up to 80-seater to connect Indian cities, like Indigo, SpiceJet and Alliance Air operate regional flights. Then Star Air, Fly 91 are some regional players. Then we also have helicopters that can carry up to 6 people from one city to another. But LAT Aerospace is building a system designed from scratch. In a social media post, a LAT Aerospace co-founder Surbhi Das has talked about building a 12 to 24-seater hybrid short takeoff and landing aircraft that will operate from air stops. Now that sounds like bus stops, which will be no bigger than a parking lot. Built closer to where people actually live, which means residential areas. It will have no security lines or baggage belts, and people will just walk in and fly. That's the vision LAT Aerospace has. Sources tell CNBC-TV18 the company has raised $50 million, of which $20 million are from Dipinder Goyal. They are inviting aerospace engineers and designers to join their ambitious project. In fact, Dipinder Goyal in a post has promised to match or exceed on-campus offers to attract engineering graduates. He also offered ESOPs to those joining the project as the founding team. Now, the idea looks to be in concept stage, and the company will have to first build a design, a prototype, get government approval. It will have to plan on how and where to build these proposed air stops from where sky buses will operate. A key question is how it will use the existing airstrips, and will the government come up with new rules for this kind of model? It's a promising project that could revolutionize air travel, but building it from scratch means it will take longer to take shape.
Yes, it's certainly not going to happen overnight, but as Madhya was pointing out, this is a space that is broken, but it's also a space that has seen many invest and many dreams not take off. Will this one see the light of day, and what kind of rules and regulations will be put in place for this to be able to become a reality is the big question. But many thanks for joining us. With that, it is time for us to wrap up this edition of Business 360. The news will continue. Stay with us. We're watching CNBC-TV18. We're back in a moment with you. Hello and welcome to the 12th edition of Voices from the Valley. I'm Shireen Bhanwal. Over the past week, you've been listening to us bring you stories of founders and entrepreneurs on what they're chasing after. But today, it's time for us to turn the tables over to the investors. Where is the money headed? Joining us now on this very special episode is Sanjay Nath, co-founder and partner at Bloom Ventures, and Vivek Goyal, partner at Altimeter. Gentlemen, great to have you on Voices from the Valley. Thanks very much for joining us. Sanjay, this is now home for you. So from your vantage point here in the Valley, what does India look like?
Thank you, Shireen, for having us on. So it's the second homecoming, the second time I'm back here. In one sense, there's tremendous interest in India, and from the vantage point here, I see that excitement because India is both cross-border AI and SaaS, but also the massive domestic consumer tech story. So tremendous interest, and Bloom covers both. So yeah, I'm here, but I'm kind of a spokesperson, salesperson for India.
Yeah, spokesperson and salesperson for India, and I'll get to what you're selling in just a second, but let me get Vivek into the conversation. Vivek, to start with, a quick snapshot on the AUM that Altimeter is working with at this point in time, and the big bet is, of course, OpenAI for you guys.
Yes, so thanks, Shireen, for having me. So quick background on Altimeter Capital. We are a $10 billion tech-focused crossover fund based in the Bay Area. We invest in both public and private technology companies globally. And, I've been in the Bay Area now 7 years, and I really think I've never been more excited.
Okay.
And Brad, who started the fund, he's been doing this for 25 years. And if you ask him the same question, he's never been more excited to invest in tech. This is definitely the golden age of technology. If all the tech waves we've had, starting 1970s with mainframe computing, 1980s with personal computing, 1990s and 2000s with desktop internet, and I think 2010s with mobile internet and SaaS. We've had like $20 trillion of value created in technology, but I think the next wave of Gen AI in 2020s and 2030s is going to be much, much more. And you have finally a technology that can basically impact each and every sector of the industry globally, and we are very excited.
Well, the golden age for technology, that's the view there from Vivek. But, let's talk about this transformation and disruption. It opens up opportunities, but it also could potentially be an existential threat for many companies that are currently public today or even private. What do you see on your radar, on your dashboard as opportunities, and where do you see the threats today, Sanjay?
Interesting. Well, I fully agree with Vivek. You called it the golden age. We are also setting the golden California sun.
Yes, we are.
Thanks to that. Well, if you go back to sort of Chinese literature and language, I think the word crisis, it has both, right? It means danger, also means opportunity. So along with every wave of disruption, there's the positive energy and the light that it brings, but also crisis. It's interesting to quote Jensen Huang, who says that, the jobs are not going to be taken over by AI, but by people who can leverage AI. So I think that's very true, to bring in the human element. Our thesis is, again, we'll do about 2/3, 60% India for India, and let's say, a third or 40%, which is really built in Bangalore, Gurgaon for the world. Now, coming to your question about where the opportunities and the risks are, I think horizontal AI as well as vertical AI has the opportunity to disrupt a lot of the incumbents. So if you look at, let's take some cases. Let's look at Waymo in San Francisco. Right? I mean,
are you Waymoing or are you still Ubering?
Well, I have to wait for my younger colleagues to come. One of my colleagues actually, he lives in Bangalore but has done 40 rides. And I said, Waymo is going to come and say bye to you at the airport. And he introduced me, even though I live in the city. But what is really interesting is they are changing the user experience the same way Uber changed it when they came in. And that has the potential to disrupt so many industries. If you look at, I mean, we are also backing, we have Pixel, which is, doing space tech, my juniors from BITS Pilani. And the Indian government as well as the US Department of Defense are big customers. So they have the opportunity to disrupt not just in one or two pockets, but the world. The other, what is the reason this is happening is youth. I think younger founders don't have the baggage, and they don't have to do things. They don't see the way the way we saw it. So they said, let's just start from a clean slate. So whether it's space tech or autonomous robotics, or I mean, there's a autonomous. It's a little late stage. A company called Monarch Tractors that I just saw, autonomous tractors. Now that is so interesting because who thought, right, that there would be? So I think that the risk with this is, what does it do to the traditional jobs? I think people learnability and the ability to leverage AI. I don't think you have to be a sort of master at vibe coding or know to code yourself, but you have to know how to use these tools. I think the younger folks who can leverage that, and even middle-aged and older folks who understand where this wave is coming, either you're part of the bandwagon or you're off. And I would definitely encourage everybody to be on, and I agree that it's a golden wave.
And let's talk about the OpenAI bet that Altimeter has made, and I'll get Sanjay to weigh in on that as well, and the impact and the implications of this for India. What is the hypothesis of what OpenAI could potentially mean in the next few years?
Yes. I think the numbers are, on a top headline basis, numbers are staggering. Media reports indicate that the latest valuation is around 250 billion to 300 billion. But if you take into context the revenue, so they are at 10 billion ARR, growing over 3x. And if you look at the TAM, so Google and Meta make around 300 billion in ad revenue every year. And if you try and experience the ChatGPT product, it's much, much more personalized. The other day I was asking ChatGPT what kind of stroller I should buy for my daughter, and I was actually in Sao Paulo, and the app wrote that, oh, I know you're in Sao Paulo, it's a city environment, so maybe this product you should buy from this store. It's so personalized, right? And it knows all about my history. So you can make an argument that the ads on ChatGPT, because of memory, are going to be much more targeted, and it could lead to a bigger TAM. So we believe that the company can grow from 10 billion to 100 billion in the next 5 to 7 years, just by targeting and taking into Google and Meta's TAM. That's just on the consumer side.
Yeah.
And look, history has shown that consumer is mostly a winner-takes-all market. So we're pretty confident that this category is going to be huge, and OpenAI is going to win in that. The second is the B2B market. Yeah. So on the enterprise side, we spoke about coding agents reaching around 2 billion in ARR. Google is saying publicly 25% of code is written by coding agents and machines. The enterprise API, GenAI API market this year is going to be 10 billion. I think Anthropic is at 3 billion ARR. And OpenAI will get its fair share. B2B is more of a winner-takes, not a winner-takes, it's an oligopolistic market. So they'll take 30 to 40% share. So you add on top of the 100 billion, they can make 30, 40 billion at least in the B2B side. And the other thing is, if you look at history, when Google went public, when Meta went public, these companies were trading at 15 times revenue. And but these have been, Google is up 50 times, Meta is up, I think, 20x since the IPO. So these have been amazing bets. So you have to have, the foresight and the courage to look out 5 to 7 years.
Yes, look out 5 to 7 years, and you've certainly taken a big bite. So you have both courage and conviction that you're hoping will play out in the long term. But Sanjay, talking about OpenAI and what we're seeing happen as far as this AI wave is concerned, now where do you find India in that? From a consumer tech point of view, consumer-enabled tech point of view, it's a great market. It's a growing market. Eventually, you will make money. Hopefully, that's the bet. But as far as the AI wave is concerned, where do you find India today?
I think the right, to win for India has changed. A couple of examples. I mean, of course, I'm older than Vivek. So if you go back to offshoring and outsourcing as the first wave, and then you had product innovation. In the, let's say 10 years ago, in the pre-AI world, you could build software from Bangalore, Gurgaon, Pune, and Chennai, and then come here to sell it, right? Typically, where the Indian typical cross-border founder, you'd have, maybe a team of 5 here, and then, 95, let's say, in Bangalore. In this new wave, your product has to be the best. So, I mean, you may happen to be an Indian origin founder, but it doesn't really matter. I think the customer proximity to integrate more closely into your workflow integrations with your customers, you have to be embedded and entrenched. Earlier, just the customer-facing co-founder could be here, but now your head of AI, head of product have to spend time here, because all of us are learning at the same time. Whatever they are, whether they are a CEO or a CFO or a founder or an investor, we're all learning at the same time. So there's no room for error for any learning to be lost in translation. Right. You can't throw it over the wall or for a different time zone. You have to be here. So we're finding the other India. So India, coming back to India's right to win, I think it will still be for our companies I would say the product engine, and it has to be much more than labor arbitrage. We have great talent density. I think the administration's policy on visas are interesting, because we actually were just able to hire someone who did undergrad here in computer science, worked with 2 YC-backed companies, but because of visa issues, is now working for us in Bangalore. Now, that is a positive net effect, right? I mean, we are getting somebody from the Valley, the young lady who's moved back. So I think India's right to win has changed in the sense that the best founders who come here are moving. I was just at the YC Demo Day last week. Of course, it's all in on AI. I saw many Indian origin founders here, but the 1 foot here, 1 foot there is not working.
Yeah.
They're
so
finding
it's more, the foot has to be, the roots
Yes,
have to be here.
yes.
Now, if you are doing for the world, if you're doing Make in India for the world, you have to be here.
Yeah.
And the valley is back.
Well, you could say the valley never left and the valley is back, but I think it's more real now, like Vivek is saying. And, you know, he's got some great data folded up in his hands about charts.
I know.
Because you're kind of trying to predict the future and saying that, Vivek, you were talking about the incumbents and your disruptors. And remember, every incumbent was once a disruptor.
Yeah. Exactly.
So we're seeing many of them are thinking, how do we partner? You're seeing incumbents strategically invest in some of these disruptors.
Yeah.
So I think working closely with the ecosystem, and you're going to see many more, I think, handshakes, to use that word.
M&A a big sort of feature as far as 2025 and beyond is concerned? Do you believe that, as Sanjay is pointing out, we're likely to see a lot more of that happen because the Davids and Goliath story is going to play out as we've seen in the past?
I think spot on. I think it's an amazing, again, time to be a venture investor in the Valley and globally, because you are at the beginning of a massive S-curve with Gen AI. And the incumbents, I think unlike the e-commerce wave where the incumbents were retail companies, they were not ahead of the curve. But I think here incumbents want to be aggressive.
Yeah.
But I think they're still tied down by their existing sales motion, existing product teams. So they will do a lot of M&A. And what we've seen is that the new administration is much more in the US. It's much more open to M&A. We saw last week Meta bought Scale AI for 15 billion. We've seen Snowflake acquire a couple of companies, Databricks acquire a couple of companies, ServiceNow acquired like a couple of companies as well. So I think it's going to happen a lot. And it's like 1999, 2000, maybe like 168 companies went public in that time. So maybe not a lot of like companies going public, but we'll definitely see
a lot of M&A. But even on the going public side of the story, because that's seen a lull in the US, it hasn't seen a lull in India. In India, in fact, we've had perhaps our best year in 2024, but from a new age company listing point of view. But do you see a revival of the IPO market on the anvil?
Yeah. So I think the way we think about this is, IPO markets are always open. Are the entrepreneurs and companies ready to take a fair value that's conducive to us public market investors? And we've seen now Circle, the stablecoin issuer, went public, and the stock is up 7x in a matter of 3 weeks. We've seen Chime, the consumer fintech app, go public. We've seen, we see in the pipeline Figma, Netscope. We will see a lot of M&A this year. And I think, the approach we have as public and private investors that public markets are always open, and we would love to partner with companies who want to go public at a fair valuation.
The IPO story in India continues to look robust. I mean, we've got a whole bunch lined up at this point in time, from Urban Company, Meesho, and of course a lot of the fintech big boys, PhonePe, and so on and so forth.
I think it continues and has become. I mean, I'm going back to 2010, 11 when Karthik and I started Bloom, and we were right here talking to Valley VCs. And I remember one of them said, well, how many companies have gone public? You could name it on your hand. You had Make My Trip, Just Dial. And it's very interesting. I think Bloom is playing on both these pockets. I think there's a tremendous demand from not just institutional but retail investors for tech. The advantage is that you can have a lower scale but be profitable and go public. So in terms of our portfolio entry and exit construction, that's positive. And on this side, we are looking to partner with large entities, the growth investors like Altimeter, because that's where the AI companies need help, right? They need to build a global footprint, a Valley footprint, get entrenched here. Yeah. So it's really these two pockets that we are playing in both. And the IPO story is really interesting. I mean, we have a IPO chart with all our companies, our logos, including Purple and everyone else. And say this year are the milestones. This is when they're likely to go public, and we have sort of IPO readiness sessions that Karthik, Ashish, and our head of capital markets do, which was not the case 10 years ago. They either had to be IPOs here or maybe M&As, which are not really not paying for full value. So that's a huge change.
That's a huge change and a huge shift. But you're excited about India and the India story, given the growth of the economy, but also the growth of the consumer tech space in India. But you're not putting your money into India yet. Why is that?
So I think very honestly, it's very rare you see a geography which has trillions in GDP and also growing per capita GDP at like 6-7%. So I think it's the best place to invest from a consumer standpoint. And I think it's very likely that Zomato will eventually be a $100 billion company. You see in every country the local e-commerce player in Korea, in Coupang in Korea, Mercado Libre in Latin America, Amazon in US. We have Shopee in Southeast Asia and like Alibaba, JD in China. So you'll see, I think Zomato will eventually, should eventually likely be that. I think Meesho and Urban, I think I love those companies and entrepreneurs as well. I think the regulatory system in India is such that it's very difficult for foreign investors, both from a tax, compliance, it's a lot of burden to be able to invest in publicly listed companies in India. And we're trying to work closely to figure out solutions, but it's been pretty hard. But I would love to invest in all of these companies.
You would love to invest, but not at the moment. That's and you're out there perhaps raising money for a fund.
Yeah.
And what's the response been so far? What's the feedback that you're getting?
No, absolutely. So we are now raising our fifth fund. I think the sweet spot has always been about 250 to 300 million. We like that spot because I think the outcomes support it. I think more capital is also always useful, but you always want to measure your outcomes. So I think the response is it's a tough fundraising market in general. I mean, for the world. But what is interesting is there's a lot of belief in the India story. I'll give an example, Stage.
Yeah.
Stage, which is so interesting. I mean, Neeraj Chopra is a brand ambassador. He's very, very passionate while he practices. He's a proud Indian. He practices, his base is outside India, but he's, proud Haryanvi. They have paying customers and they just complete this round with Goodwater Capital, right from here in the valley, that invested in it. And imagine the potential, because you land one state and you can go across India. So you have local consumer tech stories with investor interest, and of course that is also helping us because people want to see those stories as well. I think one of the concerns in India has been just the return of, the lack of the return of liquidity and DPI. But we just had some good news. Secondaries have taken off, and again, as we have an IPO chart, we also have a DPI chart. Because LPs are asking for that and saying, okay, this is great, you have all these great markups. And I think the Indian IPO market is a huge, really attractive avenue that's enabling a lot of this, along with a lot of secondary investors who come in. So what India is doing now we need to show this recycling of cash, which is very active in the valley.
Which has started to happen. It started to happen as well. But we were talking about all the charts that you're looking at, Vivek. So throw some numbers at us in terms of what the big bets are going to be. Of course, linked to generative AI and perhaps outside of that as well.
I think the big debate in the market right now is that there is around $500 billion of capex going into Gen AI, right? And every year, by the way, right? So if you add it up over 4 years, it's like $2 trillion of capex is going into this big bet. Is there going to be an ROI? And that's the biggest
question. Yes.
And I think if you take a long enough horizon, 5 to 10 years, we definitely believe that there is a very strong ROI. And we are starting to see the shoots, the early signs of those ROIs. And we can walk through certain examples. Just like the way we browse the web. We used to have Google, a $2 trillion company. That was the gateway to the web. And I think that's definitely going to change. I'm not saying Google goes away, but Google search, the way it exists, is going to change. So most likely our bet is ChatGPT is going to take over. Could be a huge company. That's an amazing ROI. Second big area where we've seen immediate ROI is customer care. $500 billion industry. People are using, even by the way, Meesho in India, I've heard, they are using Gen AI. And they've been able to reduce cost and actually improve the CSAT. Because it turns out that the AI is more empathetic than a human being. And I heard that, that was a mind-blowing stat to me. So that's a $500 billion annual revenue industry, and that could be disrupted. Same, is like the Indian IT outsourcing industry. That will, the nature and the margins of that industry will change. Then we go into the coding industry. You have 30 to 50 million developers globally. And the way to think about Gen AI attacking this is that this is going to attack basically the salaries of these developers. So that's like a multi-trillion-dollar sort of an asset class. And you have companies like Microsoft yesterday, unfortunately, laying off a lot of people. Amazon publicly saying we need to keep our headcount flat to down. This is the golden age of margin expansion. So another stat is 2011 to 2021, big tech hired, the annual increase in employees at big tech was 25%. Starting 21 to 25, it's been flat. So the entire Silicon Valley had 25% employee growth. Now it's flat because people are, like Google said publicly, 25% of code is being written by Gen AI, right? So the cost saving potential runs into trillions. And then, you have education. I can now have a personalized AI tutor teaching me language. And there's a company called Duolingo, $20 billion company based in Pittsburgh. They are doing that. So I think you go line by line. Maybe in the near term, people are overshooting in terms of expectations, but I think in the long term, people are definitely underestimating.
So let me end by asking you forecasts for the year, whatever is left of it, and for 2026 as well. And I'll ask Vivek that also.
Well, I should have got a sneak preview at his cheat sheet. I think, again, the two Indias, I think the IPO story in India will continue to be stronger. They're all becoming role models, and we have, like, for example, Manish at Purple and Rahul, Dipinder and Zomato as a role model. So I think that continues to be very positive. Also building on the coattails of all the stats that Vivek shared. I think here it's certainly the golden wave again, and we're very excited. We were at YC Demo Day, loved what came out of it. We're also learning, that's new. And I think the older, the earlier wave was, the 1 million to 10 million to 25 million scale-up was great. Today we're seeing scale-ups to 100 million in 3 years. So we have to make sure our founders are part of that we are part of that. So very, very bullish on both the Gen AI, vertical AI story here, as well as consumer tech in India.
Okay, your time starts now.
Thanks
Throw
for
those charts at us.
I think so 2025 and 26 are going to be the years of agents. And, let me give you an example that, I'm trying to book a flight for my parents to visit us. And you try and book the cheapest flight. So you try and keep checking every day that, this is my flight, this is I want to get the cheapest price. But now you can have an agent keep browsing the web for me at the back end and just give me a ping, hey, this is the cheapest flight. I know they don't have like the EU visa and this is the best time, and just they have my payment information. I just click a button and I say, yes, just do it. So I think the technology exists. I think the tooling is being built, and all of us will be surprised, I can promise you, by what AI can do than not. So I think I'm pretty bullish on agents this year.
So agents will be the big theme, and that clearly